Very good morning. You're watching India Market Open, and you know the fantastic thing is, it is the last day of this trading week. What an action-packed but truncated week.
Somehow April is turning out to be my favorite month of the year.
Isn't it always?
It started very, very rocky, Neeraj.
No, market notwithstanding, just the number of leaves until May 1st.
And it's not done yet.
It's not done yet.
No, but to be fair, Saturday is going to be power-packed. With two big banking results coming in, and we're going to be tracking all of that.
Yeah.
But yes, last trading day of the week, and before we get into the global cues, guys, just one thought came into mind, that whatever the Trump administration is doing with global tariff wars, and maybe there's a reasoning to it, make America great again. What they're doing to NVIDIA is shocking. There's actually going to be a hearing to see if NVIDIA is giving any advantage to China. It's one of the most valuable companies created in America in the last, I don't know how many decades, and you're holding a gun to their head.
I think that a lot of what has happened over the last few months has been value destruction. So this is just one more added element to that.
Yeah, why would you mess with NVIDIA? That's just the only question. Anyway, let's just take you quickly through what the global cues look like, and not great as far as US markets are concerned, at least. Sell-off has resumed in US markets, largely as the Federal Reserve Chief has sounded a warning on tariffs driving up inflation. That led to the Dow losing about 2%, nearly 700 points. S&P 500 dropped over 2%, but it was the NASDAQ that really hurt, declining nearly 3%. NVIDIA, of course, that stock was down 7% for all of those reasons and more. Let me just play out for you what Jay Powell said and why this was such a big concern for the street.
Where we are now, again, to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood, and my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can.
Okay, so this statement from Powell saying that we may have to relook at what our goals are is something that has maybe concerned the street. The other thing perhaps that is concerning the street is this escalation of the US-China tit for tat. I mean, I don't even know if the numbers matter anymore, but for anyone who's curious, US's tariff against China is now 145%. China's tariff against the US is 125%. Of course, the US tariffs against China exclude some key electronic devices, etc. But nevertheless, that's where it is, and neither side seems to blink. Meanwhile, in terms of core data from the US perspective, March retail sales were better than expected, 1.4% growth. The expectation was a 1.2% growth. So that's given some relief. The US 10-year consequently slipped to 4.28%. Gold is continuing to shine, has crossed the 3,300 mark now. That's $3,300 to the ounce, as investors are flocking to safe haven. Oil has risen. Fresh US sanctions to Iran is the trigger there. Brent is at $66 a barrel. So that's largely the global setup. I'm going to pull up Asia and see what's happening there. Asia is open kind of mixed, implied for India, also telling you that you're going to have a bit of a weak start as far as India is concerned, about 50 points down. But let's go across to Mark Franklin. He's Deputy Head of Multi-Asset Solutions, Asia Manulife Investment. Mark, thank you so much for joining in. Pleasure speaking with you. Let's get your sense first about Jay Powell's comments that inflation is going to be a risky factor. That is expected, isn't it, if you are going to go into a tariff war? Why has that one comment spooked the markets in your view?
Yeah, good morning. The market was looking for some sense of striking the right balance between the perceived and potential impact on activity versus the perceived and potential impact on prices. And the market probably took the view that Jay Powell is leaning more of his focus on the perceived and potential impact on prices or inflation. Whereas in effect, if you look at the bond market reaction to his comments, actually the front end and the whole of the bond curve was pretty becalmed. And their view, therefore, the bond market's view is that the activity side of the equation is more important. And what you're likely to see is a more significant downwards impact on activity that offsets and is more important than the initial impact on goods prices as a result of higher tariffs.
Hi, Mark. Alex here. I'm asking about treasuries and I'm asking about dollar because it's not very often that you see the dollar move down at the same time as risk assets moving down. And we're talking about a situation where there is selling, in fact, by foreign investors in US Treasury on the long end. What are the implications in the near to medium term of those flows? And in the context of that, you see that there is buying in the Indian equity markets. I'm just wondering if fixed income will find takers in Asia, in India, equity will find takers based on the movement of capital.
That's a great question. It's really pertinent as well. If you look at all US dollar assets, whether it's equities, bonds, currency, there's significant foreign ownership. And what we're seeing is some retrenchment of ownership by European investors, by Japanese investors, and by Chinese investors, but for different reasons. In the case of European investors, the heightened degree of policy uncertainty and to some extent local distaste for what the policy shift has been is encouraging institutional investors in Europe to repatriate some of the overseas ownership and to redeploy some of that into local markets. Now, we don't necessarily think at this stage that we can conclude that this is going to be a permanent and progressive unwinding of foreign ownership in US assets, but there's going to be a marked shift down as an immediate reaction. In the case of China, potential lightening up of US Treasury positions, it's more as a result of an acute US dollar shortage. And it's almost forced selling, not as a result of a reaction to the Trump administration's policies. Now, what does it mean for bond markets such as in India and so on? You have to look at who the sellers are. And as I said, if you're a European institutional investor looking to de-risk to some extent your US asset exposure, you're probably going to redeploy that in your local markets, take less currency risk, take less repatriation risk. So it's not necessarily the case that those flows are going to find their way into other overseas markets. It's more about bringing it home to some extent first.
Mark, just one question. There are a lot of reports, right, about, I think WSJ is saying that US officials are planning to use negotiations with about 60, 70 odd countries to tell them to disallow China to ship goods through their countries, maybe to the US or otherwise. But at the same time, we are seeing enough data which suggests that China is making a pivot out of US to other countries for business, right? To Canada for oil, etc. How easy would it be for the carrot and stick administration currently, a strategy that the Trump administration is using to tell countries to quote unquote isolate China?
It's going to be difficult. But if you look at the longer term trends, indeed, the US as a share of China exports has been progressively falling over many years. And actually, that's as a result of China's success in cultivating other overseas markets. Now, with respect to looking for alternative destinations for exports, the Canada-US trade situation is still going to require US permitting of that transshipment route. And so it's going to be difficult for China to fully cultivate a more accelerated shift away from the US, even if goods ultimately find their way into the US market. Now, coming back to whether the US administration is going to be able to convince other parties to effectively choose between the US and China, it's really going to require a carrot and stick approach. What is in China's favor is it is a huge market for those other countries' own exports, even though most countries do run current account deficits with China, albeit much less so than the US. So it's really going to come down to what can the US offer as a means to offset what those trading partners would lose by effectively shutting off those transshipment routes.
All right. Mark, just a quick view on emerging market risk assets then. Do you think, as you pointed out, of course, there is this sense of bringing money home, bringing capital home, and not wanting to take that currency risk? In that context, I think if some of the noise gets separated, you're talking about earnings once more, and I want to know what you think of the expectations for India when you talk about your strategy globally?
Yes, I mean, if you look at the structure of the Indian economy, it has a high weighting towards domestic economic drivers and therefore less sensitivity to a marked potential downturn in global trade dynamics. And as a result, you would think, all other things being equal, that the earnings cycle should have less sensitivity to what is happening globally. That being said, though, we know that there are significant offshore earners in the Indian equity market that derive a significant portion of their earnings in US dollars. And if the US dollar continues to weaken, albeit at different paces in the different currency crosses, that may also have its own feedback loop, which could to some extent mitigate any of that resilience. So lots of movers and shakers. I think what this calls for is not just a country or regional view, but it's also a sectoral view. You're not only looking for markets which have a greater degree of domestic drivers, but also those sectors themselves which are deriving the bulk of their earnings from domestic sources rather than offshore sources.
Interesting. All right. Yeah. So then IT is something to watch very closely. Thanks so much for joining us this morning, Mark. Pleasure having you. All right, let's talk about what happened in trade yesterday, and let's start with that picture. Of course, we talked about foreign institution buying and significant buying at the start of the trading week, or actually, if you can call it the mid of the trading week. There were only 3 sessions, and you saw buying yesterday as well, close to 4,000 crore rupees. And domestic institutions once again selling to the extent of about 2,500 crore rupees. It's an interesting point because, I don't know, can we pull up the intraday chart for the Nifty 50? You will see around 130, 135. There you go. You see a big spurt, and that late rally pushed the Nifty 50 higher by 109 points, about 0.5% or thereabouts. And what pushed this rally? It was the Nifty Bank. It was banks that powered that late rally. The Nifty Bank, in fact, gaining as much as 1.4%. And what stocks in particular? You had Axis Bank, HDFC Bank, ICICI Bank that contributed over half of the Nifty 50's gain in trade yesterday. By the way, the Nifty 50 has now gained about 1,000 points, 1,038 to be precise, in the last 3 sessions. And the Nifty Bank's gain is close to 2,900 points, exactly 2,937 points, or 5.7% in just 3 sessions. It's been a rapid move up. In fact, the Nifty 50 is only about 1/3% lower in April so far. And that is quite a bit of ground that they've made up, that the index has made up. PSU banks were the biggest sectoral gainer, up about 2.4% in trade yesterday. Oil companies, both upstream and downstream, interestingly in trade, were higher yesterday. ONGC, Oil India, GAIL, all gained over 3%. But you also had something like a BPCL gain, and you had HPCL gain, in fact, close to 2.8%, if I'm not mistaken. There you go. So BPCL up 1.5%, HPCL close to 2.9%. Nifty IT, Pharma, Auto all out underperformed, and metals were also lackluster in trade. A few big movers to draw your attention to. JBM Auto gained quite considerably, about 11% or thereabouts, ended off the high point of the day. But this is as Delhi eyes a full bus fleet electrification. And IndusInd Bank ended over 7% higher on that auditor report that talked about the extent of the damages. IndusInd Bank, in fact, has gained about 30% from the 52-week low. And finally, MGL dropped about 5% on that lower APM allocation. That element that we were talking about the new well gas and the fact that the replacement cost is not going to be as significant as previously thought, not really being bought by the street yesterday. So it was down about 5%.
Yeah, so I mean, just the basic trade setup seems to be that the DXY being sub 100, commodity prices being lower is great tailwinds. But could, ahead of the long weekend, yet another long weekend, would large leverage positions be a no-no? The likelihood of that being a strong yes is there. And there are multiple quant indicators, by the way, which now kind of indicate that we are in the extreme greed zone. So maybe the positions also being high. All of that put together, you might not see a hunky-dory uptick today. I mean, it'll be surprising really if we end with a very sharp trending up move today. So that much seems to be the given. And just looking at the statements that are coming in, we spoke to Vari Energies, by the way, and that interview will come in next week. Systematics came out with a note on Inox Wind and have spoken about the kind of bumper quarter that Inox Wind might put out in Q4 today. And I'll talk about that. MK's note on CESC. Everybody speaks about the near term, while there is a global uncertainty, that energy transition seems to be the most certain near-term, short-term deliverable index. Almost everything else has an uncertainty or two element to it. except for this one. Maybe consumer durables thrown in out there, but this one seems to be very, very strong. So maybe it's a pocket that people might stay invested in or flock to in these times of global uncertainty. So that is one thing to certainly watch out for. And big day for results. I mean, Tamanna was referring to Saturday, but today there is Infi post-market hours, there is Jio Financial, there is HDFC AMC, there is HDFC Life, Tata Elxsi.
Yeah.
It's small in number, but it's a set of very important companies to watch out for today.
Yeah.
And, so results is one factor to watch. We'll take a look at some of the other factors to watch before we go to Puneet. And among them, apart from results, I would say is the IT pack as well. So, Neeraj, you spoke about Infosys, but Wipro. And the kind of numbers that we saw from Wipro is definitely going to be a dampener for the street. So let's pull up some of those factors to watch if we can. Now, this note from Lawrence Belanco is the other interesting one that we need to watch out for, because look at what has happened. Nifty has extended its winning streak for the third consecutive session. The index may continue its upward momentum as per analysts. To watch out for that. Here's what Belanco is saying. He's saying break above the 200 DMA would trigger bullish implication. Such moves would support an upside target in 26,427 to 26,430. That's CLSA's point of view coming in. He also says essentially a move back to the September 2024 highs. Worth noting that the bank index continues to work its way higher. Apart from that, I would watch out for IT in today's trade. I would watch out for banks. So IT banks continue to be in focus. Their top picks as per price action for CLSA is HDFC Bank, ICICI Bank and Bharti Airtel. So those are some of the things that you need to watch out for. But let me go across to Puneet for more on what are the trends or what is, ahead of a long weekend. Is there enough action to talk about today in the F&O space, Puneet?
Well, definitely, because we are seeing a continuous short covering in the market. So we are seeing traders not taking large leverage positions, as you guys highlighted as well. And today, the GIFT Nifty is indicating an implied open of about 50 points in the falling on the Nifty. And essentially the 23,300 where we started off yesterday, we are currently at 23,400 odd levels. That will be one of the key supports in the near term, at least for the Nifty. We're also anticipating 23,600 to be one of the next key resistance level essentially for the Nifty. So the band will be something to watch out for amidst, the results season that we come in. This is, of course, when you also look at the put option as well as the call option open interest as well. We've seen the maximum call option open interest at 24,000 now, while the maximum put option open interest is seen somewhere around the 23,000 level. Essentially, you're seeing the big red candle at the start. That's essentially for the maximum put option interest. We've also seen, some interesting calls being developed at 23,500, but largely the out of money lower premium 24,000 call is something that traders are looking at. Let's also look at some of the key stocks, because as mentioned, we're seeing a lot of short covering in the market today, especially some long build up in stocks like Indian Bank, Hindustan Zinc as well as NBCC. But when you look at the open interest loser side, there we've seen a consistent short covering across a bunch of stocks which might be active in trade again today as well. Now, as we mentioned, finally, we are looking at 23,300 on the support, 23,600 on the resistance, but largely the index will be in focus specifically on the results. So Infosys coming out today, that would be one of the key ones to watch out for in trade today as well.
All right. Thank you so much for that, Puneet. Let's get to some of the stocks that we're tracking this morning. Wipro has to be on top of that list, and a disappointment there. Let's take a look at the ADR. The ADR was down about 5% overnight, and just giving you a sense of to what extent that disappointment has come down. 3% is where it finally settled. A poor set of numbers was expected, but this has disappointed even the lowered expectations. The Q4 numbers for Wipro has disappointed on most parameters. Deal wins have clearly not translated to revenue growth. Guidance below street expectations. Company guides to a largely negative Q1. Now, here's what the numbers look like in Q4 in Q-on-Q. Revenue was up 0.8% at 22504. EBIT was up 1%. At 3,902 crores, and margins were flat at 17.3%. Net profit was up 6.6%. But what is painful is the guidance. Guidance for Q1 is largely negative. They expect revenues of $2,505 million to $2,557 million for Q1 FY26. this is the important figure. The sequential guidance of minus 3.5% to minus 1.5% has been given in constant currency terms for first quarter. That means the company is telling you that they're going to grow negatively in the first quarter of this year, which is why, look at all the notes, and I'll just go through them very quickly. Citi is maintaining a sell. They've cut the target price to 215 from 240. They say the guidance for Q1 is below expectation. Management commentary talks about uncertainties by tariffs for clients, multiple segments impacted like manufacturing, consumer, BFS, Europe, etc. FY26 estimates likely another year of revenue decline. BofA on Wipro says they maintain an underperform, cut target price to 225 from 260. Q4 revenue and Q1 outlook are below expectations. The ask of a catch-up could remain for FY26. Improved market share in European manufacturing and high-tech segments are key to narrowing growth. Investec has maintained a hold but cut its target price to 250. They say FY26 is likely another year of revenue decline. Revenue decline will be weaker than consensus, and it's likely to be the third consecutive year of revenue decline. So no shining light there for Wipro at all. Expect the others to follow suit, and Infosys, we'll have to wait and watch what happens there. Vari though, good set of numbers. Thumbs up there. For Wari, earnings have been aided by 76% higher EPC sales on an annual basis. Margin impact on higher EPC contract, employee and other costs. So you will see some margin impact because of that, but revenues are looking good. Order book was up 38%. So look at the core numbers. Revenue up 75% odd at 477 crores. EBITDA up 68% odd at 126 crores. Margins have come down slightly, 27.5% to 26.5%, so about a percentage point there because of higher costs like I explained. Net profit meanwhile up about 83%. Earnings have been aided by trickle-down effect of higher top line, so that order book has helped. The third stock is an interesting one actually that I have picked today on the watch list. It's PTM. And this news coming out late last evening that Vijay Shekhar Sharma, the MD and CEO, has voluntarily foregone 2.1 crore ESOPs. Voluntarily is an interesting term here simply because this is something that SEBI had pointed out it was not happy with. So after that regulatory wrap, Vijay Shekhar Sharma has foregone all of his ESOPs. This means a one-time expense of 492 crores, which you will see in the fourth quarter. But consequently, you are going to see the pressure of ESOPs on this company's profitability come down. Now, what had happened is in September 2024, September last year, SEBI had raised the issue on whether Sharma had control over PTM. He was listed as a public shareholder during the PTM IPO, but he's running the show. So, are you someone who gets an employee ESOP or are you a promoter? So that definition was becoming vague. That has now been clarified. And in fact, the initial brokerage views coming in are fairly positive because this is an overhang. There's going to be about a 400 crore hit this quarter, but their path to profitability becomes clearer and quicker. Some assuming that you'll see a profit number even as soon as next quarter in Q1.
Interesting. Very interesting. On the point of Wipro and what you were talking about, it's already down. I was looking at the charts, 18% in 2025. Some of those target prices implying a further downside of 13%, which is quite stark.
Yeah, I mean, if indeed they do 3 years of revenue decline, and that is the expectation,
that's warranted
then maybe so, considering the fact that there might be a lot of other companies which might actually do slightly better than Wipro. So
fair point. All right, the first stock on my list is actually a tough one, I will admit, and I've given it a neutral rating, and it's not a cop-out. It was expected to be a bit of a weak quarter for Angel One, and it's panned out. The total income, in fact, down about 22% at about 1,058 crore rupees. The net profit also declining as much as 49%. But the thing is, the PAT was actually better than expected on the back of a sharp fall in employee costs. So that's the caveat. We'll have to wait for the management call to try and understand, or to speak to the management to try and understand where this fall has come from, because the fall was quite dramatic, as much as 23.4% sequentially, and that has resulted in a smaller fall than expected in the PAT number. What was the reason for the decline in earnings? You had, of course, the number of orders slump quite dramatically. Understand the context, of course, you had the regulations on F&O come through, and you had a weak sentiment in the equity market play out in the fourth quarter. The number of orders, in fact, falling as much as 22.4% sequentially, 30% on a year-on-year basis. Average daily turnover was also about 20% lower sequentially, 27.6% lower on a year-on-year basis. And the share in NSE active client base fell very marginally by about 6 basis points, not percent, 6 basis points. It shouldn't be percent on a sequential basis. The client addition is also slowed. Now, what a few brokerages saying? Investec had a note out on Angel One. It's maintaining a buy with a target price of 2,700 rupees, and the PAT, they say, is in line on account of a one-off saving in employee costs. They've attributed it to that, and some traction in new initiatives is being seen. However, just 3% of the net revenue earnings growth is set to remain weak in FY26 as well. DLF is the second counter that I'm talking about, and this is a thumbs up. It's a pretty simple update. The company has entered a master framework pact or an agreement with Srijan Realty in order to sell its ITES SEZ land parcel in Kolkata for a value of 693 crore rupees. Simple value unlocking. The amount can be used towards projects that they have underway right now. Puravankara is the third stock, also a real estate play. This is a thumbs down on the back of its Q4 business update, which was quite weak actually. Pre-sales coming down as much as 34% on a year-on-year basis to 1,282 crore rupees. Collections as well declining as much as 13.5% on a year-on-year basis. Average price realization was, however, up as much as 9% on a year-on-year basis. Pre-sales were down in all probability on account of delay in project approvals, but one can also argue that maybe the demand scenario is not as strong as they would like, Puravankara. So watch out for that in trade today.
What else? Just the three names that are part of my list, and most results covered, but Prestige Q4 update, while Puravankara was being, Prestige wasn't as bad for quarter four. So new sales jumped about 48% to 6,957 crore. Sales volumes about 9%. So not as tough as Puravankara, at least. Let's see if there is a bit of a reaction there. Keynes Tech, the government is, as per Reuters, planning a $4 billion DLI, which is Design-Linked Incentive Scheme, to boost India's electronic sector. Presumably will go into semiconductors, so on and so forth, designing. And therefore, one of the key beneficiaries could be Keynes Tech if they manage to bag this, of course. But usually people associate top companies with bagging PLI schemes or DLI schemes, I would reckon. So that's why Keynes Tech could be in focus. And from amongst notes, there are multiple notes, by the way. I thought the MK note on CSE was very good. They went and did the whole group meetings, etc. And they come back saying that while there are a bunch of companies out there and all of them could do well, CSC could do well. They say that its entry into hybrid renewables has been timely, and the synergy with the distribution business gives it a lower risk profile versus peers. Moreover, the growth outlook for its distribution license business is also improving, and the stock trades at a conservative 1.5 times price to book and 12 times EV EBITDA. So do keep an eye out for that. Well, these are the top three on my list. Okay, let's go across to our first guest on the show, Shaji Nair, research analyst, Mirae Asset Share Khan, who joins us right now on Wipro. Shaji, thank you so much for taking the time out. What did you make of, well, small profit beat notwithstanding, the revenue miss and the slightly tepid Q1 outlook as well?
Yeah, exactly. The revenue miss was there, which was not, which was kind of largely thought of there would be a decline, but there was a clear revenue miss. The EBIT margin was basically flat, and that was in line with the estimates. Though the order bookings were are robust, especially that was also pretty much in line because we as well as the street was anticipating the large deal booking, especially the Phoenix deal to show in the Q4 numbers. So the disappointment basically came from the outlook. The Q1 FY26 outlook that the company has provided shows the fallout of the increased uncertainty, and due to the macroeconomic headwinds. That is really disappointing because we as well as the street were anticipating somewhere close to -1 to +1, or 1.5 to minus zero point 0.5. That was what we are anticipating. So this was pretty much a steeper and a weaker guidance.
Shaji,
Yeah.
the next point, which is, okay, fine, we've seen what has happened, and of course the scenario globally and particularly in the US is very uncertain. So we'll take that, as par for the course. But the question is, heading into next year, and a lot of people are going to look forward to that, the outlook is so much worse than even what was being penciled in. And so if you are an investor in Wipro, do you finally say, okay, you've had enough patience, 3 years you've tried to give them an opportunity to pull their socks up. It's not happening. So do you pull the plug?
No, not exactly. We are not going to pull the plug. Basically, we have a hold rating on the stock, but looking at the outlook that has been given, and as management have been saying that this macroeconomic uncertainty, the increased uncertainty, is likely to settle down in some time. Probably we are not. We are not aware of the timelines when it would settle down, but importantly, it would pretty much settle down. And plus, with respect to Wipro's, the large deal win should probably, as the company said, should start ramping up in the second half, and that is a positive. And besides that, the robust pipeline that they have, that is again a positive. And once the cautious approach or the measured approach towards discretionary spends mitigates, probably we could see the demand environment improving, and the more of the large transformation deals coming in. With respect to that, I think probably the near term looks a little bit hazy, but maybe 3 to 6 months down the line, things would be pretty much more clearer, and things would be more, from a standpoint of Wipro, it would definitely be improving.
I'm just wondering, Shaji, if in terms of this worst guidance, and I know this is maybe clutching at straws, but in terms of this very clearly negative guidance, is Wipro as a company preparing for a worst case scenario? And any improvement from here on then will be a pleasant surprise. Is that one way to look at it as well?
The management has pointed out, they have got these large deal wins. The deal momentum is improving or is getting stronger. It is just that the near term, the clients have taken a backward or a measured approach, which has a bearing for the near term. But going forward with Capco showing traction, BFSI as such has been showing improvement. So on those aspects, certainly going forward, maybe once clarity emerges, Wipro could be out of the woods.
Shaji, so here's the question though. I mean, could it well be that we do not see large cap IT being in the reckoning list, including Wipro, but even otherwise? And if you are looking for growth, you will have to look at the slightly smaller names, because one of the base effect, two of the fact that they'll be a lot more nimble than the legacy business companies.
What we have seen and what we have anticipated for the fourth quarter is that large cap companies are really seeing some kind of greater headwinds compared to the mid cap companies, and we expect the mid cap companies to continue doing better. But like I said, FY26 was expected to be a year when the growth would return. The near-term headwinds that have come up and has been more, and is actually in fact more challenging for the tier 1 companies. But like I said, probably 6 months down the line, probably we'll have tier 1 companies probably doing well as well.
Okay, fine. All right. So 6 months is what you're penciling in. I'm just wondering, in a quick view here, Shaji, on Infi, we're looking forward to the numbers. Do you see a similar picture for Infi playing out?
Yeah, Infi, we are anticipating a weaker set of numbers. Among the pack, we expect the weakest number to be reported by Infi. And pressure on margins as well.
Okay, I'm just wondering in terms of the pecking order as well, Shaji, how would you look now? TCS, Wipro, we have clarity. We'll wait to see what Infosys looks like, but between the three, are you looking at one more favorably than the other two? What would be your preference order?
My preference order would be TCS, Infosys, based on the guidance that they gave out for FY26. Infi had reported pretty decent set of numbers for 9 months, but fourth quarter is going to be disappointing, and the outlook and the guidance would be play a major role in determining how Infi should be placed. TCS, the management has always shied away from being optimistic, but we are seeing some the optimism with TCS, and like they have said, FY26 is expected to be better than FY25. The pecking order would be TCS, Infosys, and Wipro for now.
Thanks, Shaji.
TCS post the guidance.
Okay, Shaji, thank you so much for joining us today. In fact, let's hear out the Wipro management after their quarterly numbers.
First and foremost, the guidance we are given is for the quarter, the next quarter, not for the year. So that's number one. Second, some of the large deals that we have won, especially the big deal that we have won, the Phoenix one, it's going to take us a few more months before we start ramping up. And that revenue tick will happen once, as per the contract, of course. And we're waiting, once that happens, we'll have a revenue momentum coming from that particular deal.
Expect the momentum to pick up only in the second quarter onwards?
The point I was trying to make is on that particular deal. But having said that, I think all of us know the macroeconomic situation. There is so much of uncertainties that are going on. And some of the industries are directly impacted with this situation and some of them indirectly. Just to give you a context, if you look at our consumer business, if you look at our manufacturing business, especially automotive and industrial, they're getting directly impacted because of the tariff situation that's going on. So those clients are actually waiting and watching, and they obviously want to contain the cost and also contain the cash. If you look at other industries, especially BFSI, those clients are actually waiting and watching. They want a little bit more certainty before they actually spend more on the discretionary spend. What we are doing as an organization is we are working with the clients as they're doing a scenario planning week after week based upon how the situation is changing on the ground. The idea for us is to sense and respond to what they're looking for and help them through these uncertainties. And whatever guidance we have given, it's baked into those. We have baked in those uncertainties for our clients.
Aparna, you are guiding for a narrow band of margins, 17 to 17.5. What are the levers that you have going into a very volatile and uncertain FY26?
So that it is going to be a volatile and uncertain environment. And the margins that we don't guide for margins. We have said that our endeavor would be to hold the margins in a narrow band. Obviously, given the weaker revenue environment, it is going to be an enormous task ahead, which we are all gearing up to. You would note that we've actually improved our profitability consistently over the last few quarters in the backdrop of a weak revenue environment. So, we are dipping into that muscle for us to hold these margins in a narrow band even going forward. The levers remain the same. We are aggressively looking at SPC productivity. We're looking at improving our utilization. We will be focused on rationalization of our fixed spends and also looking at how we can optimize on overheads. All hands on the deck.
Srini, give me a sense of the kind of client additions that you have done, because if I'm looking at your client additions on a year-to-year basis, you've lost nearly 10 clients in above $50 million. What is the kind of client outlook that you have, and what are they saying even with respect to orders? Are many of the transformational orders on hold, or they're getting pushed because now that we have a 90-day pause in the tariff negotiations, decision will be post-June?
So first and foremost, we called out growing our large accounts as our strategic priority. And if you look at the last quarter, we have grown the top 5 and top 10 clients for Wipro in the context of large accounts. And most of it is because of being proactive with them, making sure we're consulting-led AI-powered in terms of our solution and approach, which are a lot more industry-specific. And if you look at the rest of the clients that we have, we continue to stay focused in terms of how they are getting impacted because of the uncertainties and what are the decision criteria that they're going to make, especially around cost optimization, which is where our biggest pipeline is, and that's where they want to actually leverage, working with us so that they can get the cost benefits here and now. So some of those deals, we can accelerate through the process. But on the larger projects, larger programs and discretionary spend, and I'm sure they're waiting and watching. So it's a kind of a mixed bag, if you will, in the kind of the decision that they're making. So what's important for us is to look at what those pipelines are, what are those deals across Americas and Europe and Asia Pacific, what are those deals we can actually proactively tell the client, if you can advance them, you can get the benefit here and now. I think that's the work we are doing, and that's the work I guess will continue for the next 90 days that you talked about.
Saurabh, on the attrition front, 15% is marginally lower for you on the Q4 on a last 12-month basis, but on a year-to-year basis, it's gone up from 14.2 to 15%. As you look into FY26, what is the kind of gross additions that you're looking in terms of employees, and will your net employee count, which has been almost flat on a year-to-year basis, do you expect some increase in employee counts here?
2 or 3 questions are there, and let me start by saying that yes, we have ended the full year with a flattish head count, and as you heard from Srini and Aparna, that in the uncertain macro environment, very clearly we will see every quarter how it comes in and add people. We have made all our commitments as far as previous year is concerned in terms of what we said on campuses, what we did for people standpoint. We ended up with paying a variable pay of 95% for our employees in the last fiscal. So we hope that the attrition will look on the downward trend. As if for the quarter, if I look at the quarter for Q4, it has actually come down by 200 basis points. That is one. Second is we have some scope to improve our utilization, especially in the current environment, and where we believe that we can upskill our talent and deploy them on billable projects, stay them engaged. That also will help us as we move forward. But it's a very uncertain environment, other than we'll see how it plays out. But for supply side constraints will not impact any growth which is coming in FY26. That I can assure. So that's very clear in our head.
And what about wage hikes this year?
So we had done it, our wage hikes ahead of time last year in September, and we have still some time for us to take a call. Closer to the date, we'll take a call because, as I said, things are uncertain, and we'll keep you posted.
Srini, as you look at the entire environment, especially the discretionary spend, are you seeing clients now being a little, wary of, putting out the orders and signing off on the orders, or is it, is it that the deals are signed but they're put on hold?
I think most of the deals that we have won, I think we'll continue to execute. I'm not seeing any flags around that aspect of it. But having said that, going forward into this quarter, and we talked about the uncertainties, and that will actually impact in the decision-making process. Sometimes they may wait to get a clarity in terms of what's coming next, and sometimes there are certain projects and programs, especially modernization, they have to get going because they cannot stop those. So to me, especially the new projects I'm referring to. So to me, we have to wait and watch. We have to sense and respond to what the clients are looking for. And we have seen what we were talking about from an industry perspective in Jan. It changed in Feb. It dramatically changed in March. So it's I don't think I can predict what's coming next. But what is important for us, for each and every employee of Wipro, is to stay very closely connected with the client and respond to their needs in this uncertain times, and we are ready for it.
My final question to you, Srini, can you give us an idea of the kind of AI deals which are coming in, or is it integrated into the pricing of new deals?
So there are two types of deals. Deals which are new projects, which are game changers for our clients, and there are deals where we infuse AI into operation, run and operate, or the managed services. So there are two different kinds of deals. But every deal, big or small, has AI component built into it.
All right, so that's the management of Wipro. Not the best Q4, and in fact the outlook going forward into Q1 is also not the best. We'll see how the reaction is. Remember, the ADR was down overnight by over 3%, so expect a gap down for Wipro when we start things off today. Take a look at the watch list heading into trade today. There are a few stocks that we've already mentioned, but these should be on your radar. Adani Ports, Morgan Stanley has hiked the target price and is constructive on the expectations going forward. Renewables has had a very good quarter, and in fact the profits have risen by as much as 82%. DLF is set to sell a Kolkata land parcel for 693 crore rupees. That's a positive as well. Glenmark Pharmaceuticals has launched a new drug, and watch out for that one in trade today. I think, if I'm not mistaken, the revenue expectation is about $400+ million for the equivalent that is currently being sold. 361 is set to offer or to consider preferential fundraise, so that's certainly something that you should watch out for as well.
All right, Indigo, IHCL, both in the green on our watch list this morning because HSBC has hiked their price targets. Bharti Airtel as well on the back of Bernstein hiking its targets. What's not in the green list today but in the red list is Wipro. As we have been discussing, weak guidance and brokerages are also negative. They're seeing a degrowth between 1.5% to 3.5% in just Q1. Puravankara has seen pre-sales falling 34%. So a bit of pain there. Amar Dev Singh joining us this morning. He's Senior Vice President Research at Angel One. Very good morning to you, Amar. Neerav Ashar, Head Equity Research Analyst at Latin Manharlal, also joining us. Neerav, very good morning to you too, and welcome to both of you. Amar, let's start with your take on the indices. We've had a decent couple of days. The question is, do we sustain going into the long weekend once again, or you see some pain coming in? Because like yesterday, you might see a soft start and then a pickup. Do you reckon that's the pattern we'll follow?
I would say that if you look at the indices, Bank Nifty is definitely on the roll. There's no doubt about it when I compare it with Nifty, because there the structure is also very different. Also, what we are seeing is that across the board, there have been positive news on the banking side in terms of rate cuts, in terms of relative stance by the RBI. So those bode well for the banking space, and that's what we are seeing both in the private and the PSU banking. Looking at the index, I would say if I talk about Nifty, Nifty is, I would say, somewhat positive now on the intermediate term trend. But to stay positive, it needs to sustain over the 23,400 to 600 zone. That's a very important zone of resistance, because there we could witness some sort of selling pressure. Going by global cues, we could witness a down gap in the market, but lower levels are definitely going to be supported. So I would say anywhere between 23,000 and 23,200 is going to act as an immediate zone of support, whereas on the upside, 23,400 to 600 would act as a zone of resistance. So any correction can be a buying opportunity, but one needs to remember that it would be more of consolidation, which we are likely to witness in Nifty. And also, if you look at Nifty, Nifty is almost 3,000 points lower from its all-time record highs, whereas Bank Nifty is hardly 1,213 points from its all-time high. So that clearly shows that banks have been outperforming, and that's where I would say to focus more on.
All right, so you could well see a new high very soon based on the momentum that you've seen in some of these banking stocks as well. I just want to come to you, Amar, on whether or not you see any opportunities. Of course, stocks have been moving quite dramatically, and then after that we'll come to Latin on his view on IT, of course, because that's going to be a pocket of expected weakness in trade. So watch out for that. But Amar, any stocks that you're picking this morning?
One stock is from the pharma space, so that is Aurobindo Pharma. What we are seeing here in Aurobindo Pharma is that the stock has corrected from almost 1,600 levels, currently it's around 1,130. You've seen the stock forming very strong base, and also some of the technical indicators clearly point towards a pause in the downfall. So this is one stock which is trying to move up higher. So one can look at Aurobindo Pharma at the current levels, or any correction is a buying opportunity. Stop loss ideally is 1,069, and an upside target is 1,215.
Okay, so that's the view on the individual stock, and we'll circle back, of course, with more to ask you about, of course, because quite a few stocks moving in the broader end as well. Nirav, I'll come to you on the IT pack because Wipro is a disappointment and a half, and the way things are going, Infosys is going to be no different, and it's going to be ahead of an early weekend. So how do you position yourself? Do you now pull the plug on large cap IT if you're holding on, if you're expecting that something might be actually better than what was anticipated?
Good morning and thank you for the invite. I think we've had two heavyweights from the IT sector declare the numbers, TCS and Wipro. And as far as TCS is concerned, it was largely a kind of a very inline set of numbers. There was a slight disappointment on the sequential front. But I think TCS does not give any guidance, so it's very difficult to make out what is there, what they are expecting going forward. But overall, it was a decent quarter as far as TCS is concerned, considering the environment. And I think yesterday Wipro has been a disappointment, especially with respect to the Q1 FY26 guidance which they have given. So I think one needs to be careful. And today we have the numbers from Infosys, so expect kind of an ordinary set of numbers from Infosys. But the winner from all this is going to be HCL Technologies, because we've seen whenever there has been some positive news flows, then HCL Technologies has managed to make the best out of the news flows. So I think we have trimmed our positions in Infosys and TCS, but we have added positions in HCL Technologies. And we are also looking at a few mid-cap names like Coforge and Infosys.
Okay. Okay, do we have Sumit now? He's standing by to tell us about the Morgan Stanley view on Adani Ports, because they, Sumit, seemingly have maintained an overweight on it and they have hiked the target price as well. What's the rationale?
Yes, Adani Ports continues to remain in focus given the fact that Morgan Stanley has come out with this note where they have maintained their overweight rating on the stock. Though there's a marginal increase in the target price, but what is more important here is the fact that the brokerage continues to remain bullish despite the tariff uncertainty. Now, they have hiked the target price to 1,418 from 1,415. Now, Morgan Stanley is saying that Adani Ports has a resilient business model with diversified cargo and geographical mix. In the medium term, they are saying that India is likely to gain the global share of goods export, which bodes well for Adani Ports' cargo business. Now, on the currently announced tariff structure, the Morgan Stanley believes that India compares better to some other larger Asian exporting countries, and at the same time, the leading domestic macro indicators also remain positive, which is also given the fact that it is also positive for Adani Ports. Now, they are seeing limited impact of the tariff given the well-diversified cargo mix, larger share of sticky volumes, and limited direct exposure to the US market. Adani Ports' direct exposure to the US market is less than 5%. As per Morgan Stanley, they also say that the inorganic growth and new capacity addition would offset the impact, if any, it comes on Adani Ports. Moreover, Adani Ports is expanding its integrated business model with continued investment in both port capacity, expansion and logistic value chain. Now, Adani Ports has been continuously gaining market share, and there is strong pricing power and stickier cargo also for Adani Ports, which all in all are quite positive as per Morgan Stanley. And lastly, they believe that the company's strategy to leverage the integrated business model to reduce the EBITDA dependence on the cargo business is quite encouraging, and these are all the broader reasons why Morgan Stanley continues to remain bullish on Adani Ports.
Okay, Morgan Stanley continues to be bullish on Adani Ports. Welcoming Shrikant Chauhan to the conversation this morning, Executive Vice President and Head Equity Research, Kotak Securities. Shrikant, very good morning to you as well. You know, before I get to you on the index view, just a view on Adani Ports.
Good morning, Tamanna. Good morning, Alex and everyone. Yeah, so like for Adani Ports, again, the technical formation is quite bullish. It is showing reversal activity on daily as well as on weekly basis. Even if we consider the overall relative performance of the stock, then it is much better in the Adani group of stocks. And if we consider the immediate targets, then we are expecting stock to move towards 1325, 1350 in the near term. It's a buy at current levels because it is crossing its previous swing high around 1230 to 35. We can keep a stop loss around 1180 for creating positional trade on the stock.
Morning, Shrikant. Let's also get your view on the index as well, right? Because we've seen considerable momentum yesterday at around 130 or so. You saw that spike from lower levels and quite the recovery led by banks. Does that momentum taper off ahead of the long weekend in your opinion, or do we see a sustained momentum, particularly in the banking pack? Of course, IT could be a weak spot today.
No, broadly, I think the markets are showing tremendous strength. Even after opening with a gap of 400, 500 points, it is sustaining above the important levels. That means that there is good amount of short covering, or short covering is consistently happening on a day-to-day basis. Also, if we consider the broader breadth of the market, then except IT, all other indices are participating in the broader trend of the market. Even if we consider the relative performance of the market, I mean to say Nifty 50 with Nifty 500, the Nifty 500 is doing much better. So broadly, I am of the view that the breadth of the market is much better. And that's the reason the strategy should be to buy on dips. I'm expecting markets are moving towards the levels of 24,000 in the near term. And today's maybe weak opening or maybe some sell-off in the first half will be an opportunity to create some long positions in the market. Now, I'm not expecting market to fall below the levels of 23,000 so easily. And even if you consider the broader pattern, I'm to say on long-term basis, on weekly, monthly basis, then since last 2 months, if we see the proper technical structure of the market, then whenever there is a dip in the market, we saw very strong buying interest and market moved to the levels of 23,500. So it indicates that we are again heading higher, and Fin Nifty, which is the index of a broader basket of BFSI, is already above its previous highest level, all-time highest levels. That means that the market is also supporting or maybe responding to the domestic developments. So broadly, I am of the view that we should be a buyer in this market if there is any correction.
So 1,000 points in 3 sessions and another 500 points for the Nifty 50 on the cards. Gentlemen, do stay with us, and viewers, we'll be back on the other side to take you through the pre-open session, of course, and talk about more stocks you should watch out for and trade. Do stay tuned.
India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact, had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth.
Back with India market open right here on NDTV Profit. Flattish start anticipated, much like how we started off yesterday, maybe, or at least supposed to start off yesterday. And then we had a fairly decent outing yesterday. Wonder if the same can happen today. Well, our guests have given their opinion on the index strategy for the day. If I were to nail it down, Shrikant, to specific pockets of strength or weakness, what are the stocks that you are recommending in the session today?
So, Neeraj, yeah, there are like a number of stocks which are doing really well. In fact, this time we are seeing good amount of relative outperformance in most of the capital goods and defense-related stocks. Even the power stocks, they are also like supporting whenever there is a recovery in the market. In that specifically, we like BHEL, which is around 226, 225 levels. It is diverging positively. It is crossing all its important support levels, volume, delivery-based volumes, all are supporting to the overall entire setup of the current formation of the stock. It's a buy at current levels with a stop loss close to 218, and we can keep a target of 240, 245 in the near term. The other stock which we like is Canara Bank, and most of these PSU banks, they are forming a continuation formation on daily basis. PNB has already broken its important resistance at 97.98. Canara Bank is on the verge of crossing its previous immediate resistance level, which was around 94.95. It was very close to those levels yesterday. And based on its formation, I'm expecting stock to move towards 102. So Canara Bank is also a very strong candidate to buy for at current levels with a stop loss at 92.
I wonder if there is a view on PTM. And before I ask Shrikant and Nirav about PTM, let's just tell you what's been happening. So the MD and CEO of the company, Vijay Shekhar Sharma, has voluntarily foregone all 2.1 crore ESOPs that he had in the company. This comes after his status as public shareholder came under SEBI's scanner. Subhana is joining us first to understand why he did this. Now, Subhana, the exchange filing says that this was a voluntary call, but there was a bit of a prod from the regulator, wasn't it?
Yes, definitely. This is because, SEBI had last year issued a show cause notice, to the company saying that, this is prohibited and, he cannot be, these ESOPs cannot be issued, to promoter. And after that, what has happened is that SEBI's scrutiny in the matter around this also increased because there were alleged violations that another proxy firm, Institutional Investor Advisory Services, they had also questioned whether these could be circumvented in the matter by a startup. But we also have to understand that till date, as of March 2025, the shareholding, of Vijay Shekhar Sharma directly, indirectly stands at around over 24% in 197 Communications. This is because he holds directly 9.1% direct stake in the company, and he holds nearly 5% through Access Trustee and also 10.27% through Resilient Asset Management in an agreement with Antfin. But overall, the impact on the company, there doesn't seem like a negative impact so far because the ESOP shares now stands cancelled, and this will actually lower the company's ESOP expenses. So they have said in the exchange filing yesterday that they will take into account in FY24 results. So going forward, also in the coming futures in FY26 and FY27, there will be a lower impact, lower ESOP expenses for the company.
Okay, so that is what has happened, but let's understand implications a little more in detail, and Harsh is joining in to talk about how this will impact the company's accounting. Now we know there's a 400 odd crore hit in the next quarter, Harsh, but down the line that's expected to ease, is that right?
That's absolutely correct. So how this is accounted for is that you'll have 492 crore of expense which will be recognized upfront, which is in Q4 of FY25 itself, as a result of the renunciation of the ESOP rights. Because this is driven by the employee, which is Vijay Shekhar Sharma, therefore you'll have to upfront the cost with regard to the entire cost even over coming years will have to be upfronted in Q4 itself. But what this will do is this will ease the cost burden, as is logical, for the forthcoming periods. So FY25, FY26, you likely see a reversal in terms of the ESOP cost which is recognized in Q4. So that will actually be a positive impact in FY26 onwards. FY25, you will see a larger ESOP expense by 492 crore. ESOP expense in FY24 was a shade shy of 1500 crore. They have given a glide path all the way up to FY27, FY28 to reduce the ESOP expense to sub 250 crore. So you're in any case seeing this reducing trend. Now what will happen is FY25 you'll see a spike up in ESOP, and thereafter you will see the ESOP cost falling.
So this is a bit tricky to look at what the impact is, because there is an immediate impact as well. Nirav, how are you looking at the developments in terms of impact on the stock?
Well, as we discussed, that if there's a provision which has been made in the accounts for any particular expense, in this particular case, the 492 crore impact, and if this provision, of course, will be made, so it impacts the profitability to that extent. But going forward, there's going to be a reversal. So there will be a provision returned back, to the best of my understanding. And so in a way, it will be beneficial in the years to come, because this is a provision which is going to be returned back. So it increases the profitability to that extent.
Shrikant, let's just get a view on the charts on PTM.
Yeah, technically also, if we consider the technical, I'm going to say the short-term as well as medium-term trend of the stock, then it is very clearly indicating us that it is heading higher. It is moving towards the levels of maybe 1,950, which is, we can say, the pullback level for the deep sell-off that the stock has witnessed in the last 5-6 months. So it was around 1,050 levels. From there all the way it went to 650, and now again it is returning back. So the broader formation is indicating us that it is going to surpass its previous level of 1,050. But yes, in the near term, at least we could see the levels of 950. That's a view that we can make out based on its technical information.
Okay, all right. So that's view on PTM. Watch out for it both on the fundamental developments that we've spoken about, what Vijay Shekhar Sharma has done on the ESOPs as well as the technical charts. Let's talk about the big brokerage call of the day, and Kotak has upgraded Cello World to a buy rating with a target price of 710. Harsh is back with us to tell you what they're seeing in that report. Harsh, what are they saying?
Well, significant correction in the stock price that we've seen from the highs. In fact, Kotak had a target price above 800 on this one. They've actually reduced the target price and upgraded the stock because they believe that there is some positive bias and the stock has been beaten more badly than is deserved. So 35% lower is the stock in the last 6 months, and therefore pressure on the stock price. But a 26% upside from here is what Kotak is seeing. Weak growth trends, delay in glass furnace commissioning, and higher discounts have weighed in on margins. You also have new competition coming in with Milton, and likely all of that is playing out on the stock price. But what Kotak has done is they've moderated revenue growth estimates and factored in a margin impact as well. They're estimating a 12% EPS CAGR over FY25 to 27 versus a 16% earlier, and they've cut their 2026 and 27 estimates by around 5 to 6 odd percent, and therefore the target price also they've cut, and they've cut the multiple from 40 times to 37 times, thereby giving it a target price of 710, a 26% upside from here.
Okay, IDFC First Bank is the other one that we need to look at. Let's quickly pull up the stock and we'll try and get our banking editor Vishwanath Nair up. The board has approved a fundraise of up to 7,500 crores from 2 investors. That's Current C and Platinum Invictus. So they've issued CCPS. That's the instrument, compulsorily convertible preference shares, to these 2 investors. That's the exchange filing that they've just put out. So a 7,500 crore rupee fund raise has been announced. So that's interesting because it's IDFC First Bank shoring up the big guns at a time when banks are actually in focus. Needless to say, the pre-open rates that have settled are showing IT being dismal, but banks still in focus. And IDFC first is something that we need to look at. Let's talk about 0.5% down in the pre-open session. Vishwanath Nair joining us for more on this. Vishwanath, put in context the 7,500 crore rupee fundraise approval.
Right. So the current investment is from two separate investors. There's Currency Investments as well as Platinum Invictus, who are both going to purchase compulsorily convertible preference shares from the bank. And then, of course, these will be convertible into full equity shares at a later date. But 7,500 crore as an equity investment is crucial for IDFC First Bank. Remember, for the last 2 or 3 quarters, they've been suffering from the microfinance portfolio and the losses therein. So any kind of confidence capital that comes in for the bank will be a big boost. Of course, the banks, otherwise the rest of the bank's portfolio seems to be doing quite well. The main pain points are the microfinance book. Remember that this money is not likely to cover any losses. This is mostly coming in as a form of confidence in IDFC First. So that's something of an important note here.
Okay, so let's go across very quickly to Latin on this one. Latin, big investors, assuming that they...
Me neither.
Nirav from Latin Mania. Apologies for that, Nirav. So I was focusing more on the development and less on the name, and really apologies for that. Nirav, what do you make of this development? If it does come through, of course, it is expected to come through. 7,500 crore rupees. How do you like IDFC First Bank at this point? It has underperformed on the price front.
Well, as far as the stock price is concerned, it's been a laggard, but I think whatever problems they faced on the microfinance book and now this fundraising, which is there, 7,500 crores, I think it should help them to enhance their capital base and shore up their capital adequacy. So it's a positive development going forward, and hopefully their mobilization of deposits, etc., should also pick up, and the cost of funds should also go down going forward. So all that is likely to have a positive impact on profitability going forward. Hopefully that should be the way going forward.
Okay, Shrikant, how are you feeling about IDFC right now on charts?
See, like after a very long time, the stock has reversed on monthly and quarterly basis. So we may see some more upside in the near term, but I think that will be an opportunity to reduce or to exit out of the long exposure of IDFC First, because I am of the view that now the time is for adding more NBFCs or maybe large banks based on the bond yield or based on the overall performance of the large banks. And like HDFC Bank, ICICI Bank, they are very close to their all-time highs. This stock is still languishing at the lowest level. So it is better if we try to buy these stocks, I mean to say large banks, and there I'm expecting at least a 10 to 15% sort of upside in the very near term.
You know what's looking weak today are steel names. So Tata Steel, JSW Steel, both the large caps are likely starting off weak. Wipro, of course, is a slam dunk, 5% lower at 235. And Angel One is a bit of a slam dunk too, 6.5%. I say a bit of because relatively smaller stock and used to fairly volatile times, but certainly starting off wobbly. Okay, Nirav, does this valuation make Wipro attractive, or you will just keep away from it? Because you gave a long list of names that you like. Wipro is not on that list. Is this 5% downtick valuation attractive or no?
No, I think you would stay away from the stock.
Stay away from the stock.
Yeah.
Okay. Angel One?
Not at the moment.
Okay.
We thought Anand Rathi Wealth delivered a better set of numbers.
Yeah, but I mean, slightly distinct businesses. So, Nirav, if you say not at the moment for Angel One, what will make you buy Angel One, or would you just stay away for the time being?
Stay away for the time being.
Okay. Steel names starting off week. Shrikant, before we get in your top idea, what about some of the steel stocks? Tata Steel, JSW Steel. Is there something that you want to give as a trading idea here?
Yeah, I think so. Like in this particular space, we like JSW Steel, which is around 995,000 levels. Tata Steel, it is better to stay away because the stock is forming lower top, lower bottom series. Steel Authority is always like remains under the influence of the news flow from the government. So it is better to stay away from Tata Steel as well as Steel Authority. But yes, of course, we need to focus more and more on Jindal Steel and Power as well as JSW Steel. Both are like participating whenever there is a uptick in the metal space. So we like both these stocks and we are expecting at least 10 to 15% sort of upside based on their technical formation.
What is your top idea for the day today based on pre-open rates?
Yeah, I think we should look for adding again large cap banks only because they're the only strength. We are expecting ICICI Bank to do well. Currently, it is around some 1350, 1360 sort of levels. And if we consider the technical pattern, then it is heading for the levels of 1450. That's the view. And it is very close to its all-time highest level. So if there is any correction, look for adding positions. 1450 should be the next target to watch out for.
1450 is the target for ICICI Bank. Okay, very quickly, Shrikant, any call on Vari before we hit the first rates coming in? The numbers looked good. Pre-open has treated it well. What would you do?
No, I have not seen the technical pattern of the stock. I'm extremely sorry.
Okay, no problem, no problem. We'll come back to you after the opening. It's 6.5% up. Are we going to have an interesting Thursday morning? I reckon we are. We might have a bit of a soft start, which is what it's showing. About 60 points down, indicating on the Nifty, which is all right. That's what was expected. But do we stay on is the question. 23,300 is an important level to look at. Nifty IT is going to be the one really getting hammered today, and Wipro numbers have not helped. Infosys coming out, TCS wasn't great. So that's the picture over there. The mid cap and small cap also in the red as we speak. Bank Nifty is the only one in the green. This has been a consistent pattern that we have been seeing last few trading sessions. It's the banks that are holding the flag up high. Let me pull up the heat map very quickly on the Nifty to tell you what is moving in terms of the large cap. I mean, Wipro here at 5% down is something that we should not be surprised with at all. I'm a little surprised seeing Hero Motor there though, but HCL Tech, Infosys, TCS, the entire IT pack seeing a bit of pain. Tata Steel as well seeing a bit of pain. On the winning side, ICICI Bank takes the lead after HDFC Bank has been leading the Nifty for the last couple of days. That's taking a breather. ICICI Bank is up there. Adani Ports on that MS downgrade. Upgrade is also working out in the top line. Dr. Reddy's, Bharti are some of the winners there, but more red than green on the screen today. So you are going to have a bit of a sticky start. Expect volumes also to be low. And Alex, as we look at the broader markets, maybe some action there, but volumes are expected to be low ahead of a long weekend.
Yeah, individual names. Interestingly, mid-cap index has moved into the green. Let's look at the small-cap index also, just to see if some of the breadth is improving. It's just about flat at this juncture. So let's very quickly pull up the sectoral heat map to see what's what, and you will likely see more red on the screen. Okay, so that's changed. It's half and half as things stand right now. Up on top, if I'm not mistaken, we have been talking about defense stocks rallying in the recent past, and that continues to be the case. 0.6%. The Pharma index up in about 0.5% gains. No very big movers. Of course, right on the bottom you have IT that is losing ground, and right there it's the worst performer by far and away. We will talk about some of those stocks, but first let's talk about a few winners. Worry Renewables. The stock is in focus, of course, because the profits have risen as much as 82%, and several factors in the EPC business doing well for the company. It is, in fact, building on those gains and gaining as much as 12% in trade today. You have, in fact, Angel One that is declining at this juncture, and it is down as much as 4.4%. It has recovered from the low point of the day though. DLF, this was a simple update, and of course 690 odd crores, not a small amount, but it's gaining about 1% or so. Also in the real estate pack, we'll talk about one more later, but first let's talk about Glenmark Pharma. It's launching a new drug. The equivalent of that drug in the US has a market value or potential of over $400 million. So certainly something that is positive for this particular company. It's up about 1% or so. LTIM, persistent go forwards. The only reason I've asked to pull this up is because the texture and the expectations are really impacted because of the earnings that you've seen by the IT heavyweights so far. Infosys is likely going to be a similar picture, and so you are seeing tremendous weakness across the board, particularly for something like an LTI Mindtree, which is down about 3.5% at this point. Also, an underperformer today in all probability is going to be Puravankara. It didn't move down very much, and it is down only about 0.6%, but it was a bit of a disappointment when it comes to the pre-sales numbers, and those really are focused on by the street as well. Of course, some part of that on account of a delay in approvals, and you could see some traction come back in the first quarter, but we'll have to wait and watch to see how things pan out. But all told, of course, there are individual names to focus on. Neeraj, I'm just wondering if you're seeing any breath of fresh air from the broader markets.
Vari Renewable, not Vari, the one which reported the numbers, which might also be doing well, but Vari Renewable is the one that we should focus on. I believe this should be a stock split or a bonus, either of the two. But look at that. No. The earnings impact is not on Vari Renewables. Let's just, or it is Vari Renewable, sorry. But Vari Energies is the other one that we should try and pull up as well. Vari Renewables is up 13%. Vari Energies should come up on your screen as well. That stock is up about 5% at 2352. So that's the other one. Excuse me for the confusion. KFin Tech, wonder if that stock is reacting to the overseas acquisition. Jefferies has a buy with a target price of 1310. Yes, indeed, up about 3% in trade. Interglobe Aviation, HSBC has hiked the target price, so keep an eye out for that one, but flat currently. Aditya Birla Fashion, Morgan Stanley has upgraded the stock to an equal weight rating with the target price of 269. Wonder if that is reacting. No, not really. Now to stocks which might be moving around independent of the news. So TTK Healthcare, I believe, is having a sharp up move. Is it? Should pull up? No, not really. So the BSE rate slightly different, but maybe stocks like Subros, etc. might be doing well. So a clutch of names out there, trying to think what is it that is standing out. Shrikant, I want to start off with a view on IT stocks simply because Nifty IT is the worst performing index, down about 2%, led down no doubt by Wipro, I presume, but also some others. Is there a short trade in any of the IT names, Shrikant? Shrikant, you're on mute, I think.
See, the medium as well as short-term pattern of all these stocks are clearly indicating us that we are going to see further more weakness. But at the same time, all these stocks are very close to their important support levels. And now it completely depends upon the results. So most of these stocks are like going to announce their quarterly numbers, and we are expecting weak numbers only. But yes, even at current levels, I am of the view that it is better to exit out of Wipro because there I am expecting further more weakness. First target is 225, but in the worst case scenario, we may even see the levels of 200. So it is better if we try to exit or maybe create some short positions on Wipro even at current levels.
Okay, just a couple of more stocks that I want to talk about very quickly. There's a Morgan Stanley downgrade on Tata Steel, Coal India, JSPL, JSW Steel. At least they maintained an underweight on sale, which is why you're seeing pain in each of these. Let me just pull that up for you. Tata Steel, Morgan Stanley, this is an overview they have on metals, and that's why the pain there. They have downgraded to underweight from equal weight and cut the target price to 125 from 160. On Coal India, they've downgraded to equal weight from overweight and cut the target price to 450 from 525. So a bit of pain there as well. And JSPL, they have downgraded to equal weight from overweight and cut the target price quite steeply actually from 1200 to 900 on JSPL. And JSW Steel has seen a downgrade to equal weight from overweight, target price cut to 1000 rupees from 1150. Sale, they've maintained underweight, but target price has been cut from 115 to 90 rupees. So you're seeing some pain in these spaces as well. Just a quick view from you, Nirav, on the metals pack.
Well, I think there could be certain apprehensions on account of the fact that there could be a dumping from China, and I think that could be the main concern as far as the metal stocks are concerned. And at the same time, we've seen a lot of brokerage reports coming in which hint that they've reduced the GDP forecast for the economy. So if the GDP forecast is revised downwards, naturally it would impact the demand for the core materials like metals or cement, etc. So I think that could have prompted this downgrade at this point of time.
Let me take you through what they're saying. They're saying that they downgrade steel and coal and they prefer cement because of tariff-related uncertainty that has boosted global growth concerns, and this will weigh on global commodities demand. They see this is important, I thought, downside risk to steel prices even if government introduces safeguard duty of as high as 12 to 15%. So that's where the concern is. Shrikant, any views on the stocks that I've talked about on charts?
Yeah, I think from the steel basket, we specifically like Jindal Steel and Power as well as JSW Steel based on their technical formation. And it is better to stay away from Tata Steel as well as Steel Authority. Both are forming a bearish formation on daily and weekly basis. Whenever there is a rally in the stock, we are seeing good amount of selling pressure in SAIL as well as Tata Steel. Yes, but we need to focus on other stocks from the metal basket like Hindalco, Vedanta. They are available at quite attractive level, and this space is going to remain highly volatile for next maybe few months. So they will offer a lot of trading opportunities as well as investment opportunities for positional traders to take some position whenever there is a fall in the stock. So we like Vedanta. In case if it falls to 380, it's a best buy. We also like Hindalco. It is around some 605, 606, but between this 610 and 590, it's a very strong candidate to buy and hold for.
Just pull up Sonata Software because we were looking at the screen. It's one of the worst performers for the broader markets. It's down about 9% or so, and it's plumbing lower levels as we speak. And this is because of a notification that was sent to the exchanges very late last night, in fact, very close to midnight, where they're saying it's a very short statement that they're making. They're saying, with reference to the caption subject, we would like to inform you that the revenue estimates for Q4 FY25 from our largest client are likely to be lower than anticipated, resulting in lower revenue from our international business for the said quarter than previously envisioned during the investor meet that was held on the 6th of February, so not too long back. And so we're unaware of the implications or the gravity of the impact. But Nirav, on the fundamentals, Sonata Software, were you building in something that you will have to review now that they've come out with this refreshed guidance?
Well, we had a very strong set of numbers. So it's been a good performer as far as the numbers are concerned. Very consistent results, good quality margins from Sonata Software. So I think this note which has come in could be a kind of a prompt. It could prompt a correction in the stock. So I think we have to see the extent of the correction and then decide whether we want to make a buy decision in the stock or not. But I think we'll have to study it in detail.
Okay. What else? There is some strength in Fusion Microfinance. Now, rights issue on offer, the grapevine is that a lot of smart money is put in some capital here too. So certainly a bucket to watch out for. Nirav Ashar, are microfinance companies looking okay? There are people who are betting on the turn of a cycle out there, and at the valuations that they're available at, they might not be too expensive. So that's the optimism theory. I wonder if you're optimistic there or you're still pessimistic.
We are not very optimistic at this point of time. It's quite possible that the cycle may turn in the near future, but I think we are more focused on NBFCs at this point of time.
What within that list, Nirav?
I think we like especially Bajaj Finance and Cholamandalam Investment Holdings, L&T Finance. These are our preferred picks in the NBFC space.
Shrikant, anything out there within the NBFC bucket? Some of them are active today.
Yeah, I think as Nirav said, yes, we are also like specifically bullish on Bajaj Finance, Shriram Finance, Cholamandalam Finance, but also we need to focus more on power finance related companies. And there also I'm expecting further more activities, stocks like PFC, REC. I think they should do well. And they are forming some bottoming sort of formation on daily and weekly basis. So also we are expecting further more rate cut in the near future. So that will actually help these power finance companies. And in fact, Neeraj, if you just go through with this particular energy and power sector, most of these stocks are reversing and relatively doing much better than other indices. Means the overall formation of these stocks showing much more constructive sort of activity. So I am specifically bullish on all these power finance related stocks and even maybe energy renewable stocks. There we need to focus for next few days. If there is any correction, they will give a best buying opportunity and investment opportunity for the medium term.
Okay, we're seeing an okay kind of a start in the markets today. Let's just review what we've seen in the first 15 minutes of trade. And a little deepening of the pain, especially on IT, 2.5% down. So that's one to watch out for. What I'm finding interesting is how 361 is doing for a second day in a row. And I don't know, Shrikant, if this is a stock that you're tracking. Even as we've talked about Anand Rathi and we've talked about Angel in view of their updates, etc., the capital market sort of space, are you liking a 361?
Yeah, I think so. Like there also if there is a medium to long term view, then certainly we should look for adding them during this particular scenario of the market where we are seeing some result announcements from them, and based on there is a specific response in the market. But broadly, I am of the view that these are the stocks which have already fallen to their extreme levels. Now we have to just find out that which one is relatively doing much better. But yes, 361 has also formed its bottom somewhere close to 850 levels. And based on its technical formation, I'm expecting stock to move towards 1150 or maybe 1200 in next few months. So it will take time, 3 to 6 months. But it is based on technical formation, I can say that it is trying to retrace its recent sell-off that we witnessed from the levels of 1300 to almost 800. So it is into pullback mode, and we should look for adding even at current levels and more on dips.
Okay, we'll leave it at that. Nirav as well as Shrikant, thank you so much, gentlemen, for taking the time out. Have a good weekend ahead. And somebody who's having a good week or a good day is Rivalry Renewable. They had a good quarter, in fact, because they posted about an 83% rise in the consolidated net profit numbers. Mihika Johnson with the highlights of the quarter first.
Yes, so it's been a good quarter for Rivalry Renewables, and the street also seems to think so. Stock up over 10% today. The earnings were aided by a 76% higher EPC sales on an annual basis, and this led to a revenue uptick of 74.4% to 477 crores in Q4. We've also seen a strong EBITDA uptick of 67.8% on a year-on-year basis to 126 crores. A slight margin downtick of 100 basis points because of higher EPC contract, employee and other costs. However, net profit was up 82% on an annual basis in Q4. In terms of your order book, we have seen a 38% growth on an annual basis. Now the order book stands at over 3.2 gigawatts. So now the key things that we need to understand is how does the margin go from here? What's the new guidance for FY26, as well as how the execution will take place. Earlier, it was stated between 3 to 3.5 gigawatts for FY26 by the company itself. Whether this is maintained or could we see more?
Well, let's try and pose some of those questions to Abhishek Parikh, Group Head of Finance at Rivalry Renewable Technologies, joins us right now on the show. Abhishek, good having you. Thank you so much for taking the time out. And at the outset, congratulations on a very good set of numbers. Is this something that you guys had penciled in at the start of the quarter and for the year as well? Is this something that you had penciled in, or has it turned out to be slightly better than what you had thought of?
First of all, thank you very much for having me on the show.
Sure.
Good morning. So, as you rightly said that, at start of the year, when we were talking about our last year's performances, we have given a broad guidance that this year, since our order book was somewhere close to 2 odd gigawatt at start of this year, we were expecting the execution around 1.5 gigawatt
odd worth of execution, and which we have. I'm very happy to share with you that we have actually completed the installations. And as we speak today, I'm very happy to share again that our order book stands strong at 3.2 gigawatt, which needs to be completed over next 12 to 15 months of time, which means by start of this year itself, we have a longer horizon in terms of execution capabilities as well as execution runway.
Okay, so Abhishek, okay, so before we get, okay, we'll come to the guidance as well in a moment. I would love to talk about that too. But as I look at the current order book that you have and the execution that you have, your operational metrics seem to be stabilizing at about 26.5% or in that range. Would you reckon that with the higher execution, you'll be able to maintain or improve upon the operational metrics and the margins? Or could there be challenges there considering that supply chains might be getting disrupted?
So, rightly pointed out again, I would rather say because at higher level of execution, when we move higher in terms of our execution year on year, our ability to deal with supply chain gets better off. So last year when we did somewhere around 700 megawatt of execution in FY24 against 1.5 gigawatt worth of installations this year, we have seen the advantage of economies of scale coming to our favor. And we believe that this should continue with the further executions year on year.
Abhishek, very good morning to you. Tamanna here. Just trying to understand about your unexecuted order book, which has grown 38% year on year. And of course, that would be a function of the growth of the order book as well. But if you can give us some details on this, and do you expect this number to come down over time? Are you building capacity to, look at the flow of order book?
So order book, if you look at broadly, we have two set of customers. One is your large scale utility segment. Another is the C&I segment, which is broadly a rooftop market. And we consistently, work on both these segments. We also work some bit with the PSU segment, which accounts for 10-15% of our overall revenue. But we believe that the healthy mix of utility scale of projects along with C&I scale of projects should continue from here. As far as capacity building is concerned, when we started the year, we were looking at order book of around 2 odd gigawatts, which by end of this year we are almost at the completion stage. And we have worked a lot on our manpower, our execution capabilities, our design team, our construction team, our procurement team have significantly increased. So for an EPC company like us, the capacity building really means addition of talent and manpower, which we have been doing consistently. And we believe this should continue.
Yeah, and of course, and which is why we saw that a little bit of a hit in margins, because employee costs and talent costs need to go up. Just trying to understand if there's more to come on that front, and where do you pencil that in?
So employee cost and other costs have increased a little bit this year, but compared to the growth of revenue, which is around 80% plus, versus the incremental employee cost, which is roughly around 50% odd, we see the advantage and the fillip of incremental revenue, coming to our favor, and we believe this should continue from here.
Got it. Abhishek, what is so 3.2 gigs or 3.2 gigawatts of order book roughly currently, right? What is the execution timeline for the same, and is there a ballpark estimate of what's the kind of order inflow that could come in for the financial year 26?
So 3.2 gigawatt roughly in terms of revenue would at the run rate of 1.1 crore to 1.2 crore per gigawatt per megawatt would convert into somewhere around 3,500 to 4,000 crore worth of minimum revenue at this point in time. But as we move ahead, we also have a large pool of talent for the business development and sales team, and every quarter we have been building our order book as well. Like last quarter itself, we have seen one of the biggest orders coming up, and especially in the second half of this year, we have seen our order book building as good as 2.5 gigawatt worth of order. Especially in that, I would again mention that we got a single largest order of 2 gigawatt at a single location, which probably is one of the largest order by any solar EPC company at this moment.
But
so we believe our team continue to work at ground level very hard and help us getting ordered the same way we have been getting until now.
Okay. So therefore, can I get some numbers? So thank you for giving out the actual. What I meant was the 3.2 gigawatt execution, is it spread over 12 months, 18 months, 24 months? Is there a timeline for that?
Yeah, so the timeline for this order book is between 12 to 15 months of time.
12 to 15 months. Okay. Yeah. Okay, that is one. And part two, is there some estimate of what's the kind of additional inflow that will come in FY26? I know you mentioned that you guys are trying hard. It may be difficult, but there will be some ballpark estimate that you have about the kind of order inflows that will come in. 1.1 gigawatt, 1.2 gigawatt, 1.5 gigawatt. What's the number?
So I may not be able to give you any forward-looking number, but what I can help you with is our current order pipeline, the total bidding pipeline, which we call for our EPC revenue, is around 30 odd gigawatts, which last year was somewhere around 20 odd gigawatts. So at 30 gigawatt of order book, we believe, we have a reasonable pie to look at, because we have been consistently maintaining our market share also. And year on year, our pipeline increases, and we have seen the impact coming into our order book as well. So difficult to give an exact number, but I can tell you our order pipeline and our overall bidding pipeline has increased significantly in last 12 odd months.
Mr. Parekh, just trying to understand, what is your export contribution to revenue and what is your exposure? Just trying to get a sense of what is your exposure to the global tariff situation right now?
So as of now, we are pretty focusing on domestic market. In fact, I would rather say roughly around 100% would be contributed by domestic market alone. And we remain watchful of global situation and geopolitics which is happening around. But we also keep hunting out any opportunity which comes our way, be in India, be it outside of India.
So in terms of imports or costs going up of imports, is that a concern for key components?
So year on year, we have been focusing on localization of our entire supply chain. And if you look at our import numbers, we have seen a consistent decline in the overall import that we do. Because we believe that to look at larger execution, India as a market itself in next 5 years is expected to install at least 180 to 200 gigawatt of solar by 2030 as per government's target. Currently, we are standing at around 110 odd gigawatt worth of solar installations already done, and we have runway of around 170 to 180 gigawatt of additional solar power. And this much of scale you cannot achieve basis the import dependence, and we have been consistently working on domestic procurement only. Okay. And we believe that this should continue.
What is the extent of localization right now in your supply chain, and what is the extent of imports?
I would rather say around 90% would be domestic overall supply chain.
But are there key components being imported and from China, etc.? Just kind of trying to get a sense of the exposure or the concerns there.
So first thing that we did last year was, because we foresee many things which were already around the geopolitics. So we focused first on getting localization of our key components, which included solar panels, which included other equipment like inverters, transformers, and all of that. So fortunately, we are in a very safe zone, I would rather say, as far as imports are concerned.
Got it. Abhishek, one final question, and that is on the O&M market. Now, a lot of wind energy EPC players are choosing to bid only for contracts wherein they also get an O&M attached to it. You may or may not be doing that, but I wonder what's the strategy ahead to expand the O&M market for yourself from where it is right now, and is that margin accretive?
Certainly. In fact, our current execution of O&M is around 680 megawatt worth of O&M that we do. But in our existing order book also, we have an optionality that we can also bid for the O&M of these projects. So line 3 gigawatt of current order book of EPC would also give us an opportunity to look at the similar amount of O&M opportunities as well. And this is an annuity business. So if you get an order of, let's say, O&M for a solar power project, the contract ranges from at least 5 years to 10 years of all kind of horizon. And that's why it's always I would say icing on the cherry or the icing.
For sure. So independent of your own thing, are you also doing third-party O&M on projects that you've not executed? And what's the size of O&M for you right now versus what you target it to be? That's essentially my key question.
So yes, we are very focused. In fact, we have also tried to get an internal specialized team for our O&M segment. If you see our O&M numbers last year versus this year, we have seen around 30 to 40% growth in the O&M revenue. But key here is the larger the EPC execution order pipeline, the larger is opportunity for O&M. So we would really want to get the maximum share in the existing 3 gigawatt of order book to get this converted into O&M order book also.
All right. Thank you so much, Abhishek, for speaking with us. Vari in focus after a solid set of numbers. The margin outlook also improving. We saw a bit of a squeeze this time round because of higher costs coming up, but the order book pipeline is what is truly robust. All right, now let's turn our focus to what's happening in banking, and very interested and excited about the next conversation we're having. The RBI cut its repo rates by 25 basis points last week. Banks have started following suit largely, but what is the impact that we're going to see on margins? We're speaking with State Bank of India up next. Ashwini Kumar Tiwari will join us, MD of State Bank of India, but a quick setup first with Harsh.
Well, so yes, not only has the RBI cut, we've started seeing banks also start cutting their deposit rates. Now, as part of this rate cutting cycle, typically there's a lead and lag, which is that deposit rates generally lag. Loan rates first come off, and thereafter deposit rates start to get cut and start to get priced in. We're starting to see a very, very swift transmission of rates start to happen on the deposit side of things, and therefore would be curious to know as to how margins will evolve. Will margins largely be protected at least over the next 2 to 3 quarters, or relatively also will margins be better off than what the street has penciled in? So that's the one piece that I'd be keen to know. Also, in terms of how the capex cycle is turning, that's the other interesting piece. And of course, who better to understand this than the management of SBI themselves?
Absolutely. Thank you for that, Harsh. And let me welcome Mr. Ashwini Kumar Tiwari to our conversation. He's Managing Director at State Bank of India. Mr. Tiwari, pleasure speaking with you here on NDTV Profit. Let's first get your overview. Some of these cuts have already been passed on by all major banks, including State Bank of India. You've announced a slight cut in deposit rates. What's the impact that you see going forward?
So as your anchor was saying, first of all, good morning. But the impact is that as deposit rates are cut, the repricing of all deposits, which are legacy deposits, will take some time to pencil in, because as they mature and are redeposited, the rates will kick in. Whereas for loans, especially those linked to repo rate and external benchmark, this rate cut has immediately happened. So therefore, there is always an immediate pressure on margins to begin with, and over time it stabilizes. That's what's happening to us also.
Okay, so in the time lag, that's how you see the transmission pan out. Do you see the transmission being paired out over existing loans as well, and by when?
So existing loans, as I mentioned, those which are linked to the external benchmark, which is repo rate, has immediately happened. We also announced on 15th of April, external benchmark rate cut of 25 basis points, which is the RBI's reduction. So that has already happened. Now, in case of deposits, as I mentioned, the rate cut which has happened is applicable to new deposits. Older deposits will continue at the contracted rate, and as they mature and are brought again for depositing again, that is the time the reduced rate will kick in. So therefore, there will always be a lag in case of rate cut in terms of the deposit rates getting priced in, and therefore there will be some initial pressure on margins.
Sure. What is the extent of pressure that you expect on margins? And of course, on the other hand, cost of funds will also come down.
Yeah, cost of funds is going to come down. As I said, the deposits, rate cuts for existing deposits will only happen when they mature. Yes. So therefore, the cost of funds will reduce over a period of time, not immediately. And on margins, we are still estimating, and I really can't give any numbers because we are in the silent period. As of now, the results are due. So therefore, what is the impact, I can't say at this point of time.
Mr. Tiwari, good morning, Neeraj here. Just trying to hypothesize that if indeed further rate cuts are a given over the course of the next 2 or 3 policies, would it be suffice to say that for the intermediate period, yes, it's a fleeting pressure on margins, but it may stay for the period that the rate cut cycle is on?
Yeah, till the rate cut cycle is on, I mean, this, as I mentioned, this current rate cut, passes into the deposits and legacy deposits over a period of time. And if there are any future ones, they will still drag this pricing in even further. So to the extent that the rate cut cycle continues, the lag in terms of deposit rates passing on will continue to happen.
Point well noted. Yeah, I mean, you mentioned that, just wanted to get that summary. Okay, great. Now, the second question is, sir, the belief is that as the globe melts, if you will, in terms of growth, all that can be done to help the Indian corporate and the borrow should be done and is being done. Would you believe that this set of rate cuts would spur borrowing, whether on the capex side or on the consumption side, but predominantly the capex side? Because except for the government capex, the private capex has largely been amiss.
So if you, I mean, I would not use the word amiss, it's a very strong word. Okay. I would say that it is less as compared to the government capex for sure. And what we are seeing, because we are a leading player in the project finance space, what we are seeing is that there is enough pipeline in certain sectors. Okay. But in other sectors, you are right. There was some initial deleveraging which happened, for example, sectors like steel, and other sectors, some consolidation is happening, but fresh capacity creation is not as much as it is expected. Especially considering that the RBI's figure for long-term capacity utilization is over 75%, which is when it is expected that fresh capex will take place in a wider sense. So therefore, yes, private capex is lagging the government capex. But the rate cuts, they help bring down the cost for everyone, including the retail borrowers as also the corporate borrowers. But that's not a sufficient trigger for capacity creation, because that depends on the demand, expected demand, that depends on other conditions. So therefore, it's not a full reason for people to go in for capex.
Agree completely, sir, and which is why I'm asking you, because it's a necessary condition, not a sufficient one. Demand is the sufficient condition, right? We don't have the inklings of demand as yet. So therefore, I'm asking the person who is at the helm of affairs in terms of lending, that are corporates starting to talk about borrowing in order to fund capex? Because one part of the equation, which is that the rates are starting to come off, and there is, I presume, decent liquidity relative to 6 months ago. So are the sectors which were not doing capex thus far starting to at least talk about this? The other aspect of this is also, of course, corporate balance sheets are fairly healthy, and the ability to borrow or fund is also not difficult.
Yeah, so corporates' ability to borrow has been really good in the last couple of years. Many of the bigger ones have deleveraged, as I mentioned. So therefore, lending capacity is not a constraint. And yes, many of them have been in conversation. Many projects are also under advanced stages, assessment or sanctions and all. That is all happening. So for us, actually, we have a full pipeline. We don't have a challenge on any of this. But in conversations, yes, conversations are already happening. What is coming in the way is the little bit of uncertainty which got created recently, and therefore people are examining what might be the impact in terms of tariffs or cost, how much to be passed on. So that probably may have a little bit of a pause for the moment. But those who are already into the expansion, I don't think they're going to stop it just because of this, and everybody hopes it will settle down sooner than later.
That's exactly my next question, Mr. Tiwari. What is the thinking to prepare for any fallout of a global tariff war, impact on export-facing companies, impact on companies where their costs go up? Is there a review on right now on the kind of impact you may see even on your book?
So this is a continuous process. This event like this has to be examined by us in consultation with our clients, which is what we are doing, looking at those who are more exposed. As of now, as we understand, the duty is just 10%, and whether a higher duty will apply going forward, our hope is that the BTA, the bilateral trade agreement, will get signed, and therefore there will be a certainty. So more than the amount of duty, it is the uncertainty around it that is the challenge. range. And we are therefore examining with our corporates those who are more exposed and are in conversation with them in terms of what support they might need. But for the time being, it is more of the analysis and hoping that whatever the tariff ultimately settles down will be a stable tariff rather than an unpredictable tariff, which is the case right now.
I just ask you a follow-up on that, on some of those conversations you mentioned. Have those conversations now begun with clients on what support that they may need, and what is the kind of ask coming in?
So nobody is asking for any lending support in terms of tariffs and all. That's not needed. What probably may be needed is, and this is very early actually, so we haven't actually analyzed the whole thing. And as you know, since we really don't know the final rate of duty, it's still a little premature to take any action. We are in touch and we are getting the information from those who are more exposed as to how they see it and what should be their strategy. And our strategy will be just to align with the strategy and give them whatever support is needed. So nothing concrete at this point of time beyond analysis and beyond conversations.
Mr. Tiwari, a fair degree of chatter over the last 12 months on the stress at the lower end of the food chain, if you will, and the marginal borrower being stressed, and it was showing in the MFI results thus far. People are talking about the turn of that MFI book for pure play MFI players as well as for banks having microfinance exposure. What is your view on this particular aspect?
So MFI, as a bank, we don't have too much exposure to MFIs. Whatever we have is to really good quality MFIs. And therefore, with them, we did see a little bit of increase in the NPAs last year, but it's now trending down. And our conversation with them tells us that they say that they have turned the corner, and this is now coming down. So therefore, that cycle seems to have passed. And in any case, we were not exposed too much. So as you have seen in Q3 also, we did not see any uptick in our NPAs into this segment overall, or the overall NPA as well.
But yeah, and therefore maybe not just from an impact on SBI perspective, but I did hear you say that it seems that the cycle is past. You do believe that the MF cycle could be turning for the better?
Yeah, that's what our conversations, as I said, we don't have too much direct exposure. So what we are doing is to have conversations with the leading MFI players, our customers, even otherwise, because we generally keep talking to various industry leaders to understand as to what their sense is on this. And this is what they are all telling, that the cycle has turned and this is broadly under control now.
All right. Thank you so much, Mr. Tiwari, for speaking with us and giving us a sense. And this is why banks are becoming a safe haven for investors as well, because solid domestic facing businesses like banks, which and especially large banks like State Bank of India, which are going to be holding on to the economic growth of India, is what the focus is. Let's talk about 0.5% up. Actually, it's banks that are working out today more than anything else. We'll take a very short break. On the other side, we talk about all the buzzing stocks at this hour. We also have a great conversation lined up with Aditya Khemka, fund manager at InCred Asset Management. Stay tuned for all that and more.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my.
Back with India market open. Just wanted to mark a couple of pockets. Fusion Microfinance is up 10%. We were talking about the microfinance book with SBI. Look at what's happening to Fusion today. It's up 9.5% or 10% as we speak. Volumes in Fusion in the first 30 minutes are higher than the last 1 month average. That's the extent of optimism in this one. Rights issue over, a lot of smart money I hear has put money in that rights issue for Fusion Micro. Are we looking at the turn of the cycle for MFIs? It will be true. I mean, it will be a rising tide that could carry all boats along with it, but watch out for Fusion. Anyways, another one, not such a pleasant note that is coming in is from Morgan Stanley on major consumer discretionary players. Mahima Johnson with the highlights of some cuts and some rating maintenance, if you will, that Morgan Stanley seems to have done. Mahima, good morning.
Good morning. So I'll start with stock-specific action that they've, changed the ratings for. Vedant Fashion, they've downgraded it to equal weight from overweight and cut the target price to 850. For Aditya Birla Fashion, they've upgraded it to equal weight from underweight and cut the target price to 269. For Trent, they've maintained overweight but cut the target price to 6359. For Brainbees, that is First Cry, they've maintained overweight but cut the target price to 574. Now, they've given a couple of reasons as to why they've done this. Firstly, they believe that discretionary landscape remains largely localized from both sourcing as well as end market point of view. They continue to back businesses with moats as well as disruptors, and self-help stories will work from now on. They do not think that market will buy on broad brush basis anymore. Multiple compressions is likely on the cards where medium-term growth outlook is concerned. In terms of market leaders that are able to defend their turf, they are bullish on Titan as well as Vishal Mega Mart. For disruptors and self-help stories, they like something like a Trent and Jubilant Foodworks. And in terms of Aditya Birla Fashion, they're saying that jury is still out whether the company will be able to execute its ambitious growth agenda, and they think that downside risk is limited and risk reward right now is in a balanced position. Lastly, in terms of Vedant Fashion, they continue to believe that the category has a runway of growth, but growth might also come at the cost of EBITDA margin. So this is the overall view of what Morgan Stanley believes will happen in the consumer discretionary space going forward.
Stay on with us, Mahima, because interesting note out today from HSBC as well on travel and hotels. They've been highlighting the sector's exceptional growth while maintaining a buy call on several counters. Give us more details.
Right. So here also I'll start with the stock specific action first. For Indigo, they've maintained buy and hiked the target price to 5975, and this is from 4940. So a significant jump for Indigo in terms of hiking the target price. For SpiceJet, they've maintained, reduced and cut the target price to 25.1. For Indian Hotels, they've maintained buy and hiked the target price to 944 from 845. What they believe is the travel and hotel sector continues to enjoy exceptionally strong trading. Q4 will be supported by Mahakumbh sales as well as a tight supply. In terms of looking beyond Q4, they believe that there are no major headwinds for hotels, but overall for airlines, will face cost pressure, but lower oil prices and strong yields could offset the kind of cost pressure that they're facing so far. So this is the overall view as to what makes them bullish on some of these airlines as well as hotel counters.
Right. Thanks a lot for that, Mahima. Now, Morgan Stanley scores, remember, also cut target prices for major players from the metal sector, and that those stocks are reacting as well, at least reacted in the morning. But what's the rationale there? Mihika Johnson with more on this report. Mihika.
So Morgan Stanley has downgraded the ratings of 3 of the 4 metal counters that it currently tracks. Tata Steel, JSPL, JSW Steel, all of the ratings from an equal weight earlier have been downgraded to an underweight. In terms of sale, it's maintained at underweight. Now the new target prices for Tata Steel indicate an 8.8% potential downside. JSPL has a 5.4% potential upside, while SAIL has a 21% potential downside from the previous closing prices. In terms of why MS is downgrading steel, the tariff-related uncertainty has boosted global growth concerns, and this could weigh on global commodities demand as per the brokerage, and they do see a downside risk to steel prices even if the government implements a safeguard duty of 12 to 15%. On Coal India, it has downgraded the stocks rating to an equal weight from an overweight. The target price has been cut to 450 rupees from 525 rupees previously. In terms of why they are downgrading Coal India, well, slow growth in India could affect the company's volumes, and weak global prices could affect the e-auction prices. Lastly, in terms of what does Morgan Stanley prefer, the brokerage does prefer cement because it expects domestic commodities to do better versus global.
Okay. Mihika, thank you for that. Now, the other story that we're focusing on this morning, an important one, is what's happening with PTM. Let's just quickly pull up the PTM stock. So, announcement yesterday that Vijay Shekhar Sharma, the MD and CEO, has foregone all 2.1 crore ESOPs in the company. Why has he done this? How is the street looking at it? Let's go across to Harsh for more.
Well, yes, let's first look at the announcement itself. It's a large amount of ESOPs which VSS had, and he's foregone all of them, 2.1 crore, valued at roughly 2,000 odd crore, nearly there. So point being that ESOPs are therefore cancelled, and this is actually a voluntary foregoing of ESOPs, and therefore the ESOP expense will have to be recognized upfront. So your 492 crore of ESOP expense will be recognized in Q4 of FY25. This is for the balance period when the ESOPs will vest. All of that expense, which ought to be apportioned over FY25, maybe a little bit, but FY26, FY27 predominantly, is going to be upfronted. It's a non-cash expense, so from a P&L perspective, you will have a large expense in Q4 of FY25, and thereafter you will have a slightly lower ESOP expenditure in FY26 and FY27. But from a cash flow perspective, it's a non-cash expense, and therefore no impact on cash flow whatsoever. So that is from P&L, and 2, from a cash flow perspective. From balance sheet perspective, extremely favorable, right? What you will likely see, therefore, is a lower equity base, lesser dilution happening, and therefore that is positive from an equity dilution perspective on the balance sheet. So your EPS will likely get a bump up in FY26, and a significant bump up because 1, your ESOP expense will be lower, and 2, you will also have a lower equity base because those ESOPs won't vest. So therefore, that's something that will play out. Now, in terms of what the ESOP guidance has been, there's been a large reduction in terms of ESOP expense. In FY24, it was just shy of 1,500 crore. FY25 estimate was 945 crore. This will go up, of course. FY26 is 567. This will come down. And FY27, it's sub 250 crore. And this will also likely go down. So you'll likely start to see these figures change. That will happen at the end of Q4 is what the management has said. Now, in terms of what next, the FY25 expense number will increase, as I did mention. You will have lower profitability. Profit will narrow in FY25, FY26, 27, it will get better. So there'll be better profitability in FY26 onwards as a result of this. There's no equity dilution to the tune of 2.1 crore shares, and therefore EPS will also likely go up in FY26 and 27. Now, why is this? Why has this possibly happened? And to try and break this down, you must first understand what the rule suggests. The promoter should hold at least 10% in a listed company. Otherwise, he's not classified as a promoter. This is the first rule you need to understand. The second rule is the promoter is not entitled to ESOPs. And therefore, to likely circumvent this, as per media reports, Vijay Shekhar Sharma has brought down his holding to 9% prior to the IPO, and therefore he was eligible to ESOPs. This, as per media reports, hasn't been taken well by SEBI, who have raised this issue through a show cause notice to Vijay Shekhar Sharma, and therefore one of the reasons likely why he's had to do this. The other reason is that he's come out and said that he will not allow vesting of these ESOPs. That is, he will not allow these ESOPs to be issued till the stock price reaches the IPO price, which is 2,150 rupees. Currently, the stock is 60% down from its IPO price. So maybe some perspective on why this may be the case being also brought out from the fact that he's foregone that 2.1 crore of ESOP.
Should pull up, thanks Harsh for that, and should pull up the stock price of PTM once again. Remember, started off in a fairly muted fashion, but has cooled off during the course of the trade thus far, of the morning thus far. The first 55 minutes trading about 1.5% lower. Can't say it's the same for all the other stocks in that bucket, but PTM certainly on account of this news and otherwise starting off lower. One would have thought that the street might view that positively per se, done and dusted with a band-aid approach just taken off, but for now, quiet with a lower bias. Same for IDFC First Bank, down, I mean, maybe flatlining, but with a lower bias because while it's approved a fundraise, it's actually done it, right, from two large investors. Harsh, who are these investors and how the company, what's the way ahead for IDFC First?
Well, Warburg Pincus and ADIA to infuse money into IDFC First, and no small number, right? It's 7,500 crore in cumulative, 4,900 crore by Warburg, and the balance around 2,600 odd crore by ADIA through their investment vehicles. Of course, you can see the names of the investment vehicles on your screen. But more importantly, it's going to be a CCPS raise, and compulsorily convertible preference shares are compulsorily convertible. There's no option to change them to any other method of non-convertibility, and therefore they will convert to 1 equity share each. Each CCPS will convert to 1 equity share. So eventually they will have around a 9.5% and a 5.1% stake respectively. So Warburg will hold 9.5% stake in IDFC First post the fundraise, and Ardia will hold 5.1% stake in IDFC First post the fundraise. Now, in terms of capital adequacy, 16.1% was the capital adequacy pre the fundraise, now standing just shy of 19%. Of course, Q4 profit not taken into account, so maybe something to mark out there. In terms of book value, now book value has seen a ramp up. We've seen a bit of a drag on profitability in recent quarters, but outside of that, till FY24, we saw a decentish growth in book value. Currently stands at 52.85 rupees post the fundraise, mind you, and therefore the fundraise has happened at 1.13 times price to book post money. That's the perspective. Of course, that is not too expensive, but these are also likely long-term holders of equity. Given the kind of record that Warburg and Ardia have, they're generally longer-term holders of equity, and therefore something to keep in mind.
Thanks for that. Thanks for that, Harsh. Well, from there to Sonata Software, which is also down. It's not having a downward bias. It's not a minor downward bias. It's really cracked in trade after the Q4 warning. Puneet Johnson with the details. Puneet.
Well, thanks for that. So definitely, they released a press release yesterday specifically mentioning that they are seeing some kind, their largest client, and there is a revenue delay essentially from the largest client. Now that is one of the key aspects of this particular press release that they've come out with. Now the key issue is they're seeing, in Q4 that will be the biggest impact that will be seen in terms of revenue from there. This will be, of course, the international business revenues are expected to be lower because of that, and now the largest client is potentially Microsoft. Now they have mentioned that specifically revenue decline is expected to be higher versus the guidance in Q4 of roughly 3.5%. So it was already mentioned that there will be a 3.5% revenue fall in Q4. Now it may be higher than that because of this new update. It's also mentioned that LTI, Mindtree as well as Persistent, both these stocks are also down in trade today, are the other vendors of Microsoft. So it's having a multitude effect in the IT space, specifically in the mid-cap IT peers as well. Now, international revenue and services business roughly contributed 25% of Sonata Software's revenue growth of revenue essentially in Q3, and hence this is a very big major margin trajectory as well, roughly about 10 to 11% EBIT margins for this particular business. So it's definitely a big crackdown that we are seeing in the stock today because of this particular update. In Q4, management had guided for, as I mentioned, 2.5 to 3.5% revenue decline, and now that might be higher than that. And considering that we've seen an unplanned ramp down as well amongst the other clients, especially in the TMT space, we might see some more major impact. But overall, it's a big negative news flow for a Sonata Software in a quarter where essentially the revenues were expected to decline. So watch out for more when the management comes out with its earnings as well.
We will, and I'm sure you'll keep us updated on that too. Puneet, thanks so much for bringing us these details. Okay, on to more details, and this time around pharma, before we have a very specialized pharma conversation. Zydus and Lupin, marginally higher after the crackdown yesterday as the US court granted patent validity in form of Astellas Pharma for generic versions of Mirabegron. Let's go across to Varsha to understand what exactly is this story. Varsha.
Thank you so much for that. Just one product, how can that affect the companies that we have seen yesterday? Zydus and Lupin, for Zydus the stock was down almost 7%, though it has recovered. Now this is because the Mirabegron litigation. Now the US court in Delaware grants a patent validity to Mirabegron, which is used to treat overactive bladder. While please note that in September 2024, US court had earlier held patent invalid. Zydus and Lupin have been selling this the generic version of this product since April 24 at risk. Now, what does the current ruling exclude is the litigation is still ongoing, and there has been no restraining order on Lupin and Zydus from selling the generic version. But what is the future course of action? One is the next hearing is scheduled in Feb 2026, and hearing will cover other reasons to invalidate the patent, and will also address whether the generics versions are different or not. if you see the current risk for Lupin and Zydus because of this litigation, they may have to compensate the innovator and they could face a penalty if Feb 2026 ruling is not in their favor. While even if the ruling is in their favor, there would be more generics competition available, which might affect the company's earnings as well. This may negatively impact their near-term profits. What is the financial impact? So for Lupin, this product contributed almost 7 to 10% of EBITDA and $15 million of sales. And according to some of the analysts, they were expecting $60 million of revenues in FY26 and $5 million of revenue in FY27. For Zydus, it contributed almost 40 to 50 million US dollars of sales and 15% of EBITDA in first quarter of FY25, while analysts were expecting almost $120 million of sales in FY25.
Okay. Well, yeah, what difference can one drug make or one announcement make? We saw that yesterday clearly, Varsha. Thanks so much for that. But what difference can one announcement of tariffs make? I think that's the key thing, right? For a sector which Aditya Khemka himself had said will see some significant departures from normal, because as rev limit comes to an end, there are now more things to ponder on. And Aditya, thank you so much for taking the time out and joining us. But now, now marry your earlier big picture about how portfolios should try and negate the impact of US market exposure focused companies because of rev limit and other factors, with the fact that it has only gotten more aggravated with this whole tariff situation.
Yeah. So the way we look at it, Neeraj, is that, anyways, most of these pharma companies were going to have an earning decline in FY27 over FY26 because the limit was contributing meaningfully in FY26 and it won't contribute meaningfully in FY27. Add to that this entire Trump tariff situation. Once the tariffs are imposed, if at all the tariffs are imposed, even today when the tariffs are just proposed, not even imposed yet, the risk for holding these stocks has just gone up, right? Because the earning declines might come, or you might have a period where they are not able to ship, or the shipping cost goes up, or whichever way this plays out. My point is that while the risks have gone up, has the reward gone up? The answer is no. So if the risks have gone up and the reward has not, then it becomes all the more important that we continue to avoid such stocks in our portfolios.
Got it. Okay, so Aditya, have you tried, I mean, you may analyze them even if you feel that they are not a part of your portfolio. I'm just trying to understand, have you tried to, how do I say, hypothesize what the next 9 months could be in the event of a likely outcome in your mind of what will happen to pharma tariffs in the US?
So I was, see, this is obviously something that one can speculate upon. We don't know what will happen.
Yeah, exactly.
But I was just watching this interview of the US Treasury Secretary Bessent, and I think he, in his interview with that reporter, said that the template that the American government is working with, that let's say there is a 10% tariff, they expect the US dollar to become 4% stronger. So 40% of the tariff out of 10%, 40% of it gets absorbed by the US dollar getting stronger. 40% is something that the manufacturing company / country has to absorb and not pass on. And 2% is the inflation that the end consumer will finally face in terms of dollars, right? So if you just take his math at face value, I mean, obviously we don't know how this will play out for various sectors, various products, obviously extremely difficult to guess. But if you just take that statement at face value, and let's say tomorrow there is a 10% tariff on pharmaceutical imports from India, you're looking at a 4%, the expectation of the US government is that 4% of the tariff or 4% of the value of the product has to be set off by the manufacturer or the manufacturing company or country. So assuming that comes through and assuming the tariffs are only 10%, you're looking at a 4% of sales erosion in terms of prices, because that amount will have to now be fed as tariff and the manufacturer will not realize that amount as revenue. So most of these pharma companies, I mean, our best guess is they don't report these numbers, but our best guess is they do on the base business around 15% EBITDA margins on the US business. So out of the 15% EBITDA margin, if 4% of that margin is at stake, because if 10% tariff is imposed and 40% of that 10% has to be absorbed by the manufacturing company, then you are looking at 4 out of 15 eroding. So that's about a 30% erosion in absolute EBITDA.
Okay. So Aditya, when one analyzes the broader healthcare space, and let's assume that hospitals, diagnostics, etc., are safe bets. I believe that is what you had told me earlier as well, and I'll come to that moment in a moment. But before that, so that is one aspect done. But if somebody does want pharmaceutical exposure, because she or he, in her or his wisdom, believes that there will not be too much of tariffs and there should be some exposure to pharmaceuticals in the healthcare bucket as well, what does one do then? I mean, does one, and also buys your argument, then what does one do? Avoid the generic players, look at CDMO, CRO companies? How does one arrive at that?
So if you are someone who wants to sort of play the pharmaceutical piece despite these risks, we highly recommend you look at companies that have a very lion's share of their revenue and cash flow coming from branded generic markets, India, Middle East, emerging markets, Latin America, Southeast Asia, so on and so forth. These buckets, so for instance, stocks like Ajanta, stocks like Ipca, stocks like JB Chemicals, Torrent Pharma, Alchem, Eris Life Sciences, so on and so forth. I mean, companies which basically do branded business for a living, right? Those are the companies that we believe will be relatively insulated from this entire tariff tantrum. I mean, they barely will have any exposure to this. They might even benefit if the US-China trade war continues. And another beneficiary of this US-China trade war will be the API CDMO companies. The only problem is that if I look at API CDMO companies in two buckets, I look at those companies which are primarily for generics, examples you obviously know, and then companies which are primarily for innovator businesses. Our sense is that companies for generics, the CDMO companies for generics, will have pressure because their client will be under pressure because of the tariff absorption. And the CDMOs for innovators will relatively again be insulated because the price at which these guys sell to the innovators is a very small part of the innovators' total input cost. So innovators then don't bother about if this tariff who will absorb or not. I think the innovators will end up absorbing majority of the hike in tariffs because they have that kind of margin to bear that hit.
Okay, and Manish, there is. Maybe it's a very, by the way, viewers, just remember, all the examples that Aditya gave are examples. They are not recommendations to buy or sell. So please do your own due diligence before you act upon it. Aditya, the other aspect is it's a very small bucket, but Indian CDMO is also coming into focus. I mean, in the sense, not the Laurus and the Syngenes which supply to the global companies, but the smaller companies in India which supply to the Reddy's, etc. of the world maybe. Is that a bucket that you've looked at all? Very small companies, and hence I'm asking you.
Yeah. No, we have looked at that bucket, absolutely. But remember, when you are supplying to the Indian pharma companies for the India business, right? The bargaining power lies with your customer. Because he's the one who's built the brand, he's the one who's done the marketing, he's the one who owns the IP here, which is basically the brand name here. And therefore, you're not really a CDMO company, you're more of a job worker, where you're given a job of manufacturing a tablet, a capsule, an injection, or an ointment, and you have to deliver X amount of inventory or X amount of batches at Y amount of time. So basically, these companies would generally be a 15 to 18% ROE companies, growth maybe 10 to 12% at the top line. On the higher end, maybe 15 if they're doing some capacity expansion and gaining market share. Because remember, the pharma market itself is growing at 8-9%, right? So you cannot grow more than 12, 13, 15% on the top line, even if you're expanding capacity and gaining market share. So these companies we like, but I think these companies are certainly overvalued today, given that these companies don't have bargaining power in front of their customers. A best way to look at it is look at their working capital. Working capital is a great indicator of bargaining power. And if you look at these companies' working capital, they're slightly stretched because their customers don't really care about, how much delay they make in payments. I mean, customers will pay in their sweet time. It is you are the one who have to bear the working capital burden. So, I mean, we like these companies. We think there's a good scope for growth, but we want them at the right valuation. I don't think the valuations today are right.
Okay, my final question, Aditya. is on the other aspect of healthcare, right, which is diagnostics and hospitals. Now, the one or two diagnostic updates that have come in haven't been particularly great. I mean, they were kind of okay. So, when you play this theme, and now that the one-offs of COVID-related high base, low base, etc. have gone away, are you playing this with a really long-term view of moderate but periodic upticks that come in business and hopefully valuations later? How do you think of it? Diagnostics, for example.
So I will divide diagnostics also in two buckets. One is urban focused, the other is non-urban focused.
Okay.
I think urban India today is spoiled for choices. Be it the brick and mortar format or the online format, they're just completely spoiled for choices. So there is overcapacity probably in the urban side. But if you look at beyond tier 1 India, there are very, very few options, but the purchasing power there is low. So you have to find a combination of diagnostic stocks or companies that are beyond tier 1 and that have affordable prices. And I think that is where, the sweet spot is. These stocks are fairly reasonably valued, in fact, quite cheaply valued, some of them. And the growth potential is immense because in those pockets, the moment you move out of tier 1 India, the penetration is unbelievably low, the opportunity is unbelievably high, the volumes are high. All you need is affordable pricing and some decent quality to offer, right? So I think that is where the moolah really lies today. The larger diagnostic companies, which are mostly predominantly urban India, they will have high single-digit growth. They will have maybe low double-digit growth, EBITDA growth, and a mid-teenish kind of PAT growth, organic. Plus, they will keep doing some inorganic because the market is so fragmented. But that's not the sweet spot for us. I mean, those are also okay stocks. You can buy them for a 12-18% range CAGR returns. But, we are looking at much higher returns from stocks which are more affordable, more beyond tier 1, and where the opportunity penetration really lies.
Got it. Okay. Aditya, always fascinating talking to you and getting these nuggets, insights, etc. Today, no different. Thanks so much for joining in today.
Thanks, Neeraj.
That's the view from Aditya Khemka on a very crucial sector, which there's a lot of yo-yo, of course, that's happening. And we end the show on the note that the markets are quiet. I mean, nothing too dramatic happening on the large caps. Small caps, maybe a tad in the green, but nothing too dramatic out there. Either breadth, pretty okay. But you can ask your specific queries on Ask Profit, so keep that in mind. And just a mention of ABB, the flashes on your screen before we wrap up. In the global earnings that have come in for ABB, they have mentioned that the Q1 global India growth order growth has come in at 1%. Now, it sounds very tepid, and yes, it is. But I think the expectations were way lower. I think the expectation was of a degrowth of about 6%. And as a result of which, that spike in ABB, it's up 2% because versus very low expectations, they've at least delivered 1% order growth. And the commentary from the India business or the India, Sanjeev, etc., on what does quarter 2 global standards, but quarter 1 FY26 and quarter 2 FY26 hold in store will determine what happens to ABB stock in the medium term or the near term. Thanks so much for tuning in today.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation.
Hi, good morning. Thanks so much for tuning in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we will take you through the next 1 hour of trade. It seems like everybody is in holiday mood, seemingly because of the severely curtailed trading week. And we are seeing the Nifty 50 with, it's recovered while I was introducing the show. Can you look at that? It's about 0.1% right now below yesterday's close, and what a move we've had over the course of the last 3 trading sessions, not counting today. So if you talk about the Nifty 50 itself, it's gained about 1,030 odd points. So now at this juncture, 1,000 points over the course of the last 4 trading sessions, including today. And it's been a phenomenal up move. In fact, one of the major contributors is the Nifty Bank. So let's pull up that as well and see where it is. It's up another 0.5%. So it's trading very close to all-time highs for the Nifty Bank. And don't be surprised if that mark gets hit. And we're heading towards 54,000, in fact, on the Nifty Bank. It's up another 300 points in trade today. Let's pull up the contributors on the Nifty 50 and see what's made the move higher in the last few minutes. I'm also pulling that up on my screen because what you will see is the gain from the low, and a few stocks are making a move higher. So Titan, for example, is made a move higher. It might only be flat right now, but it has moved about 2% higher from the low point of the day. Grasim has made a smart move as well. Shriram Finance, Eternal, Sun Pharmaceuticals, M&M, all gaining over 1% from the low point of the day and doing particularly well right now. In fact, the breadth has also shifted to a certain extent. It was more negative earlier. At this juncture also, you have the advances that are lower than the declines on the Nifty 50, but that is not the case for the market as a whole. There's been quite a lot of crisscrossing of those two lines. Let's look at the broader markets and see whether the up move has actually extended there as well. And the mid-cap index, there you go. It's now just about treading water close to yesterday's close. The small cap index, I'm guessing, will also have made a similar recovery. And in fact, it is in fact trading in the green. Among the various stocks that are reacting today, in fact, let's not get into some of those details, because really the stock of the day could well turn out to be the one we're talking about next. And ABB, you pointed this out yesterday. Yes. The stock was in focus because of what the global entity is going to do. Before we get into ABB though, the numbers that you see on the top of the screen and at the bottom, you can call us on the one that is here, which is the landline number, and you can message us here, as a lot of you have already done, and we will get you answers to all of that. In fact, Dheeraj from Hyderabad is called us and he's got a question on ABB. Dheeraj, allow us to set the context for your question, because there's a significant update that has come through. Mahima, you want to take us through the highlights, and then we can go to Anushi, of course.
Right. So basically, the key highlights, I think Anushi will be a better judge there, but the key highlights is the margins have come at much better than what was expected. It has come to around 20% and overall order book growth is also much better than expected. We have Anushi also joining in to give us more details on that, since she tracks this very closely. Anushi, give us the details.
Right. So what we are looking at for ABB Global is what is a clear standout, as you've mentioned, is firstly the EBITDA margins. Now we are looking at a number of 20.2%. The expectation was for overall margins to be in the range of 19.1%, see about 80 basis points of a decline, but in fact it has recorded better than expected margins over here. So that is definitely something that we are seeing. India order growth also, if we see of the company, the context in terms of how the ABB India growth story is in terms of order inflows, they have reported a 1% of a growth. The expectation was for a negative growth for the quarter, so that is also another positive that we are seeing, and management commentary on the same would be important to how the ABB India order flow business could pan out in terms of where the order picture is concerned. If you look at the overall orders of the company, that stood at about $9,213 million, which is a 5% of a growth compared to last year. Revenue also saw about a 3% of a growth, while revenue we did see a little bit of decline, because the expectation was that the revenue may grow in the mid-single digit range as per the last quarter outlook given. The Bloomberg expectation was to see about a 3.9% of a growth. So it is majorly in line with that estimate that we are looking at. Now do note that the outlook for CY25 for the company remains that they plan to maintain a positive book-to-bill ratio. Along with that, they expect the revenue growth to remain in the mid-single-digit range and operational EBITDA margin to improve on a year-on-year basis, as we have seen in the first quarter. So that is the overall context that we are seeing for ABB Group.
Okay. All right, Anushi, thanks so much for that. And you're looking at the intraday chart, it's up about 3% or thereabouts. Let's get our experts on for the day. We've got Kush Bora of kushbora.com as well as Shahina Mukaddam joining us this morning. Thanks so much as always for the two of you for joining in, and happy Thursday to you. I would normally say happy Friday, but today I'm saying happy Thursday. Incidentally, let me go to the first call of the day, because he's called at a very opportune time. Dheeraj, thanks so much for calling us, and you bought ABB at 5525, not too far from the current market price. When did you buy it, and what is the outlook that you have? Yeah.
I bought it 10 minutes ago. Sir.
Oh wow, okay, fine, all right. So what do you want to know?
Can I add more at current levels is my query, or should I exit within a month, or what's the overall outlook of ABB is my query, sir.
Okay, so but then if you have an outlook on the business and you bought it for fundamental reasons, why are you looking at only 1 month? I'm just curious.
Actually, for a short-term swing, sir, as it posted good result, I wanted to
You wanted to benefit from that. Okay, I get it.
Yes.
All right. So this is not a long-term fundamental view that you're seeking. Anyway, let me address both, right? China, I'm sure that you caught the numbers that Anushi just spoke about, and I'm sure that you've been tracking the stock as well. So first, let's look at fundamentals, and then I'll come to Kush on ABB on the charts. What do you make of it? Should you hold on?
Well, if you're a long-term investor, you can hold on. But if you want to add, I would believe you should add at lower levels. The numbers were very good. Margins are expanding quite well, and I believe even the order book is doing well. So they should do. They've got good order book. They've got good products. They're targeting the high growth and also the more higher margin products. Having said that, I would just say add at lower levels because valuations, despite everything, is still very expensive. If you look at the price to book, it's almost above 1 year forward, it's about 14-15 times. And also if you look at the, EV by EBITDA is also very high, and even the P is very high. So given all these expensive factors, better to add at lower levels.
Okay. All right, let's talk about those levels then. And if you've got a time frame of 1 month then Kush, and you bought at 5525, you've already seen a bit of a pop. What are the key levels to watch out for on the upside?
Hi, Alex. Hi, Shaina. I think this has to be one of the first, right, Alex, where you've got a live trading query. And by what do I mean by that is that, the trade actually happening, on this show. So that is fantastic, right? So I think this is a good buy. I would have ideally preferred to buy this above the 5600 mark, which was a recent swing high. And once it crosses that, there will be completion of a rounding bottom formation. But good to see that he's already bought it and he's in the money. Now what he could do is hold this with a stop loss around the 5350 mark. Once it crosses 5600, I think the supply pressure of the last about month and a half, 2 months will get over and the stock could move higher to 5750, perhaps even 5825 kind of levels. So suggestion would be to hold, keep a stop loss around the 5350 mark. Don't add right now. Once you see it crossing 5600 and building on from there on, that's when you should add more and hold till 5825 level.
Okay, so that's the view with regards to where charts are concerned for ABB India. Our next question is from Puneet, who's writing in from Delhi. His question is on RVNL. He's bought 1,550 shares at 598 a piece and sitting on a significant loss of around 3.6 lakh rupees right now. And he's stuck since July is what he's saying. And he wants to know what should be the next course of action. Shaina, I'll come to you on this one. Fundamentally, how are you viewing the stock? Railway stocks have been beaten down, but they have picked up in the past few weeks or so. What's your view with regards to RVNL? Should he book some losses or should he wait to recover them?
I think he should hold RVNL. They have again here a good order book position, and what I believe is that it's a public sector. It's pure play into with 50% over in terms of engineering. The order book is more than 65,000 crores. So while it is slightly expensive, and also the stock had given you a good return if you look at a slightly longer term period. But I believe given the order book position, given the execution improvement that is likely going forward, one can continue to hold at current levels.
Continue to hold at current levels is the view coming in on RVNL. Our next caller, Viral, is calling in from Mumbai. A very good morning to you, Viral. How can we help you?
Hi, good morning. So I have a stock called Valor Estate. So I wanted to know the fundamentals of the company, price targets, and what do the analysts think about its future.
Okay. Viral, if I'm reading this correct, you're holding around what? 3.9 lakh shares at 116 a piece. Is that correct?
This is correct, yes.
So you're sitting on a profit of 3 crores already right now?
Close to, yes.
All right. So you've already studied the fundamentals, if I'm not wrong.
You could say that, yes.
All right. So first of all, I would say congratulations on that. That's a significant amount of profit that you're already sitting on. I'll take this up with Shahina. Shahina, 3 crores is not a small profit, and especially right now we're seeing a volatile market overall. What's your view with regards to Valor Estate? Should he book some profits at the current level, or should he continue to hold?
See, what I see the numbers is that after a long period of losses, the company, it's a real estate company. So they have actually turned around, and we saw in the last quarter, they have made profits. The stock seems to be pretty bullish. It's about a 10,000 crore market cap. So it seems to be pretty bullish for the shorter term. Numbers could be good, coming in good. I just want to give a negative out here that you need to keep a watch on. The promoter holding has come off over a 1 year period. Secondly, there are huge amounts of, there's a lot of pledge. While the pledge has reduced over a period of time, so there seems to be some turnaround. But really, you need to keep a watch on this. Otherwise, the stock looks like a hold even at current levels.
Viral, you're still with us. Can you help me understand what the thinking was? Because you've gotten at the absolute perfect level if you think about it. We pulled up the 1 year chart. And on a 1 year basis, it's actually negative, but you've gotten in at a very key level. What was the thinking when you did, and how did you take such a large bet? What did you think of, or what drove you to take such a large bet?
Correct. No, so actually I've been buying since 2018. So I have been buying since 3 rupees 50 paisa.
Oh, okay.
And I have been consistently buying since it was 350, 4, 6, every level you could imagine, every price I've bought up till 230 levels. So the thing is, we have a huge, land bank. Basically, so if you see, they hold about 250 acres of land bank in Mira Road, and just next to the station. And if you really do the calculations, it's debt-free land in residential zone. So only that land is worth 6,000-7,000 crores. So, and apart from that, they have got massive build-up of 5-star hotels. So if you see the Delhi 5-star hotel, if you see their 50% stake, that itself is worth 4,000 crores. Right. So two projects, just a land bank is 10,000 crores, plus a lot of construction happening in BKC and South Mumbai, so massive land bank. So that's the reason why I bought it.
Okay, so fair point. And by the way, in case people are not aware, we're talking about DB Realty, which is now called Valor Estate. But Viral, now that you made this kind of gains, and you don't have to answer this, but I'm just curious about this, right? Because you've accumulated over a period of time. This is a very sizable holding. What percentage of your portfolio does this account for?
Probably 50%.
50%, okay. Okay, all right. So, and if the view is on the technicals to take some money off the table, you'd be willing to do that?
Not really.
Okay, but let me still go ahead and give you some perspective. Kush, do you want to weigh in on this? Based on the kind of run-up that you've seen from lower levels, it's moved up very quickly. If I saw the chart correctly over the last 3 months or so, what do you make of the current levels, and what is the potential for upside?
Firstly, Alex, I must say that you often invite us, China, myself, and some experts on the show. Who take the conversation higher. This time it's the case, kudos to Viral for, taking the level of the entire conversation, to a different level, and of course on the gains that he's making. Now, I'm not very constructive on the entire real estate space. In fact, if you've heard me for a while now, the other ones, the DLF and the macro tech of the world have been reeling under pressure. The rise has been taken as an opportunity to sell. I must say though that Valor Estate actually stands out, from the entire pack. The reason being that if you see, the last about month and a half, 2 months, there has been a good accumulation incidentally around his average price. I can't call it buying price. He started at ₹3, but around his average price of 120, 118. From there on, the stock has moved higher. From a near to a medium term perspective, the stock's actually broken above all the resistance levels. So at least the moving averages. The next one coming up is at 202. If that level is taken out, I think the stock is poised to move higher, perhaps 235, 250 as well. My suggestion would be to continue to hold anyway. He doesn't look like in a hurry to sell. So not a bad idea to continue holding on to this one. But I'm a fan of stop losses or trailing stop losses at least. So I would go ahead and still recommend one to him close to the 170 mark. If that is broken, perhaps taking some money off the table might make sense. But yeah, as I said, this one stands out from the real estate.
All right, so that's the view with regards to where charts are concerned for something like a Valor Estate. Moving on to the next question, Suman Prasad is writing in and wants to know, he's from Noida and wants to know a view on Geo Finance. He's holding 1,300 odd shares at an average price of 355 a piece. Shaina, I'll come to you on this one. A lot of people have invested in this counter and are sitting on significant losses. Should they continue to hold or book losses? Because he's sitting on a loss of roughly 1.5 odd lakh rupees.
He should continue to hold. It's of course a very well-known management, and the growth is likely to come in. They're expanding their business, likely to launch their mutual funds. They're getting very aggressively into loans, even the small ticket loans. They have got it's smaller in terms of base as of now, but the potential for growth is good. So one can continue to hold if you're a long-term investor.
So that's a view on Jio, and quite a lot of value erosion, but the stock has made a bit of a comeback, up about 10% as you can see over the last month or so. Ajay is calling us from Ambala. Hi Ajay, good morning to you, and how can we help you today?
Yeah, good morning sir. Good morning ma'am. मेरा क्वेश्चन सेलो वर्ल्ड के ऊपर है. एक्चुअली लास्ट टाइम मेरी बात हुई, कुछ ने कहा था कि 580 के आसपास आए तो बेच देना. मेरे पास 1200 शेयर्स हैं 730 के आसपास. तो सर क्या मैं इसको बेच दूं कि अभी रखूं? आज 4% अप है.
4% अप है. और आपका टाइम फ्रेम क्या है अजय? आपने जब खरीदा था?
मैं रख सकता हूँ, मैं 6 मंथ साल रख सकता हूँ, ऐसा नहीं है. मतलब मेरे पास 1200 है तो कुछ बेच दूं क्या, वही पूछना था.
Okay, understood. Kush, you want to weigh in on this? If he's got a relatively short-term time frame, he's made a bit of a recovery, but what are the key levels to watch? Where would you put the stop loss?
So I prefer to answer this one in Hindi, as he's asked the question in Hindi. That's all right. तो अजय, फर्स्ट ऑफ थैंक यू, आपने ये याद रखा कि क्या लेवल्स हमने यहाँ पे डिस्कस किए थे. अब देखिए जो 580 590 वाला जो रेजिस्टेंस जोन था, अगर आप देखें तो अभी भी वो स्टॉक पे एक्ट कर रहा है, क्योंकि स्टॉक ने अभी रिसेंटली जो हाई बनाया था वो 600 के आसपास का था और फिर से स्टॉक उसी लेवल के आसपास आ गया. मेरी सलाह रहेगी कि बिकॉज स्टॉक में अब पिछले 3 सेशन से मोमेंटम पिकअप हुआ है. अगर आप आज का वॉल्यूम्स देखें तो दिन में करीब 1-1.5 घंटे का समय ही बीता है, लेकिन अभी भी इसका अगर आप वॉल्यूम्स देखें तो पिछले 20 दिनों के एवरेज से ऑलरेडी 2 गुना वॉल्यूम हो चुका है. तो हो सकता है कि यहाँ पे मोमेंटम जो है ये पिकअप करे. तो अब मैं ये सजेस्ट करूंगा कि रादर देन इसको अभी आप थोड़ा सा ऑफलोड करें, इट विल बी अ गुड आइडिया टू होल्ड दिस विद स्टॉप लॉस जो कल की जो क्लोजिंग थी उसके आसपास. तो 560 का ट्रेलिंग स्टॉप लॉस लगा के चलें और पार्शियली जो आपकी क्वांटिटी है उसको इस स्टॉप लॉस से होल्ड करें. अब ये मोमेंटम जो है बिल्डअप हो रहा है, 580 590 का अगर ये रेजिस्टेंस क्रॉस करके उसके ऊपर की क्लोजिंग देता है तो यहाँ पे आपको 625 से लेके अबाउट 660 तक के लेवल्स भी देखने मिल सकते हैं. तो मेरी सलाह रहेगी कि इसको ट्रेलिंग स्टॉप लॉस के साथ होल्ड करें, बिकॉज अब इसमें वॉल्यूम एक्शन भी पिकअप हुआ है, प्राइस एक्शन भी पिकअप हुआ है और मोमेंटम भी बिल्ड हो रहा है.
With regards to Cello World, just a quick context. Cello World is up today on the back of a Kotak note. In the Kotak note, they've given a target price of 710. What Kotak believes is that the correction is overdone now. The stock has been down around 35% in the past 6 months, and they're expecting a 12% EPS CAGR on this particular counter. They're also expecting growth to recover, and this will be on the back of consumer sentiment seeing recovery as well. And they don't see any major demand challenges for something like a Cello World. So that is the major reason as to why the stock is up almost 4% in trade today. All right, moving on to the next counter and caller. Venkatesh is calling in from Bengaluru. Venkatesh, a very good morning to you. How can we help you?
Yeah, good morning, ma'am.
Good morning.
Yeah, so I've got around 28,000 shares of LIC which I had purchased at 1,070, 1070.
Okay.
1 year back.
Okay.
Shall I hold or shall I dispose it off and switch over to some other company?
Okay, got it. Venkatesh, I just want to understand, because you're sitting on a significant loss right now, what was the thinking when you bought LIC, and how long ago did you buy LIC? Because you've bought it at elevated levels.
Yeah, 1 year back.
1 year back, okay. And you would want to continue to hold it from a longer term perspective, fundamentally?
Yeah, because it is safe is what I feel.
Okay, all right. And since this is 28,000 shares, what percentage of your portfolio is this exactly?
What is that? I didn't get it.
What percentage of your portfolio right now is LIC?
90%.
90%. Okay, that's quite a significant amount of your portfolio. Yeah. Shaina, I'll come to you on this one. He's sitting on a 75 lakh rupees loss right now, almost 76 lakhs. And that's 90% of his total portfolio. First of all, Venkatesh, just to give you a view, it's not advisable to have such a big amount of portfolio concentration in one particular stock, and I think Shaina will also agree to that. But Shaina, what's your view? Should he continue to hold, wait for some recovery?
See, just purely on LIC, of course, I totally agree with you, Mahima, that one should not have such a huge percentage of your portfolio in a single stock. Even despite it's something like an LIC, which is fundamentally strong to hold for the long term, basically because it sort of, keeps your overall portfolio return in a stagnant basis if the stock doesn't perform for, say, a 1, 2, 3 year period, which sometimes happens for large cap stocks like LIC. So having said that, I think if I'm just discussing LIC by itself, You can continue to hold at current levels. I would say keep a stop loss of 700 rupees, but hold because your valuations are very attractive at current levels. It's just about 0.7 times FY27 EV. So one can continue to hold, and also in terms of growth, new expansion in terms of verticals, they are likely to expand. They are looking at other segments in terms of growth going forward. Government is giving them other areas in which they can operate. So to that extent, it's a hold. But yes, you need to diversify your portfolio. You can actually diversify to something like a large cap bank, ICICI Bank, HDFC Bank. So you can switch part of it, book part of your loss, switch to one of those banks, say ICICI Bank. So there you have that potential for diversification as well as in quality stocks.
I'm just to follow up on LIC, since it's a very large holding that Venkatesh has. There are a few headwinds that the sector as a whole is facing, right, China? So when we're talking about bank assurance and the way that these products are sold, and we're talking about the construct of their policies that they sell, and we're talking about the need to increase term loan contribution because it's a higher margin product. How do you see these things affecting earnings, if at all, in the current financial year? And from that perspective, what is the potential for growth for LIC that you see? I agree that valuations look attractive right now, particularly if you consider the kind of portfolio that it's sitting on. But in terms of growth potential, how much would you attribute to LIC?
I think the impact of the changes of the government policy on LIC will be quite marginal compared to the others in the segment, and they all are finding ways to actually overcome it. There are limitations that the government is putting on various factors. They have already started, like on expenses. At the same time, I think the opportunity for growth, given the market size, and also LIC expanding into other areas in overall insurance segment. So there is potential for them to do better. And I think the overall market construct also seems to have bottomed out. If you look at the overall, the negativity sentiment that was there, because whatever China negative is positive for us. So to that extent, we seem to have stabilized in the overall market, and LIC does have huge holdings across quality stocks. So to that extent, I would say you can hold. But yes, you can, as I said earlier, you should switch actually partly just to diversify your portfolio into quality stocks in other sectors.
Yeah, Venkatesh, hopefully this views helped you out. And I guess to a certain extent, when you're buying LIC, you're buying the portfolio of stocks also that they hold. If you can stretch the argument that way, but then that's not the ideal way to hold a portfolio of stocks. So bear that in mind, and I hope that this conversation has helped you. We have to slip into a very quick break. We will take more questions on the other side. Viewers who've been waiting by, thanks so much for your patience. We'll be back to take more of your questions, so do stay tuned.
That's huge. That is a biggie. It's on a
Gold Plus Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. All right, moving on to the next query. Ram from Dublin is writing in. He's holding 2,500 shares of Tata Power, bought at 65 a piece, and sitting on significant profits of around 7.9 lakh rupees. He wants to know whether it's time to sell and book profit, or should he continue to hold? Shaina, I'll come to you on this one. Tata Power is the counter. What's the view like? Should he continue to hold?
Yeah, you should continue to hold at current levels. Tata Power has actually expanded a lot and is doing pretty well in the renewable energy space. They have got a couple of new initiatives, including nuclear power. So I would believe at current levels, it's a hold.
Hold is the view coming in on Tata Power where fundamental is concerned. Our next caller, Ravi, is calling in from Visakhapatnam. Ravi, a very good morning to you. I believe you have a query on MRPL.
Yes, ma'am. Yes, MRPL.
Okay, go ahead with your query. What's it about? Have you seen the fundamentals of the company or the technicals?
Yeah, fundamentals I have seen, and I bought at 230 rupees, ma'am.
Okay.
So I found, overall the petrochemical sector is also lucrative.
Right.
But unfortunately, with this Trump flow, from 232 it's banked to 105, and later it covered to 130. Now I'm sitting on loss of 50k.
Okay.
So what is the view should I take? I'm ready to wait actually. I'm a long-term investor.
Got it. Got your query, Ravi. I'll come to you again, Shahina. Mangalore Refinery and Petrochemicals is the counter. What's the view like? Should he continue to hold? He's sitting on a loss of 47,000 odd rupees right now.
Well, I think he can hold for now and look for a bounce to exit. There's a lot of uncertainty in terms of oil prices. Oil prices as of now are low, but at the same time, what is going to be happening to their ability to actually continue to sell at current levels, or will they have to see price cuts going forward? So to that extent, it's a hold at current levels, but he can look for a bounce to then look to book some profits of his. I think he can look for something close to about 150 odds for him to take an exit.
Okay. All right. We have a viewer who is saying or is asking, did we stop the YouTube live or NDTV Profit? It's live. It's available. In fact, please do check it out. And we can maybe take some of the questions from there as well. But you got a next question, Javinder, who's writing in from Punjab and asking about Canara Bank, which he's bought at levels of 110, and he's sitting on a sizable profit. No. Okay, this is seemingly the wrong. Okay, that's the wrong play that we played out. But he's bought at levels of 110. Kush, what's the view on the charts? Should he hold or sell?
No, continue to hold. We've seen PSU banks do rather well in the last 6 to 8 weeks. The uptrend has been rather encouraging, on some of them. Now comes up, at the resistance of 98 to that 100 zone. But I think overall the momentum is good with the banking space. Volumes could have been higher, but we'll take that in volatile times like these. So my suggestion would be continue to hold. Keep your trailing stop, or rather keep your stop losses at the 90 mark. I wouldn't be surprised to see once the 100 level is taken out, the stock move higher to 105 and then 112, which puts it slightly above his buying price. But that would still constitute a view that comes to hold.
All right, so that's the view with regards to where Canara Bank is concerned and where technicals, of course, for Canara Bank is concerned. Our next caller, Brijesh, is calling in from Hyderabad. Brijesh, a very good morning to you. How can we help you?
Very good morning. I have a query. I just wanted to get your inputs.
Sure.
So the query is, I bought Shakti Pump on 820.
Okay.
And I'm holding it, and I'm also a long-term investor, but just wanted to understand your perspective on this stock, how it will go, and yeah.
Okay, got your query, Brijesh. I'll take this up with Shahina. Shahina, Shakti Pumps is the counter. What's the view like?
I believe it's a hold from here. Basically, they have got a huge order book position, and in terms of performance, also they're doing pretty well, and valuations are quite attractive. So to that extent, I would say, given all these factors, it is a hold.
It's a hold on Shakti Pumps. Hopefully that answers your question, Rajesh. And the next question is on IRIDA. And the stock has been in focus on the count of a stellar set of numbers in the fourth quarter. It is, of course, cooling off just a tad bit, 1.5% lower right now. But Divyam wants to know whether this is the right time to buy the stock. Kush, based on the kind of rally that it's seen in the last few days, would you suggest that you wait a little bit, or is this the right moment to add?
Alex, it'll be a good idea to wait a little bit because we've seen a very sharp up move in the last 5 sessions from 140 all the way up until 180, but not sustaining at those levels. Also, we've had a couple of gaps, going along the way where the stock had a gap up opening. You're still some signs of profit booking, and that is par for the course. My suggestion would be closer to the 165, 168 zone is where the stock becomes a little more attractive. And once again the levels of 180 and 195 come into play as your targets, with your stop loss coming in close to the 150 mark. So anywhere close to the 165, 168 zone is where you should consider a buy on IRIDA. So it's a buy on.
Okay, so that's the view with regards to where IRIDA is concerned. Our next question is from Satyan. He's thanking you, Shaina, for picking up Vadilal a couple of years ago. So he's bought Vadilal at the price of 2,200 on the basis of your suggestion, and sitting on a significant profits of around 5.8 lakh rupees. He wants to know as to what should be the next course of action now that he's sitting on a significant amount of profit. Should he book profits, continue to hold, book partial profits? What should he do?
Well, the story is just starting to unfold. At the same time, given the sharp run up in the price, it is starting to get slightly fairly priced. So to that extent, I would say you continue to hold. They are entering into a number of new spaces. That is the reason why I had actually recommended it, of course, at much, much lower levels. But now it is doubled from those levels in the last 1 year. I would still say hold, but hold with a stop loss. Keep something like 5,000 rupees, a stop loss, where, of course, I think the investor would still be making money. So keep a stop loss and continue to hold.
Okay, yeah, indeed. He points out, Shaina, very clearly that he's held only because of the conviction that you had in the stock in your recommendation, because he's had a lot of people telling him to book profits at levels of 4,000, levels of 5,000. So he's continued to hold based on that. All right, let's go to Adani Ports. This is a question coming in from, Sumit. Okay, Sumit is asking about Adani Ports. He's bought at levels of 1,200. 400 shares is what he's got. So he's sitting in the green right now, just about, because the stock has made a comeback off late and it's gained quite considerably in the recent past. On the charts though, would you hold for a period of 30 days, and what is the kind of upside? By the way, you have one brokerage that came out today. Was it Morgan Stanley?
For
Adani Ports?
Adani
okay,
Ports,
we'll pull that up, but I think there was an upgrade on the stock. And the target price was raised as well. But on the charts, Kush, what's the view on Adani Ports?
Not bad at all, Alex. It's a good idea to continue holding on to this one. And the 1,200 level was, a stiff resistance for the last month and a half, where the stock has actually attempted at least 5 to 6 times and then, given way. This time around, on the back of very good volumes, the stock has surpassed, that level. And when you see, such kind of a breakout, it usually tends to continue for higher levels. So my suggestion would be hold on the upside. You're looking at targets of 1265, 1300 is a 200-day moving average. So that is also in play right now. So for a period of 30 days, maybe slightly longer, you should continue to hold. The stop loss for this one is at 1180, where the 20-day moving average is.
Okay. Standard disclaimer, of course, the Adani Ports company is part of the Adani Group, and so is NDTV Profit, which, as you know, is part of the NDTV Group.
And you do have a good memory. It was Morgan Stanley on Adani Ports, and they've maintained overweight and hiked the target price to 1418. So that's the view with regards to Adani Ports. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Very good morning to you. Thank you for taking up my query. I am holding East India Hotels.
Okay.
EIS at an 1,500 shares bought about 9 months ago.
Okay.
At an average price of 425.12.
Okay.
I am willing to wait for more than a year because considering the upcycle in the hotel industry.
Correct.
And number 2 is ROE, P is the highest in the industry and P is the lowest compared to its peers.
Right.
So I thought Shiva, I should hold. What is your advice?
Okay.
Hold, exit.
Okay, got your question, Murli. Yeah, I'll take this up with China. China, in the past few days as well, hospitality, there have been a lot of brokerage notes also coming out and they are now turning positive in terms of where the entire travel and tourism space is concerned. But there are a few names that are standing out in those notes, and one of them is ITC Hotels, one of them is also Indian Hotels. Murli is holding East India Hotels, that is EIH. What's your view with regards to that? Should he continue to hold that or switch to something else in the tourism space?
He can continue to hold if he would like to, because here the growth is quite good. They have shown a 16% increase in their ARRs, average room revenues, and also in terms of valuation, as he pointed out, it is attractively priced. So he could continue to hold. In fact, if you would like to diversify, I personally also hold, and I think there is good potential even in ITC hotels if you're looking at a medium to longer term view. So you could add that also to your portfolio.
Let me just take a chance. Murli, hopefully that answers your question. But Kush, do you at all track silver and look at the technical levels on silver?
Not on a very consistent basis, Alex, but usually, do keep an eye on it. But yeah, as I said, not on a very consistent basis.
Okay, so while I take the next question, let me just take a question to Shahina in the meanwhile. Maybe if you can look at the charts, because we've got a view on YouTube. We've got Ajay who's asking for a view on silver because he wants to buy ETF. And I know that we normally take stock specific questions, but then commodities also in focus as of now, and precious metals in particular. So I'm going to try and get a view from you, Kush, if you can facilitate. But on Worry Renewables, this is a question from Afreen who's writing in from Hyderabad. And Shaina, this one's for you. She's looking for a for a long-term view. Of course, the results came through yesterday, and it's a considerable upside that was reported on the profit, over 80% gain on the PAT number, and the stock is reacting positively to that. If I remember correctly, it was on account of the share of EPC business, which has gone up quite considerably. And so though you have a narrowing of the profit margin, you have a sizable increase in the PAT number that has come through. So would you hold on to this, and what are the prospects going forward?
If I would prefer, switching over to Vari Energies rather than Vari Renewables, because here it's a recent listing. The valuations are extremely expensive, and to a large extent they are dependent on Vari Energies, which actually has got a base in the US. So if I was looking to invest in the same group, similar products, I would prefer Vari Energies over Vari Renewables.
Prefer Vari,
so I would say a switch.
Vari Energy. Shaina, have you looked at any corporate action? I don't know if I'm remembering correctly, but Vari Energy, is any corporate action that you've spotted? I'll check.
Yeah, I'll check that.
I'll check. Okay, in the meanwhile, let's go back to Kush. Kush, any view on silver?
So, Alex, very sharp run over the last 8 to 10 sessions on the back of good volumes, but now I see some negative divergences popping up, and also on the hourly charts, the negative divergences are quite pronounced. So my suggestion would be perhaps there could be a correction going forward, a buy on decline kind of a setup to begin with. 94,000, 94,200 is where I think some correction could happen, and that's a good entry point. This rally continuing on the way up, it could very well move to 98,000 and about 99,000 odd levels. So silver at the moment could be, a buy on dips kind of setup. 94,000, maybe stretch it a little to 94,200. Those are the levels where I would prefer to enter. If you have an existing position, not a bad idea to continue holding on to this one, but the 94,000 becomes your trailing stop loss.
Okay, all right. Do bear in mind though, Ajay, on silver, of course, you can't lump it in with gold. And gold, of course, has been trading higher every other day, and we're at life highs here in India as well. But silver, a large portion of its price is determined by industrial demand. So if you're talking about 2/3 of the value of silver is attributed to industrial demand, as a result of which, if global growth is going to slow, then you can anticipate that that's going to have downward pressure on silver prices as well, which is why metal counters overall have been under a little bit of pressure in the recent past. By the way, let's address the markets because they are at the day's high. The run-up that you saw at 1:30 p.m. or thereabouts yesterday seemingly is playing through right now. Well, let's see if that gets built up through the day, and pull up the intraday chart for the Nifty Bank as well and see where it's challenging those higher levels. It is in fact doing just that. 0.6% for the Nifty Bank. Any calls here, Kush, on the Nifty Bank? Would you take the opportunity if you've gotten in maybe 3-4 sessions back and you've seen a 3,000 plus point rally on the Nifty Bank? Would you book out right now?
Absolutely, Alex. Yesterday in the closing show, this is exactly what we discussed. That the momentum is for sure there with the financials and particularly Nifty Bank, but it's hit over heated territories on the momentum indicators. While PCR, there is still some comfort. I think the last I checked, PCR was at 1.15 thereabout. So 1.3, there is still some room, but it's hit overheated territories on at least the momentum indicators on short-term charts. My suggestion would be take some money off the table. You might, if you don't want to completely exit, at least book partially, about 50, perhaps 75% of your position. Should be booked out at the current juncture. Look at buy on decline kind of a setup where a drop till 51,800, 52,000 levels should be taken as a opportunity to re-enter. But yes, at the current juncture, from a near-term perspective, it's definitely a bit overheated. So not a bad idea to take some money off the table.
Right, not a bad idea to take some money off the table is the view coming in where charts are concerned right now. All right, our next caller, Mansingh, is calling in from Andhra Pradesh. Mansingh, a very good morning to you. How can we help you?
Yes, madam. I am holding Arts and Chemical shares, madam.
Okay.
110 shares, average price 583, madam.
Okay.
My query is, should I continue to hold the stock?
Okay, and you bought this?
Accumulate more, madam. One more, madam. Just listen
sure.
to me, madam. I am also holding.
Okay. So Mansingh, we'll take only one question per viewer. So you will have to choose between Arkin and whichever is the next counter.
Deepak Nitrite and Arts and Chemicals. I am choosing Arts and Chemicals, madam.
Okay, Arkin Chemicals. Okay, I'll take this up with Shaina. Shaina, what's the view with regards to where Arkin Chemicals is concerned? Should he continue to hold the 110 shares that he's holding, accumulate more, or book profits?
He can continue to hold. Here, 1-year forward valuations are quite attractive. It's about 12 times FY27 earnings, and they are having a big factory that they're putting up. It's in some zinc gel batteries. So I think there also the opportunity is quite big. So he can continue to hold. And in terms of, as I said, valuations, it's not expensive. It's a small cap company with market cap just about 7,700 crores, but it looks decent to hold as of now.
Okay, all right. Decent as of now is a view on Arkin Chemicals. Schneider is the next counter that we're talking about, and Bhupendra has got the next question. He's bought 345 shares at a price of 775 or thereabouts. Should he hold or sell or buy more? He's a long-term investor, he points out. I guess the question is based on the current market price, so therefore let me go to you, Kush, on the charts. He's sitting on a sizable loss because of the kind of erosion in value that you've seen in Schneider. Should he add more the current price?
Advice, so Alex. However, if you see, the stock has actually taken good support near the 600, 595 zone. There is a positive divergence popping up on the weekly setup, suggesting that the near-term bottom perhaps could be in place, and the stock might attempt a move higher to the levels of 650 and then perhaps 680 as well in the coming week. However, given the medium-term trend, which is squarely negative on Schneider, I would suggest a stop loss near the recent lows of 575, 560. So keep the stop loss around that zone. If that is broken, the stock could actually go into a further TC on the way down. But as of now, it's a hold with a stop loss around the 575 mark. And things getting steady, the stock could actually gradually inch higher, and he could exit at a lesser loss.
Coming back to you, Kush, very quickly, just a clarification. You spoke about Adani Ports and you've given your call. If I remember correctly, you said hold. But would you add the current price? And we've got Alexis who wants to know, should he buy right now?
Well, he can. There's a good breakout, as I said, above the 1200 mark. Even if you take 1300, 200 day moving average as your target, the risk reward ratio is still favorable, better than 1:1. So, you could still at 1200 just lower your stop loss, and 1300 is your target.
Okay, so that's the view with regards to Adani Ports. Our next question is from Angad, who's writing in from Indore. He wants to know whether this is the right time to enter Avanti Feeds. Shaina, we saw a significant amount of downtick in this counter when tariffs were announced, and a slight recovery post the 90-day tariff pause, because they are shrimp exporters, and a large portion, in fact, of their revenue comes from the US. Do you think that this is the right time to enter something like an Avanti Feeds, considering the volatility in Trump tariffs that we've seen?
See, the Trump tariffs are likely to again hit us next couple of months down the line. It's just a pause. So I think it's extremely risky. I would avoid.
Avoid is a view on Avanti Feeds. The next company that we're talking about is Aster DM, and we've got Deepika Ramesh Kumar, who's writing it on YouTube and asking about this. She's bought at levels of she's bought at levels of 512. Quantity is 320, and the loss is about 5,000 is what she points out. It's not a very significant deviation from the current market price. Kush, on the charts, would you hold on to this one?
Absolutely, Alex. The entire healthcare space, and by that I mean, the hospitals per se, are actually doing rather well. So, while pharma is a bit of a no-no right now, or maybe being extremely selective, I think this space is doing very well. The rebound on the stock also has been very, very sharp and very smart. There could be a possibility that stock might consolidate here for some time, given that it's coming up, at a 510, 525 supply zone. But past that, the stock could actually inch higher to 555 and 575 levels also. So yes, very clearly the view at the moment is a hold on this one. I would suggest a stop loss near the 480 mark.
480. All right, we've got the next caller, Siddharth from Andhra Pradesh. Siddharth, we're running out of time, so quickly, can you tell us your question, please?
Sir, Ujjivan Small Finance Bank, sir.
Yeah.
I'm holding 4,000 shares, average price 40 rupees, sir.
Okay. What is your time frame?
Should I book profit or 2 to 3 years, sir?
2 to 3 years, right?
Yes,
okay.
Sir. Yes, sir.
Okay. Shaina, on the fundamentals, 2 to 3 years, bought at levels of 40, he's in the green. Should he hold?
He can hold for now, and he can look at higher levels to switch. The sector is doing well as of now.
Okay. It is time, in fact, now on the program we're winding down, and it's time to hit the rapid fire segment. So Kush and Shahina, this is a heads up for you. We're going to throw as many questions as possible at you over the course of the next 2 minutes. I'm going to start with a question from Prameet. He's asking about Agarwal toughened glass. I'm not sure if anybody has a view on this one. If not, just say no. Shahina, bottom levels of 133. Any view?
No.
Okay. HDFC Bank, I'm sure Kush is going to have a view on this. 1655 is the buy price. Smart up move in the recent past. Would you hold is a question. Bharat wants to know.
Absolutely. Continue to hold. Keep a shilling stop loss at the 1820 mark.
Okay, Rajkumar from Kolkata is holding Sky Gold at an average price of 4350. Now it is 435 because of the bonus issue. What's the view like, Shaina? Should he continue to hold?
Yeah, he can hold. He can hold with a stop loss close to about 320.
Okay, got it. Suzlon Energy, Shaina, coming back to you on this one. Partha from Kolkata is bought at levels of 67 a piece. Wondering whether hold, add or sell at this juncture.
I would say it's a switch.
Okay.
To what?
Switch to some other, maybe Tata Power.
Okay. Aventil Limited is the next counter. Rakesh from Hyderabad wants to know whether this is the right time to enter the counter or not. Kush, on the charts?
Yes, you can. The stop loss, that's the first one. The stop loss is at 119. On the upside, you're looking at targets of 135 and about 144. So yes, you can add at the current time.
Okay. Shaina, Sagility India, Vijay wants to know whether to hold. He's bought it at an average price of 50 rupees. He's got 4,400 shares. Should he hold?
I would say exit.
Okay, Heritage Foods is the next counter. We don't have the name. So, okay, Suman Kumar from Hyderabad wants to know whether this is the right time to enter or not. Kush, on the charts?
Yes, the stock's given a golden crossover, so you could consider, adding good momentum building up. Stop loss would be 405 and targets 435 and 460.
Okay, NTPC Green, last question. View on 6 months is being sought. Bought at levels of 88 rupees and 1 year, maybe 1 year target. Kush?
Definitely continue to hold stop loss at 102 and on the upside targets of 117 and 125.
Okay, all right. On that note, it brings us to the end of this edition of Ask Profit. Kush as well as Shaina, as always, thanks so much for joining in. Always a pleasure, and wish you a happy weekend. All right, to everybody tuning in, we tried our best to take as many questions as possible, and hopefully over the course of the last 1 hour, whatever we've taken has benefited you, even if your specific question was not taken. Thanks so much for watching. From Mahima and myself and the team that put the show together, thank you so much. Do stay tuned. This is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact, had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea?
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Hello and welcome to KYC, Know Your Company, a show designed to give the regular investor powerful, actionable insights into the fundamentals of a single listed company every day. And today we're going to talk about Federal Bank. It's in focus because there has been a reasonable amount of rejig, both on the leadership front, with Shalini Warrior was a key part of the leadership now choosing to step down. And you have KVS Manian, who was ex-Kotak Bank, who took charge in September of 2024, and now it's been 2 quarters since the time he's fully taken charge. What we're going to do is, of course, we're going to break down Federal Bank for you, and thereafter we're going to speak with an analyst to try and understand whether the commentary emanating from the company is reasonable in terms of expectations and whether it's achievable. We thought this is the better path to take. Because it will give us better perspective. There's enough commentary to talk about. So let's get right to it. What about Federal Bank? It's one of the oldest private sector banks in the country. 1931 was when it was incorporated. It was predominantly south-based, continues to be, operates through around 1500 odd branches. The focus largely is South India. That's where it gets a bulk of its market share from. The market share, it's one of the top 3 banks, both in terms of loans as well as deposits in South India. So significant presence in that sense. We had KVS Manian, who now leads the bank. I did speak about that. September of 2024 is when he took over. Why is this important? Is because he is driving a huge change within Federal Bank. One, he's played a key role in Kotak Bank earlier, and a key role in their transformation from NBFC to bank. He's expanded retail banking at Kotak. He's also led corporate and investment banking at Kotak. So those sides of the business he has deep experience in, and therefore will be important to understand what he is trying to do at Federal, which I will come to, and thereafter we'll speak about execution, whether it's even possible or not. Now, in terms of how the loan mix is, corporate and commercial is around 1.02 lakh crore, so around 1 lakh crore book, corporate and commercial. And then you have retail, which is a larger chunk. So 55% of the book is retail, around 45% is corporate. That's how the split is. The growth, as you can see, in retail is healthy and in commercial is healthy. Corporate is slightly sluggish. This is at least over the last year or so, and therefore these figures will give us a reasonable angle on what the company has done over the last 12 months or thereabouts. Within retail, where's the focus? Well, one is pure play retail, then there's specific loans, something like a gold, something like a business banking loan. So some of those aspects also come in, but this is more from a perspective to help you understand what are the segments that it currently caters to. If you look at the next graphic as well, we'll add, there you go, agri-allied CV, but very small, right? In CV, just 3,000 crore book, and MFI, just about 4,500 crore book, and then you have MFI, which is around 4,000 crore in terms of book size. The growth there is obviously faster because it's off a low base, and therefore something that we'll have to keep in mind to see how the strategy will evolve going forward as well. But that's how the bank has shaped itself up, at least over the last year and historically. More south facing, and this is how it's split in terms of segments. Now let's talk about the factors that we look at. We'll first start off by looking at the income statement. Thereafter we look at the balance sheet. We look at operational metrics because those are important, and we look at asset quality as to how that has evolved, and we'll rate each of these parameters. We look at shareholding, valuations, the street coverage, and the street credentials. We'll look at all of that, and thereafter give a comprehensive assessment on what this looks like. Let's first start off with the income statement. And mind you, it's a relatively small bank in that sense, and therefore you would expect it to grow faster than mid-teens, but that's what it's done over the last 3 years. In an era where growth has been extremely strong, we've seen just about a 14.5% growth on the net interest income number. Operating profits even more tepid at just about 11%. What's really aided profitability is the fact that you've seen a sharp rise in your, a sharp fall in your provisions number, which is aided profitability. The other piece also to know is FY23 was a relatively better year than FY24, because FY24, or rather FY23-24, have largely been better than even an FY25, because FY25 we've seen sharp margin compression, and we'll talk about that in the operational metrics, and that will also somewhere reflect in profitability. So NII may be slightly compressed in that sense, but yet a 14.5% growth on the NII account leaves something on the table to be desired, and therefore we'll give this a neutral. We'll also look at the balance sheet. When we're looking at the balance sheet, again, you'll look at the growth on the advances, gross advances front, it's just about 16.5%. So again, in an era where at least the last year or two, maybe the last year has been sluggish in terms of loan growth, but prior to that, for a year or two, there was extremely healthy loan growth in the system. So you would expect a bank size of Federal to probably go slightly faster than a 16.5%. You know, and deposits have been even more tepid. It's at 13.5% on the deposit growth front. Look at the CASA, and the CASA ratio is even more difficult in that sense. The CASA ratio is just about 30% currently. So overall, we'll give this a neutral as well on the balance sheet count. Not the best when it comes to the growth that's coming through in the system versus what a medium-sized bank ought to grow at. Let's last off look at one metric, you know, in that sense is the operational metric that we look at. And within operational, you look at how yield on advances have crept up. Not surprising per se, but it's definitely a healthy inch up in terms of yield on advances. If we look at the annual yield on advances, it's moved up from 7.8% in FY22 to 9.2% in FY24. This is also on the back of the fact that you would have seen an inch up in the repo rate from FY22 to FY24. Mind you, April, May of 2022 was when the repo rate started to get hiked, and therefore some of that also spilling over on the yields. But you compare that to a cost of deposits, it's gone up from 4.1% in FY22 to around 5.5% in FY24. And when you're looking at the cost of deposits even now, you'll see the deposit cost inching up from 5.84% in Q1. It's gone to 5.92% in Q3. So just in a few quarters, you're continuing to see that pressure with regard to cost of deposits, and that is keeping a lid on margins. And now this is where it gets interesting. The net interest margin number, which was at 3.2% in FY22, inched up to 3.5% in FY23 because you had the repo rate go up, but deposit rates did not catch up very quickly, and therefore you had a lead lag for about a year. Thereafter, you saw it come back down. You saw it come back down to 3.3% in FY24, the margin number, and thereafter we've seen even more margin pressure, as you can see in FY25, 3.16, 3.12, 3.11. And a lot of that has spilled over to the ROA number. Before I come to the cost to income, I'll talk about ROA. ROA, which was at 0.89% in FY22, inched up to 1.25%, went further up in FY24 to 1.31%. Why? Because of the credit cost number being extremely low. If you remember, in the P&L that we spoke of, the provisioning number was extremely low in FY24. If we have that graphic, let's put it out, because FY22 provisioning was at 1,222 crore, FY23 was at 750 crore, but FY24 was just at 196 crore. And that was the number that actually aided ROA more than anything else. But FY25, you're starting to see an unwind on that particular number as well. And therefore, you're seeing ROAs come off 1.27 in Q1, 1.28 in Q2, but 1.14 in Q3. So you're starting to see an inch down with regard to ROAs. Can those ROAs sustain? Because that will determine profitability for the company. That's something that we have to look out for. So operational metrics, not very impressive. Neutral on the operational metric count as well. Let's look at asset quality. And now this is key for a bank, right? Would you want your asset quality to continue to improve? Yes, for sure. And that is exactly what Federal Bank has done. A clear thumbs up on this metric. From 2.8%, the GNP has come down to 2.1% in FY24. And thereafter, it's further inched downwards. And this is, mind you, in a difficult cycle as well. We are seeing pressure in some pockets in the lending industry, and despite that, Federal Bank is able to hold up fairly well. So that comfort is available. While they're doing lower margin product, they are also being able to control asset quality. So clear thumbs up on that count. In terms of margins as well, among the top 5 private sector banks, Federal Bank trades at a considerable discount in terms of margins. So if it has to chase the top 5 private sector banks, it has to considerably improve its net interest margins. NPA also very similar trajectory carried. Now the net NPA is down to just 0.5% at the end of Q3 FY25. So a clear thumbs up where asset quality is concerned. Let's talk about shareholding, and this is where also it's quite interesting. You look at the FII holding. When I'm looking at it over the years, it's come off, but March of 2022, it was at 26.01%. It continues to remain at around 26.3%. So largely that's how it's played out. We have an interesting set of investors in the FII basket as well, and I want to quickly talk about that. You have IFC, which is International Financial Corporation, which directly holds 4%. And then has other funds through which it continues to hold maybe another 2 to 2.5%. So IFC Financial Institutions Growth Fund LP and IFC Emerging Asia Fund LP also hold 1% each in the company. So that's a decentish holding by IFC. Outside of that, you have Bank of Muscat India Fund. You have the Government Pension Fund, which used to own and some interesting names, obviously, as part of the old shareholding of Federal Bank, dated. But for the moment, IFC is the key large shareholder. Even among the DII basket, you have an HDFC mutual fund, which holds 7% in Federal Bank. So some good institutions which have a decent holding in the company from an investor perspective. So shareholding, neutral overall, no major promoter, but you have these institutions which hold a decent amount of shareholding within the company. That's one. Now, last couple of factors. Let's talk about street cred first. When we're talking about street cred, there you go. That's the last 1 month performance for Federal Bank. It's been a very strong performer when you're looking at it over the last year or so, 27% increase in the stock price over the last year. And we've also seen a decentish kind of return that the company has given over the last 5 years or so. In fact, the 5-year chart indicates it's been a multi-bagger, 322% returns from that 50 rupee mark, or rather it slipped even below 50. It was at 40, 45. It's currently sitting very, very pretty at 195. So it's made good returns for investors in that sense. And therefore, street cred has been rated as a thumbs up from our side. Let's look at valuations. This is again crucial because you have to look at valuations even from a perspective of how what's the kind of strategy that's been implemented. I'm going to quickly touch upon that. There's been a leadership change and there's been a strategy change. There's the leadership and strategy change now entails an improvement in margins. How are they going to do that? CASA ratio is going to go from 30% to 36%. They're going to improve on their CA composition from 6% to 10%. They're going to tap non-resident customers and non-South based customers. Those are two pockets of customers which they are doing well with. They're going to go outside that and tap those. Branches is going to be the way they're going to do it. 1,550 branches currently. They're going to hike it to 2,126 branches in the near term. They're also looking at therefore pushing higher deposits. Higher yielding assets is what they're going to do. Larger focus is going to be on vehicle loans, tractor finance, affordable housing. There's going to be an increase of fee income through forex, wealth management income and credit cards, and your cost to income is eventually going to come down from 50+% to 41%. That is what is going to lead to a target ROA of 2.2%. They're going to bring down cost of deposits. They're going to inch up yield on advances. They're going to increase fee income and they're going to do cost control on the top line. All of those should hopefully aid the ROA number. And therefore, it's currently placed in terms of valuations at 1.3 times, right in the middle versus some of the other mid to small banks. Slightly at a discount, or rather at a large discount to some of the larger private sector banks, and fairly so. If Federal Bank has to make that journey, it has to do a lot of execution, and if it does that, then likely it will command a premium in terms of valuations, and fairly so. And therefore, we'll give this a neutral because we want to see more execution, and whether this is realistic in terms of guidance or not, we'll obviously have an analyst, Rahul Malani, who will come shortly and speak to us about that. Last off is street coverage. Let's talk about that. 39 buy calls, 3 hold calls, 1 sell call. That's broadly how it stacks up. 14% upside. We'll give this a thumbs up. Very well covered and a decentish upside as well. 12-month returns. Now let's talk about all the rating parameters that we've just spoken about. Let's stack it up. There you go. So you've got income statement, balance sheet, operational metrics and asset quality has a thumbs up. And then you have shareholding, street cred, valuation picture and street coverage, and that gives us a 5.5 on 8 on our KYC ratings. So that's how it stacks up for a federal bank. Now let's talk, let's go straight across. We have Rahul Malani, Senior Research Analyst at Mirae Asset Sharekhan, who's here to talk to us about exactly this. Rahul, you know, huge transformation that's expected from Federal Bank. First off, I want to understand from you, how are you looking at the overall strategy? And let me ask you a blanket question on what you believe the execution risks are to this strategy.
Yeah, good morning, first of all.
Good morning.
So, if we look at the compare the Federal Bank with some of the private frontline banks, operational performance has been a laggard for the Federal Bank. After the leadership change, the bank has outlined its revised strategy with coming out with improvement in the levers, improvement in the asset mix as well as the liability mix, where the focus is to improve the NIMs and the fee income part, which will really drive the operational performance in line with comparison with the other frontline private players. So it's a tall task. Execution is key, as you outlined mentioned, because the bank is guiding for 70 to 80 basis points improvement in the ROA over the next 3 to 4 years. So we believe that at least 30 to 40 basis points is achievable, but 70 to 80 basis points is a tall task. While in terms of performance over the next 2 years, we believe that for the strong re-rating in the stock, there is a need to improve the risk-adjusted returns that should be comparable with the front-end private banks. So outline strategies in line with that, in line with improving the risk-adjusted returns, taking into comparable to the private banks. But it will be a tall task over the period. But we acknowledge that we have to watch out from quarter to quarter where the execution is happening on the ground. And as and when the operating metrics starts to improve gradually over the period, there would be certain partial re-rating over the next 2 years in this. In terms of valuations, valuations are reasonable for Federal Bank. While overall execution is at this point of time is key, and at this point of time we will like to give a positive probability to execution, because after the leadership change, almost we have a veteran from the banking sector who has almost experience of more than 3 decades working in the Kotak Bank. So we will like to assign a positive probability towards execution, and we will ramp up we will look at quarter-to-quarter improvement in the operating metrics as and when it starts to report in the performance.
Taken. Rahul, one key concern at this point is with regard to margins. They had spoken 4 quarters ago under erstwhile leadership that margins will not fall below 3.2%. It thereafter fell at 3.19. They said a few basis points here or there. Now it's fallen at 3.11%. The margin pressure seems to continue. Now you have a repo rate cut as well, which has come through, which should further accentuate the problem. How should one look at margins for Federal Bank, and is that at all a concern for you from an analyst perspective? What are you building in terms of the margin number for FY26?
See, clearly in FY26 there will be a margin compression of around 20 to 25 basis points if there is a 100 basis points cut in the calendar year overall for the Federal Bank. So clearly there will be a margin compression because 50 to 60% book is linked to the external benchmark rate. And then repricing. If you look at in the last higher interest rate cycle, when the rate starts, when the RBI started to increase the rate from May 2022, we had seen a sharp increase in the yields for Federal Bank, because they are more sort of their higher share of book is linked to the external benchmark rate, and then they are the revision time period is relatively smaller for the Federal Bank. So clearly, in terms of this quarter four also, you will see a much higher compression in the NIM for Federal Bank. Over the medium term, as I alluded that when company is speaking about improving the liability mix in the form of improving the CASA share from 30% to taking it to 35-36% levels, and then start focusing on mid-yielding assets, like for example they will now focus on the used CVs, used vehicles, lab, tractor financing, micro lab loans. So which they are earlier didn't do, which have certain partially higher yield, but in terms of risk also, the risk is manageable other than with the unsecured book carries. So risk is lower than the unsecured book, but partially higher in yields. So overall, over the medium term, at least from the at least 2 to 3 quarters after that, we should see if that execution is happening on the liabilities or the asset mix, and then we can decide upon the same.
Point taken, but 25 basis points is a large decrease to the already established floor that they had guided for. So you'll see margins fall below the 3% mark. And how realistic is this increasing of CASA from 30 to 36%? Are we building in too many risks into this, Rahul? Because you have an ROA problem then. You would likely say that ROA in the mid to near term has peaked, right?
Yeah, your conclusion is right that ROA has peaked in the near term, at least for the FY26 versus compared to the FY25. But I have spoken of 20 to 25 basis points over the period of cycle. That is when I'm taking into account 100 basis points compression. 100 basis point cut in the repo rate cut. So overall, in this quarter, we should see 5 to 10 basis points compression in the margin for Federal Bank. And at this point of time, there is no lever because they are into their investment phase. OPEX should be elevated. Credit cost is already at the rock bottom, around 35 to 45 basis points of credit cost will be there. So there are no certain lever to offset that offset that compression in terms of power. So basically,
yes, Rahul, complete your point, please.
So basically, I don't find any levers to counter that NIMS compression. So yeah, there will be a ROA compression led by NIMS compression in the near term, in the at least coming quarters.
Point taken. Faster growth, Rahul, is what Federal Bank offers. But when I'm comparing valuations of a Federal Bank with some of the PSU banks, some of the PSU banks looking better, all on margins, even maybe a bit more comfort with regard to ROA metrics. You also, so because you don't have ROAs peaking, or rather peaked in the past and now falling trend line on ROA, that's not reflective, right, on some of the PSU banks. More comfort, more safety. So is Federal Bank therefore a decent bet at this hour, given that you have 1.3 times price to book is what the stock is trading at, and you have so many risks which are yet to play out?
Basically, in the near term, we believe that the valuations are full for the Federal Bank.
Okay.
But over the medium term, as I alluded that at least if there is certain improvement in the asset mix as well as the liability mix, NIMS improvement will be there in the franchise, which will lead to higher operating profits. So which can lead to improvement in the ROAs. From that perspective, if we take a bet for at least 2 years, then we may see that the Federal Bank appears to be a reasonable bet for at least for the medium term perspective. But as you alluded, in the near term also, basically all the mid-sized private banks would see higher compression because of the weak liability mix, weak liability franchise compared with the large private banks or PSU banks per se compared.
Point taken. Thank you so much, Rahul. Rahul, one quick question. If margins were to compress by 25 bips, what will the ROA therefore compress by? And of course, credit costs start to normalize.
We don't see ROA falling below 1% for Federal Bank.
Okay. Point taken. Okay. Thank you so much, Rahul, for coming and giving us that perspective. And you know, completely out of time on this edition of KYC on that note. Hope you found this helpful. Hope you found this insightful. But completely out of time from myself, everyone who puts the show together. Thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
Role, responsibilities of board, its committees. Now, disclosures are periodic and event-based to ensure transparency and information symmetry in the market. SEBI has specified periodic disclosures of certain information, such as quarterly disclosure of shareholding pattern, compliance with corporate governance requirements, financial results, and deviation and utilization of funds. To prevent information asymmetry, there are also event-based disclosures of material events of information, such as disclosure of material events within the specified timeline, disclosure of events which may have material impact on the performance or operations of the listed entity. Such disclosures ensure that the stakeholders have equal access to material facts and information related to companies' operations and performance. This promotes level playing field by bridging the gap between company insiders versus outsiders and the better decision making by the investors. So some regulatory measures, instances of false, inadequate, inaccurate, misleading and delayed disclosures of material information by listed entities leads to information asymmetry in the market. In order to bring more transparency and to ensure timely disclosure of material events and to facilitate a uniform approach in determining materiality of events of information, and after consultation with stakeholders, we have amended the LODR regulations to introduce quantitative threshold for determining materiality of events and information. Similarly, guidelines have been made on timelines for disclosure of material events of information. To address the issue of perpetuity of special rights and to do away with practice of permanent board seats, we have brought in periodic shareholders approval, which is once in 5 years, for any special right granted to a shareholder of a listed entity. And also periodic shareholders approval every 5 years for any director serving on the board of a listed entity. To strengthen the independence of independent directors and enhance their effectiveness in the protection of interests of minority shareholders, SEBI has mandated that at least 2/3 of the members of the audit committee must be independent directors. Now, the ease of doing business is important, and there have been some initiatives recently. To promote ease of doing business, SEBI has introduced single filing system for listed entities. Tech-enabled single filing system now eliminates the requirement of filing the same documents across multiple exchanges. With the advent of technology, there is substantially reduced reliance on newspapers for getting information on financial results. Thus, to reduce the compliance burden, SEBI has made it optional for listed entities to publish detailed newspaper advertisements with regard to disclosure of financial results in newspapers. Further, to promote ease of doing business, timelines for disclosure of outcome of meeting of the board of directors that concluded after trading hours has been increased to 3 hours from earlier 30 minutes. Similarly, the timeline for disclosure of litigations or disputes involving claims against a listed entity has been increased to 72 hours from 24 hours earlier, subject to maintaining such information in structured digital database. And recently we have provided flexibility for companies by allowing either assessment or assurance of BRSR core disclosures. This reduces compliance burden while ensuring credibility of data reported under BRSR core. ESG disclosures for value chain are now voluntary and applicable from FY 25-26. But is that enough? So what's the way forward? As a regulator, SEBI has laid down a comprehensive governance framework on the corporate governance. We have taken measures to protect the interests of investors, at the same time tried to facilitate ease of doing business. But to achieve the desired objectives, we need to have a collaborative ecosystem. There needs to be a balance between regulation and ease of doing business. We are conscious that over-regulation can stifle growth and innovation. At the same time, too little regulations can also lead to decline in trust of stakeholders and adversely impact growth. Thus, there is a need for optimum regulation. Regulations need to be rationalized by removing what is no longer relevant and reducing overlaps. Stable and adequate financial regulation can help in creating a high-trust environment, increase attractiveness for investors, and promote economic growth. What we can do about effective self-regulation by entities? We need to move from a thinking of minimum compliance to maximum governance. Boards must rise above routine and ask difficult questions. and auditors and independent directors must act as gatekeepers of integrity. Our regulations, which are LODR, lays down the principles which outline the essence of expectations of SEBI from the boards. There is an emphasis on doing the right thing for the right reasons, asking the right questions, constructively challenging management, demonstrating sound judgment, possessing an independent perspective, and avoiding groupthink. Corporate governance is not a matter of regulation alone. It's a matter of conscience. SEBI will continue to expect higher bar on governance, but true and lasting change must come from within the corporate boardrooms and cultures. And Mr. Bajaj was actually mentioning, he was giving a glimpse of what they are doing about their own organization cultures. And there are several good practices, and those need to be carried forward, those need to be propagated. There is a need for industry to adopt RegTech solutions, which is use of technology-based solutions for complying with regulatory obligations that can help in improving compliance reporting, streamlining processes, and improving the operational efficiency. SEBI and first-line regulators, which is exchanges, are deploying SupTech solutions for effective and enhanced supervision. The use of technology by regulators has been very helpful in detecting early signs of market abuse and non-compliances. Harnessing technological advancements could further reduce the potential blind spots, market misconduct, and instill a culture of continuous compliance amongst regulated entities. The governance is not about ticking boxes. It's about building institutions that can be trusted for years and decades. It's not an easy path, as it involves sacrificing some short-term gains. But it is the only path to have a sustainable growth and development of a corporate.
IDFC First Bank's board has approved a fundraise of up to 7,500 crore rupees from two of its investors. We spoke to V. Vaidyanathan, MD and CEO, about the fundraise and next stage of growth for the bank.
We felt that the bank will need capital for the next phase of growth, because the phase one is what, let me say, was a setup stage. Still setup stage, but next phase we can move over to profitability in a very meaningful way, and we need capital. From that point of view, frankly, I spoke to maybe one or two more people also, but these people, I know them for like 10, 12 years now. I have confidence in them. They are like wonderful people, and RDA, of course, is a iconic institution.
Mr. Vaidyanathan, Sajit here. In the last 3 years, you have raised almost 14,000 crores. It's a huge dilution which is coming on your equity as we speak, and at every time you have raised funds, if I can take some of the numbers, 95 rupees you raised 3,000, last year at 80.63 you raised 3,200, and now at 60 you're raising 7,500. 14,000 odd crores and at a declining price. The shareholders will be a little worried, saying that you're diluting very fast and at a price which is lower than the last raise.
No, before that also we raised two.
I'm talking about just last 3 years alone.
I know. I'm saying over and above that, prior to that, we raised at 57 also, we raised at a lower price than that also. We raised at multiple prices. But the good news, Sajid, is that all of these raises have all been above book value per share. All. So every one of them adds to book value per share, because you're giving new shares at a higher price than the book value. So net, the book value per share after this transaction will touch close to 53. But that's one point. That's one part of the story. Now, I think a more fundamental question should be that why you're raising capital, so much capital, and why you're raising so frequent capital. Is that the question simply?
Yeah.
Yeah. Now, I need people to understand this basic fact that if you look for a bank which is like 35 years in existence, they're already running to peak profitability. So their capital is almost equal to the return on equity. The growth is almost equal to return on equity. They can keep on forever. But for our bank, starting from zero. So for a bank which has a zero return on equity to start with in 2018 or 19, So, right now, let me call it around maybe 7-ish or so, if you take out MFI impact. So your return on equity is 7, growth is 20, the gap has to come from capital. But the good news is that 0 has moved to 7. We believe 7 will come to 15 or 16 also. But it's a phase. Early stage bank, every bank starts low and then becomes, backed like ICICI or HDFC. Think about how ICICI raised capital 20 years ago. They raised $5 billion in 2005, so 7, $3 billion, something like that in 2005. That's one of the capital initial stage people raise.
The capital raised by those banks has not been on a yearly basis and at a price which is, declining in that sense, right? So that's the worry.
That's not a fair question. If you go back and see, say, ICICI Bank, etc., 2005, 2007. So imagine that time, like 2007, to raise $5 billion. I'm not referring to ICICI Bank, another bank. The point I'm trying to tell you is that early stage bank needs capital, short answer. You just need capital because return on equity is lesser than growth of the bank. But the good news is, like I told you, it's coming at a premium to the book.
Mr. Vaidyanathan, just a quick question around the OPEX side of the story, because that is one complaint that a lot of analysts have been pointing out, that the bank, yes, over the course of this financial, FY25 at least, you've seen that OPEX trend down, at least OPEX growth trend down. It is still higher, of course, but the rate might be slowing down. I want to get a view, is this also one of the reasons why you would need a more capital infusion?
I think, Vishnu, you're connecting some...
Sure.
Something else to something else.
Sure.
End of the day, your return on equity is lesser than the growth of the bank. That's it. Now, whether as far as OPEX is concerned, it is coming down. This quarter's results yet to come out. So don't take me in a direction where I have to reveal this quarter's results.
Yes,
so please,
of course.
I can't go there. That is not the agenda of this discussion. We are talking about capital raise in this context, but this is nothing as simple as saying that return on equity is less than the growth of the bank. But the good news is, let's focus on why do such seasoned high quality investors want to invest 7,500 crores? Let's be clear about that. So there is some reason, right? And I believe that if they are going to make money in this transaction, I hope they do, then everybody makes money.
Okay, just one point of addition. So the investor presentation that you released to the exchanges that points out that one of the goals is, of course, to fund the next phase of growth, as you have already said in this interview as well. One line caught my eye: 20% over the next few years. What is giving you that confidence? Because not very long ago there was a lot of caution in the Indian banking system.
No, if you see our bank, the first 3 years we did not grow the loan book. First 3 years. 2019 we merged, FY19, 20, 21, 22 we did not grow. There's a reason, because we had a very high credit deposit ratio and a very high credit, like 169% credit deposit ratio, including corporate bond issuances, and we thought that 136%. So if that's high credit deposit, we could not give any more credit. We did not want to give, and we grew deposits the first 3 years. But that phase is over now. Now our credit deposit ratio is incremental lending only 75. We can afford to lend. So now we're in the growth phase. So I feel that 20 is not like a big deal for a bank which has so many capabilities. Main thing is asset quality. If asset quality is good, you can grow. And our asset quality, gross NPA is less than 2, net NPA is less than like 0.6 or 0.5. And the credit cost is so much under control, except the MFI problem, which we'll talk separately. So if the bank is good, growth opportunity is there, asset quality is good, you can grow.
Mr. Vaidyanathan, while you mentioned that for the next few years you would be looking at a growth of 20%, the capital raise which you have done of 7,500 crores, are we to assume that for the next few years you will not be coming back to the market for capital raise because this capital is enough for that growth for over the next 2 to 3 years or so?
I think so, because after all, this is a large raise. One of the purposes of taking a large raise, to your earlier question, Sanjeev, that we were talking about, every year the bank is raising capital. I don't deny. But do you think I have a choice? Do you think anybody had a choice? It's a startup bank and it has to grow to reach a particular level of return on equity. Till that time it has raised capital. So for 3-4 years, we have in 5 years, we raised 5 rounds of capital in 5 years. But good news is that people are giving us capital. We have made ourselves attractive for investors enough for fresh people to look at the bank, see the model, see the economics, see the culture, see the tech, see the growth, see the deposit growth. So people are seeing all this and fresh money is coming into the bank. So I'm really happy that the bank has been made attractive for fresh investors and 5 years in a row. Now that we raise big capital, they will not come to the market for a foreseeable future.
And when you said that you're looking at improving your return on equity because that's what is the focus, is there a level that of return on equity that you are aiming at, and is there a path to that?
Of course. I'm glad you asked that question. It is the important thing. So when I start a company at 0, you reach 7. Now after 7, you're at 15. So we have to go. There's no question. And any good bank should be posting 15 plus return on equity and should be, but there's no choice. You have to start somewhere. We start from 0. We'll touch 15. It has to go there. But path is like simple. We are already making good money on the lending side. We have good economics. Adjusted for risk also, we're making good money. We are losing money on liabilities because it's a new bank setting up branches and all that, and credit cards. Both these businesses, every year they're losing lesser money than last year in a percentage sense, as a percentage of book.
And this 15% that you're targeting, is it next 2 to 3 years? Is that the timeline that you're looking at?
We don't put out very specific year-by-year guidance like that, stuff like that, because we are running a bank and, but directionally we're heading there.
Okay. I want to take one last question, Mr. Vaidyanathan, and that is on.
But if you think of all the even iconic institutions, like the well-known banks of India, every institution starts from 0. That's how every institution starts. So, but good news is bank is catching up very fast. Just to give you an idea of how powerful the machine is, our operating profit have now touched. Last year has touched close to about 6,000 crores. It was less than 1,000 crores. In 2019, it was 750 to be precise.
Yeah, I was looking at the presentation. It said about 6x, I think, between FY18 and now.
Yeah, 8x. 8x is the deposit growth. Deposit growth is 8x.
Got it. Well, okay. Let me ask you one last question, and this is the MFI point because that's something that's been mentioned a few times in this conversation. I wanted to get a sense. A lot of expectation was that by Q4 you would have seen the end of the problem, and Q1 you would have seen some amount of normalization. Now I know this is pre-results, so you can't really give specific guidance, but are we to expect that before the second quarter you would have most of the system would have gotten over this MFI hangover? Because the reason I'm bringing this up is because some state governments have also taken certain actions which are sort of prejudicial to the broader microfinance segment.
So because results are around the corner, I'll take nothing. So take none of my comments as this quarter's comment. Let's stick to what prior comments. Yeah. We have already guided that Q4 will be will be the highest credit cost because of MFI. It will peak, and we said that Q1, Q2, Q3, Q4 should come down. And these are 2-year loans. Already 1 year has gone by. We stick with what we said. Rest wait for the results to come.
All right, Mr. Vaidyanathan, thank you so much for taking time out and talking to us, sir. Pleasure talking to you.
Thank you. But on a closing note, I must say, since the agenda of the discussion was more about the capital raise, I want to just say that this is a very momentous occasion.
Yes.
To raise that kind of capital in the global environment the way it is, with all kind of crisis and chaos all over the place, for investors to give this kind of capital to the bank is really, we made the bank an attractive place, and I'm very confident we'll live up to it.
Well, on April 9th, 2025, the Reserve Bank of India's Monetary Policy Committee reduced the repo rate by 25 basis points to 6%, marking the second consecutive cut following a similar reduction in February 2025. And the reason for the cut was primarily to stimulate economic growth amid slowing GDP and global uncertainties, including tariffs, in fact. The MPC also changed their stance from neutral to accommodative, hinting at further rate cuts in the future. But to understand the effects of this on a deeper level, I'm being joined by Shweta Dabtardar, Vice President, BFSI Elara Securities, and my colleague Harsh Sayata will be partaking in this conversation too. Welcome, Shweta. Thank you so much for giving us your time. Let me set the stage for you by asking, yes, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and who would this impact the most? Shweta? Shweta, can you hear me?
Yeah.
Okay. Okay, no issues. Harsh, why don't you give us a sense of what are the implications of a rate cut? Yes, a rate cut is good. And when the RBI's governor was giving his speech, he mentioned that he is cutting these rate cuts to ease liquidity because there's a slowing GDP growth as well. But we've gotten Shweta back. And Shweta, are you with me now?
Yeah.
Okay, amazing, Shweta. Thank you so much. As I was asking you, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and how would this impact, who would this impact the most?
Okay, clearly having
okay, yeah, no problem.
But okay. So while they fix that, quickly onto your question.
Yeah.
So yes, a repo rate cut would likely has already in fact translated to deposit rate cuts at lots of major banks.
Correct.
We've seen ICICI, Axis, HDFC, and an SBI even come out and say that they've cut the deposit rates. So one is you'll start to see deposit rates come off, and you'll also see loan rates come off. So any external benchmark loan rate should ideally be coming off by 25 to 50 basis points already. MCLR, which is more linked, and that's again another type of linked loan, that may take some amount of time to come off as the cost of funds of various entities start to come down. But the immediate translation will be deposit rates coming off. The other immediate translation will be NBFCs benefiting from a lower cost of funds. Both of those should translate pretty much quickly.
Sorry. Oh, Shweta is back again. Let's try again. Shweta, can you hear me?
Yeah, I can hear you.
Okay, okay. So Shweta, as I was asking you, and this is my third time, I really hope that you get my question now. How do you think the repo rate cut is going to affect the margins of major banks, and who is this going to impact the most?
Yeah, so I'll touch base on NBFCs because that's where my expertise and forte lie. So as far as 50 bips repo rate cut is concerned, it is determined by three factors. So one is fixed versus floating rate loans as far as NBFCs are concerned, then funding mix, and lastly, the way these NBFCs can transmit these rate cuts. So NBFCs factoring in 50 bips repo rate cut, the ones with fixed rate loans, say for instance, Bajaj Finance, SBI Cards, Cholamandalam, these will see stable yields and lower borrowing cost. So any NBFC with fixed rate loan book will benefit in the near term as far as rate cuts are concerned. And NBFCs with floating rate loan book will have a certain lag and will see certain pressure on net interest margins in the interims. But effectively, a 50 bips rate cut will definitely translate into over 20 to 40 bips kind of cost of fund reduction for NBFCs.
And Shweta, Harsh also joining in, how much of that will translate or get transmitted in your understanding to the consumer? Because that's the other thing which the governor has alluded to.
Yes, so as you rightly mentioned, there has to be transmission that has to happen through yields. And I think we are already sort of getting there with banks already beginning to cut their deposit rates. We are also expecting and hoping it will flow through and transmit through lending rates as well. But we have to be cognizant about a couple of factors here. One is we know that we are coming from a scenario where risk weightages had turned higher for NBFCs. But alternatively, on the positive front, the liquidity constraints, the liquidity scenario is sort of turning in favor of NBFCs. So although risk weightages had risen, but given the fact that liquidity scenario is supportive and juxtaposed to that repo rate cuts, I think that definitely bodes well for NBFCs as far as their funding scenario or funding situation is concerned. So I think if the funding scenario is slightly turning favorable, then highly likely we'll see transmission also happening through yields. So ultimately, the consumer should definitely benefit. As far as, like I mentioned even earlier, in the interim periods, you will see consumer loans, consumer durable loans, personal loans, vehicle loans benefiting more from the rate cut scenario.
Point taken. And Shweta, what about the outlook from an asset quality perspective? What's playing out? You're seeing some spikes in certain NBFC counters, microfinance in particular. It seems from a stock price perspective seems to have bottomed to a certain extent. What are your checks indicating both on microfinance? And I also want to highlight that in December 2024, Ilara, you guys came out with a report and suggested that CV might also be under some bit of pressure in quarters going ahead. Any concerns on any of these books and how do you see it play out?
Yes, so lead indicators definitely are building in a slightly positive scenario as we usher into New Year. I mean, we are already into New Year. But having said that, while headline buckets, so say 30 DPD, 90 DPD, headline GNPA still or headline delinquencies still remain on the higher side. But the good news is the forward flows or the delinquency flows into NPA pool, into write-off pool is definitely substantially declining. So that is a positive indicator in terms of anticipation of lower slippages. And therefore, we have started building in slightly modest credit cost going forward. Coming to sector-specific scenario, so as far as microfinance is concerned, clearly the recovery is still 2 quarters away. Perhaps H2, beginning of H2 of FY26 fiscal will be a better, perhaps will provide a better picture on how things are turning around on asset quality front for microfinance. For now, delinquencies continue to remain elevated, although there has been improvement in collection efficiencies. But then it's too premature to sort of build a positive scenario there. CV financiers, you're right. We did some channel checks pan-India, which are alluding to the fact that bounce rates or early delinquencies still remain on the higher side. But the growth scenario, so as far as vehicle finance growth is concerned, is slightly tapered. But growth scenario as far as home loans, LAP, consumer loans are concerned, so there we are building in strong growth targets. So I think diversified NBFCs, even though likes of Chola, Shriram are CV focused, but their non-CV portfolio is going to drive growth. So definitely net scenario looks pretty healthy in terms of growth. Asset quality concerns remain, they still linger. But yeah, as we have entered into a scenario where incremental flows are curbed or have been under control, so I think it paints a positive picture going forward.
Right, Shweta. Thank you so much. A positive picture overall, although asset quality remains a concern, but we're hoping that that eases down soon as well. And with that note, Shweta, thank you so much. We're running out of time, but we really do appreciate your time with us. And viewers, you stay tuned to NDTV Profit as there's a lot more lined up for you right on the other side.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has
Market stage, a stellar recovery to trade near day's highs. Nifty gains roughly 350 points from the day's lows to trade about 23,650 mark. The Sensex also above 77,700 mark. Nifty Bank as well as the Nifty Finance and Consumption lead the sectorial action, while the Nifty IT bears the brunt yet again, this time backed by fundamental quarterly results. Angel One tanks in trade after a disappointing Q4. Income drops 21%, while the net profit is down more than 48% in this particular quarter. Waaree Renewables, on the other hand, is up 11%. After strong Q4 numbers, net profit soars 82% for the company. Nifty IT as a whole is under pressure after Wipro posts a weak Q4 weakness extends across the mid-cap players as well. Sonata Software falls over 7% after they've given an update and a Q4 revenue warning as well. All eyes on Infosys, though numbers are due later today. IDFC First Bank board approves a fundraise of 7,500 crore rupees from two of its investors. We speak to CEO V. Vaidyanathan to understand the rationale and more. ABB India making smart moves in trade, up almost 4% after international parents suggest stronger than expected order book growth in this particular first quarter of FY25 for the company. Overall orders is up more than 5%. We bring you more details on the show. Hello and welcome. My name is Puneet Zaveri. You're watching Profit Buzzers right here on NDTV Profit. Let's first look at the market because we've seen a very positive move and so-called recovery essentially in the Nifty today. Currently trading at about 23,705. And we spoke in the morning on the F&O segment as well that while 23,300 was one of the key levels to watch out for in trade yesterday, we ended roughly about 23,400 odd levels. It's been a very smart recovery. It was about the next key level at least to watch out for was 23,600 and we've decisively moved past that as well. Let's also look at the contributors for the Nifty today because we've seen the banking names as a whole being very positive, specifically for essentially the Nifty, and we've seen ICICI Bank as well as HDFC being the top contributors on the Nifty today, while on the other hand some pressure seen in the IT space as a whole, but it's not enough to drag the Nifty in the red. So very positive move, almost 300 points now on the Nifty. Let's also look at the mid cap and the small cap indices as well because across the market today we've seen some smart moves in some key stocks based on news flow as well as positive momentum from the traders. Mid cap 150 currently underperforming the benchmark, while the small cap as well we could see a similar reaction as well, and there you go, just about 83 points, 0.54% up. Let's look at the sectoral heat map though for the Nifty, and we've seen spoke about how the financials were in the top gainers in trade today. We've seen the Nifty Bank, Nifty Private Bank as well as the Nifty Infra up in trade today. Some pressure of course on the Nifty IT, and we'll discuss that during the show as well. Apart from that, just finally let's look at the Nifty 500 now, the gainers as well as the losers specifically because we have seen a lot of moves. Sonata Software, we will be discussing that in the show. They released a press release yesterday effectively mentioning that its largest client will have some revenue degrowth in this particular quarter, so that will get impacted. Restaurant Brand Asia, though, very smart move, 8% up after its QIP over the last month. Delivery also trading in the greens as well. GMM Pfaudler is the other one. Equitas Small Finance Bank is a surprise because we've seen the update for quarter four for the bank also. It's not the greatest, and there is expected some pressure on provisioning, but today it's up almost 5%. On the other side, just some pressure on the chemical name like Archean Chemicals seen on the BSE 500 as well on the losing side. We also have G. Chokalingam, who's joining, the founder and MD of Economics Research. Mr. Chokalingam, thanks so much and good afternoon for joining us. I just want to start off with your view on the market because we see very strong move on the Nifty today. How are you seeing the current levels of the market, and because you've seen some positive move on the banking names as well. So just to start off, your view on the banking names.
Yeah, first on market, this is what I've been saying for last few weeks. We did not panic on US tariff war because the two economies which would be most impacted would be US because almost everything getting into the country would be taxed at higher rate. And second, China, everything it exports to America would be taxed heavily, multifold. So these are the two economies which would be impacted badly. And in between you have India. It is very safe because your domestic demand and IT service exports form 90% of your GDP. Our goods export is only 10% of our GDP, and within that 20% of overall exports to America. So only 2% of GDP is exposed to American export, and therefore we panicked and it was unwarranted. And I believe unless IT service exports are touched by US through tariff or non-tariff war, Indian market is going to see significant recovery. Added to that, global pain always leads to oil price crash. Oil is already down about 27%, which gives tremendous help to Indian market and economy. So coming to banking sector, most sectors, if you look at the Nifty or Sensex, you have about 8 broad sectors constituting these two benchmark indices. like auto, cement, etc. Now, if you see these benchmark indices, sectoral constituents, most sectors have what I call single-digit growth syndrome. IT services expected to grow poor single-digit, the dollar revenue, automobile sales volume and single-digit, FMCG single-digit volume growth, then cement also single-digit volume growth. So among many of these sectors, when you see the growth, single-digit growth syndrome, banking sector is the only sector still giving you optimism in terms of double-digit growth in the credit base. 2 days back, the most reputed domestic rating agency also mentioned that 11 to 12% would be the banking credit growth. So that is the reason the banking stocks are doing well, and I believe FY26 banking sector would be one of the few sectors to outperform both Nifty and same sides by a significant margin. The other tailwinds are inflation rate crashing, and therefore you can expect a significant cut down in the interest rate. Oil prices down, that also would ease the inflation pressure. So FY26 will see aggressive rate cut as well by the RBI. So all this would mean too good for the banking sector. There will be marginal rise in the asset net NPA, but it is manageable if you see from which level we have come down from say 2017 or 18 financial year to now. There are tremendous progress that is not going to be disturbed. So therefore, banking sector will do well, and within that, most probably the PSU banks will do well because of the solid branch network, which is helping them to consolidate and retain the low-cost deposits, namely CASA. That has become the key trigger for performance now. So that's my view on the banking sector.
Right. And thanks, Mr. Jokalingam, for the detailed view. But let's stick with the banking space, because IDFC First Bank's board has approved a fundraise of up to 7,500 crores from two of its leading investors. Now let's go across to my colleague Harsh to understand who are these investors and how are the bank's plans to raise these funds and what could be the utilization going forward. Harsh.
Where IDFC First is concerned, they've done a fundraise, 7,500 crore fundraise, around 4,900 crore to be infused by Warburg Pincus, around 2,600 crore by Ardia. So marquee investors coming in at 60 rupees a share. Now, in terms of how this is being done, it's been done through a CCPS, which is a compulsorily convertible preference share. Each preference share will be converted into equity share and therefore is equivalent to equity share. The conversion, post-conversion, Warburg will hold around 9.5% equity in IDFC First. Ardia will hold around 5.1%, and the book value currently is at 52.85 post the infusion of money that's come in, and therefore it's happened at around 1.13 times price to book. Now, one thing to be mindful of is IDFC First has raised money in 2023 and 2024 at far higher valuations. Something to be kept in mind. They've raised at around 70 to 90 rupees a share. So again, that is one thing to be kept in mind. They've done around 6,500 crore of cumulative equity raise back then as well. But this fresh equity raise happening at 60 rupees at a price to book which is just about 1.1 times. So again, that's one thing which really stands out.
Got the view, Harsh, and thanks so much for giving us all those details. Mr. Jokalingam, coming back to you first, we spoke about the banking space as a whole, but IDFC, last three fundraisers, my colleague mentioned, at 95 rupees, at 80 rupees, and now at 60. What's your view specifically on the bank? Do you think that this fundraise will be beneficial? Should investors buy into the stock right now, or are you cautious?
I used to be very cautious before severe fall in the stock. But to be fair to the stock, now the stock is already down substantially. And in March quarter, the credit growth also around 20%, which is substantially higher than the industry growth. The only problem is that, this bank used to grow upward of even 30% in the past, distant past. And because of the whole industry growing at around 11-12%, and also the base effect, the growth in business has moderated substantially, which is reflected on the stock price. And another big problem is that the new banks which started 3 decades ago, they had a very low industry credit base. And all ICICI, UTI Bank, that is Axis Bank, all these banks when started, including HDFC Bank, the industry credit base was around 7 lakh crore rupees, just 7 trillion rupees. Now it is upward of around 140 lakh crore, which is very difficult to grow at a solid double digit. And therefore, IDFC also suffers from that. The advantage which the other banks had, it could not have, this bank could not have it. Now, other problem is that the equity base. Its equity base is so huge, to command 2.5, 3 times price to book value, it has to grow the credit by very big margin. I mean, much more than even this 20%, which is also very difficult. So, in a nutshell, yes, one can buy the stock definitely for 10 to 15% upside, because as I mentioned, the whole banking industry has a very good tailwind, and IDFC Bank also would be able to benefit out of that.
So, Mr. Chokalingam, for the long term, what's your preference specifically? Is it mid-sized banks or do you prefer large caps? And any names if you can mention?
Yeah. For short to medium to long term, I would prefer Bank of Maharashtra to IDFC First Bank. The stock is already down substantially, 35%. I think this is a great opportunity to buy the bank. I've been tracking the banking sector from 1992. But I have not seen such a small bank, which used to be a small bank, has grown its business, and also maintaining a superior asset quality. Very rare to see the progress. Once upon a time, it used to depend on government for infusing the capital for its own survival. Now it has come a long way. Net NPA is 0.2%. Hardly there are only 2 or 3 banks have that kind of net asset quality, net NPA, being very low. And such a best asset quality, only 2 banks have. And this point, the outstanding net NPA is a fraction of quarterly profits. So it is easy to make even zero net NPA. I would love the management considering that. And secondly, look at the low cost deposits. This is a bank which has not slipped down badly on retaining the low cost deposit. That is a problem for small to big bank now. And particularly the banks which have gone for digital business, they are suffering, and they understood the importance of having a branch network to retain the CASA. And there also it scores. And March business numbers are already out. And Bank of Maharashtra has beaten the industry credit growth by very big margin. And it looks very attractive. I think this is one of the finest banking stocks in the entire sector. And I may be wrong, it can beat most listed banks in this current fiscal year.
So very positive view specifically on Bank of Maharashtra from Mr. Chokalingam, but the IT pack as a whole, and you just mentioned at the start of the show, is under pressure. Let's pull up a Wipro and a one-year chart of Wipro as well, because it's not been something that's rewarded investors very well. Now the company is in focus after its Q4 earnings. Now the company mentioned revenue largely flat. That's what brokerages are also estimated, but essentially, it's the deal wins haven't transpired to revenue growth in this particular quarter. Margins, EBIT margin specifically at 17.3%. Now, while the deal wins were very strong in this particular quarter as well as for the year, they mentioned that $3.9 billion of total bookings in this particular quarter. That's up 13% on a quarter-on-quarter basis. The large deal wins at $1.7 billion. It's also up almost 45% on a quarter-on-quarter basis. But the revenue growth number is so disappointing, and the trajectory and the guidance for next quarter, it's come in at roughly negative 3.5% to a negative 1.5%. That's the range that the company has mentioned for Q1 of FY26 specifically. And that's disappointed investors across the board. Brokerages have also come out and cut target prices. We have Citi that has a target price of 215 from 240 earlier. And the one key aspect they mentioned is that FY26 is likely to be another year of revenue decline and the third consecutive year of revenue decline. So that's one of the key negatives specifically. We also have something like BofA, who's cut target prices to 225 from 260 earlier, and so has Investec to 250. So across the board, it's disappointment from investors. Currently trading at 17 times price to earnings from most brokerages. So it's attracted there, but the numbers don't support the growth metrics going forward. The other one that's in focus and will be in focus today is Infosys. Now, Infosys amongst the large cap is expected to have the most disappointing set of numbers in terms of EBIT margins as well as growth, because we are also seeing a salary hike component come in this particular quarter for Infosys, and hence we're not expecting too much of a growth. The only one of the biggest numbers will of course be deal wins, but the FY26 guidance expected to be between 2 to 5% for the next whole year of FY26. That's what Infosys is expecting, and most brokerages are penciling in that number as well. But Mr. Chokalingam, Specifically, your view on Wipro, how do you view the Q4 results? And now that the stock has also corrected, do you think that it's a better play compared with the other large cap peers?
Large IT stocks, as I've been saying repeatedly on this channel, that the wealth creation story is over. The IT export used to grow even 30-40%, about a decade ago, which has now come down to 2 to 4%. And some of these companies are stagnating or expecting stagnation in the revenue in dollar term for the current fiscal. So therefore, if one aspires to make a big wealth, that's in my personal view, most unlikely, at least for the next 1-2 years. But to be fair to the stocks, they are already beaten down. Quickly they have come back to 52-week low from 52-week high. And as you rightly mentioned, the valuation also around 70, which is very rare to see in the past. Of course, that reflects pessimism for the sector as a whole. So therefore, considering the valuation and also the fact that they are all already beaten down, I would say that stock like Wipro would be a hold for defensive investors. But little risk-taking investors can go for small and mid-cap IT stocks because, from 2014 to 2012-13, we saw a series of acquisition in the mid-sized IT companies. And that probably should once again get a life because of stagnation in the industry, whole industry. So from that perspective, one can look at small and mid-cap IT quality stocks and stay away from the large cap. But still, from defensive approach, one can stay. And I would prefer Infosys to Wipro.
Got the view, Mr. Chokalingam. The other stock that's in focus in the IT pack is Sonata Software. Now, the company came out with its a press release yesterday specifically, which has lowered its Q4 FY25 revenue estimates from its largest client. Now, international business revenue is expected to be lower in this particular quarter. That's what the company has said. And revenue is expected to be declining versus a little higher than what their estimate was. So they had anticipated a 3.5% revenue decline in Q4 of FY25. Now that its largest client has also mentioned specifically they are estimating lower revenues from the largest client, it might have a larger impact, maybe a 4 to 5 to 6% type of decline in terms of revenue now. And that's a slight key negative. We've seen the stock recover from almost down 12% to 6% now. But the largest client, we're speaking to multiple brokers, is actually Microsoft. And both LTI Mindtree as well as Persistent also are India vendors for Microsoft. Let's also pull up those stocks and see what they're doing in trade. Currently for Sonata, we have roughly about it was about $87 million in terms of revenue from the international business that was there. Persistent come back in the green again, but we've seen that kind of pressure now, and share of the international business is almost 25% for Sonata. So it's a very sizable contributing in terms of revenue as well as margins. Now for fourth quarter, the guidance, as I mentioned, it was 2.5 to 3.5% decline, might be higher because of this news now. And in Q3, they mentioned that the second half specifically of Q3 also had some unplanned rundown. So that's one of the key negatives on Sonata as well. Mr. Chokalingam, I'm not sure if you track the stock specifically, Sonata Software, any view on the same?
Even after such a massive crash, for FY26, it would be trading at around 22 PE. I believe, if stock corrects below 300, then one can consider, because these kind of mid-sized companies can get re-rating in valuation multiple. They may not get a growth trigger, but there is a chance of valuation multiple getting re-rated. As I mentioned, by fag end of the current fiscal, the consolidation might get some life once again in the IT space. From that tactical perspective, I would give a buy recommendation below 300 on Sonata Software.
So below 300, that's the level to watch out for Sonata Software. But Waaree Renewables also posted about an 83% rise in its consolidated net profits for Q4 earnings. Stocks almost up 9.7% now in trade. Before we also spoke to the management about the quarter gone by. Let's get my colleague Mihika to talk to us about the key highlights about this particular quarter. Mika.
It's been a good day for Vori because Q4 numbers were strong. Earnings were aided by 76% higher EPC sales on an annual basis. Margins were impacted by 100 basis points on higher EPC contract, employee and other costs. But the company's order book, unexecuted order book, was up 38% YOY and now stands over 3.2 gigawatts. In terms of the top four numbers, revenue is up 74%. EBITDA has seen a 68% uptick. Margins have contracted by 100 basis points to 26.5% and net profit is up almost 83% on an annual basis. The key reason why margins fell was a 78% rise in EPC contract expenses, a 51% rise in employee costs, and a 59% rise in other expenses. But execution for the company as a whole in FY25 was strong. It was up 15% year on year at 1,524 megawatt. This is surpassing the 1,500 megawatt target that the company had. And the unexecuted order book, like I said before, was up 38%, standing at 3,263 megawatts. In terms of their balance sheet picture, lastly, the total debt is now reduced at 27.37 crores versus 40.1 crores a year ago, and the cash and cash equivalent stands higher at 26.8 crores versus just about 9 odd crores a year ago.
Got the view, Mika. Thanks for that. And Mr. Chokalingam, any chance you track Waaree Renewables as a space? Any view on the stock?
Yeah, long back we had recommended it, and then we closed the call. Particularly during IPO. I've been tracking it, and it's, to be fair, the results are really very impressive. 57% growth in profit for entire fiscal year is really something impressive, but that is reflected in the P multiple also. It's trading around 50 times now on trailing basis. But my only concern is that, competition in the renewable source has increased tremendously. There are many players starting from small cap to large industrial houses. So in this background, whether for next 2 to 3 years, this kind of growth is possible to maintain, I have a severe doubt. So therefore, by any chance, any profit booking comes and stock corrects 5-10%, then one may consider Waaree Renewable, in my view.
Got the view, Mr. Chokalingam, and stay with us, Mr. Chokalingam. But with that, it's time for a quick break. But we leave you with a special ground report. If you used to use BlueSmart as an application for cab rides, well, you won't now, because if you have followed us for the past 2 days, we have been, bringing you extensive coverage of Gensol fraud. How is it impacting your cab rides? My colleague Tushar brings you this particular ground report. Take a look.
Why is BlueSmart in a spot of bother? Remember, BlueSmart is an EV ride-hailing company. Operations of BlueSmart, India's only pure-play EV cab operator, has come to a screeching halt after Gensol Engineering was pulled up by SEBI for misappropriation of funds. But first, let's explore what's the connection between BlueSmart and Gensol. Both BlueSmart and Gensol share a co-founder in Anmol Jaggi, the promoter of Gensol Engineering, who was accused of misappropriation of funds to the extent of buying a flat in DLF Camellias in Gurugram. BlueSmart works on a EV leasing model. Essentially, it gets all these from gets its electric cabs from a EV leasing company, which acts as a middleman and sources loans from government institutions such as IREDA. These funds are used to then buy electric cabs and are then leased out to companies like BlueSmart. Given that they shared a co-founder in Anmol Jaggi, BlueSmart was a key beneficiary of these electric cabs at favorable lease terms. Now, with Gensol gone, the future for BlueSmart looks uncertain. Remember, BlueSmart was operating about 8,500 to 10,000 electric cabs on a daily basis and was doing about 20,000 rides per day on average. Its actually USP was catering to the airports in Delhi, Bangalore, as well as Mumbai. The city operations were limited to Delhi and Bangalore so far. So essentially now what happens to BlueSmart's cabs? What we are hearing from sources is that a part of that fleet will be taken over by Uber, who will be running these cabs under its Uber Green wing. There were also talks of an acquisition by Uber of BlueSmart that we don't know where it is progressing at this particular point of time. There is also talk of a hybrid model where BlueSmart leases some of its cabs to Uber as Uber Green and itself operates a pruned fleet of its own. So essentially, BlueSmart, which was a good EV cab company, a look into the future of mobility, is now facing existential crisis.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth.
Welcome back. You're watching Profit Buzzers right here on NDTV Profit. Now, Nifty is the most resilient market, believes CLSA's Lawrence Blanco. Now, he has mentioned that, a break above the 200-day moving average would trigger a very bullish implication on the Nifty going forward. He's also mentioned specifically that, on the upside target, he has roughly 26,427 to 26,430 as one of the key, positive benchmarks for the Nifty going forward. Specifically, we've also seen that, it mentioned that this was essentially moved back to the September highs that we had on the Nifty, from where we've actually seen roughly a 10 to 12% correction. He's also mentioned that, certain top stocks such as HDFC Bank, ICICI Bank, as well as Bharti Airtel as one of the key top picks for CLSA as well. And let's also look at the Sensex, because we made a very decisive move over 78,000 now, as highlighted at the bottom of our screen as well. And we're seeing over the last half an hour or so, the markets moved up really strongly, both on the Sensex as well as the Nifty Bank as well, now decisively above the 54,000 mark. And ever since, the last 6 months, we've seen a very strong move on since this correction, essentially since I think the level to watch out for on the Nifty Bank was 50,300. well above that number and almost 1,000 points. Let's also look at the Nifty Bank contributors as well, because seeing very resilient up move specifically from HDFC Bank as well as ICICI Bank on the Nifty Bank. Let's look at the contributors now for Nifty Bank specifically, because that move on all these stocks above 1900 for HDFC Bank. We're also seeing SBI contribute very positively as well. Something like Axis also doing very well. So very strong day for the banking as well as the financial names as a whole. On that note, we have Mr. Chokalingam, but also let's welcome in Osho Krishnan, who is the Senior Research Analyst, Technical as well as Derivatives at Angel One. Osho, let me come to you first specifically on the Nifty Bank. Very strong moves that you're seeing on the index. Any kind of view that you have on the index as well as some of the key stocks, HDFC, ICICI, what to watch out for?
Very good afternoon to both of you. And firstly, thank you for inviting me at the show. Well, yes, Bank Nifty has seen a very strong movement in the entire week. It has been a truncated week, but for the whole 3 days, Bank Nifty have seen very strong outperformance. And the time we witnessed a breakout above the zone of 52,000, it was indicated that market can see a very strong movement from here onwards. And looking at the overall sentiments that was building up from past few trading weeks, that financial were having a very positive traction. Private sector banks and something from the PSU banks also have started contributing to the upside march in the Bank Nifty. So I'm expecting that with the kind of a momentum that we are into, Bank Nifty has a very strong potential to retest the 52 weeks high, which is approximately 54,400 kind of a zone. Because looking at the Fin Nifty has already achieved a fresh lifetime highs, and Bank Nifty is approximately testing the same zone. So I'm expecting that in the coming period, there is a high possibility for Bank Index to have a very positive stance from here onwards. Now coming to stock specific front, today ICICI Bank and HDFC Bank both have given a very strong breakout, and they are at a 52-week high. So I'm expecting that in the coming days, there is a very strong potential for these counters to have some kind of outperformance in the market, followed by strong backup that has been provided by the PSU banks also. So one should not leave out the banks like CUB, Indian Bank, Union Bank. All these counters are looking very positive to me. And even from investment point of view, these counters can be seen as a good opportunity to buy here and get a decent return over a period of time. So overall, BFSI as a sector is looking very positive to me. And from here onwards, I am having a bullish approach for the coming near future, in the coming future.
So 54,400 is the level that Osho is watching at from the Nifty Bank. And both HDFC as well as ICICI will be in focus. Their results for Q4 expected this Saturday. Another stock that's in focus is Angel One. Now it has been in the spotlight as the stock has recovered from the day's lows after reporting a subdued quarter. Now my colleague Harsh joins in with key highlights from Angel One's Q4 earnings.
Well, tough set of numbers for an Angel One. You saw a 16% contraction sequentially on the revenue number, 22% YOY. Employee expenses were the one place where we could see some bit of calibration, due to which the profit after tax was in line. There was some one-off savings in the employee expenses, which has led to this in-line kind of profitability. But outside of that, it's been a tough set of numbers. New initiatives are seeing good traction. They've added Axis Bank, IDFC First Bank as partners for credit distribution. They've also witnessed a slowdown in their credit disbursements in Q4 versus the 9-month FY25 period. They're expecting credit distribution to see a ramp up in FY26. So that's from an outlook perspective. The FY25 earnings were weak due to multiple headwinds. The impact of these headwinds will come in versus the base in Q4 FY26. So something to be kept in mind. But otherwise, the earnings growth will likely remain weak or muted. That's what brokers are expecting, likely to remain weak, at least in the near term, where Angel One is concerned.
Well, thanks for that, Harsh. Mr. Chokalingam, your view on Angel One's Q4 earnings, if you had a look?
Yeah, I just now analyzed it. After the fall, it looks quite decent. Definitely, it may not create a significant alpha, but 10-15% upside is very much possible. Yeah, Q4 result is bad, but that is expected for all the players who are related to stock broking business and wealth management. Jan-March quarter was one of the worst quarters in the recent period for this particular business. So now with the market expected to recover, these businesses also to be recovered. So therefore, from current level, definitely 10 to 15% very much possible.
Got the view, Mr. Chokalingam. Now, ABB India is also up almost 4% in trade after the global parent actually reported its earnings for Q1. Now, specifically, we are anticipating, there were a few numbers going around. Let me bring in my colleague Anushi to contextualize all this and more for ABB.
Right. So what we are looking at is ABB is in focus in trade. ABB India is in focus in trade after the group company, that's the ABB Global parent, has reported its Q1 numbers for the quarter. Do note that the company follows a January to December calendar year, so it's the first quarter numbers that we are looking at. So what has happened is that for their India business, they've seen about an order inflow growth of 1%, which is a positive. Considering that the last quarter there were discussions on there being slowdown on order inflows, so order inflows above expectations is something that we are looking at. Other than that, if you look at the earnings side of ABB Global, they reported a 3% of a growth in their revenues. This is lower than what was the guidance given for a revenue growth to be in the mid-single digit, but it was the margins which were a standout for this quarter, wherein margins are about a 230 basis points of an improvement at 20.2%. This is above the guidance that the company had given, wherein the expectation was that the margins will remain broadly stable. So this was led by pricing, positive pricing that we are seeing, leading to this kind of a margin impact, that margin improvement that we are looking at. Overall orders, if we see not just the India orders, they were up around 5% at $9,213 million, again higher than what was the expectation. Now, just to contextualize how the order growth has been in terms of trends for ABB Global versus ABB India, if we see that ABB India, whenever a group has seen a decline in their growth, like minus 21% in the fourth quarter, we did see about a minus 14% of a dip in the ABB India business as well in terms of where the order inflows are concerned. Similarly, in when the order growth has been stronger for the business, ABB India has reported even stronger growth picture over here that we can see in Q3, Q4 performance, Q3 and Q2 performance as well. In the first quarter also, the company had reported a 5% of a growth in their ABB group. The ABB India business had reported a 15% of a growth. So this is in terms of how the trends have shaped. So focus would be on how ABB India's order inflows for the quarter would be. If we go look ahead, the company now sees more uncertainty for its global business environment. However, they have retained their CY 2025 outlook that they have given, wherein the revenue is expected to remain in the mid-single digit range. Book-to-bill ratio mainly will remain in positive. This time the book-to-bill ratio stood at 1.16 times. And there would be further expectations of improvement in the EBITDA margin. In other business updates, so the company has stated that it plans to spin off its robotics division and is expected to separately list its robotic division in the second quarter of 2026. So this is what we are seeing for ABB.
Got the view, Anushi, and thanks so much for that. But we've seen a very strong move and up move in the market today. We're also getting joined by Mr. Mihir Vora, who's the CIO of Trust Mutual Fund. Mr. Vora, thanks so much for joining in. We've seen a very sharp move and on a positive side, specifically for the Nifty 50. Any view that you have specifically currently on the market?
Sorry, you're asking on the Nifty?
Yes, we've seen a very strong move in the market. The bulls have come back in a sense, and we've seen the banking and the financial names specifically, which have been one of the key reasons for the growth today in the market and its prices as well. What's your view specifically on the banking as well as the market move that you're seeing currently?
So if you notice, India has been among the few markets which are actually above the pre-2nd April Trump tariff levels. So I think it's a testimony to the fact, and probably the FI is also realizing it, that India will probably be the least impacted. There will be an impact, of course, on exports, etc. But relative to the other countries in the world, India should be amongst the least impacted. That's one. Second is, typically we have seen in most of the crises, it's ultimately the Indian consumption story remains very, very solid. And India does tend to kind of rebound also quite well after most global crises. So I think India's relatively lesser dependence on exports is one. Second is the overall RBI policy approach also has now turned more dovish. So we are seeing liquidity come back into the system locally. And third, I think most importantly, for the first time in history, we are seeing that all the problems that are typically associated with emerging markets are actually now being associated with the US. So we are talking about inflation there. We are talking about the dollar depreciation. We are talking about bond yields going up in the US. So typically in a crisis, all this used to happen to emerging markets in India. Now it's the other way around. So probably we are seeing some more FI buying after the last 2 days. Last 2 days, the cash market buying in from FIs has been positive. And maybe I don't have the numbers, but I guess that buying still continues from the FII side. And domestics were anyway buyers continuously. So to that extent, I think we are seeing some kind of relief rally after the huge volatility that we saw after April 2nd.
Fair point, Mr. Vora, and you highlighted that India is definitely looking better when compared with the other countries in terms of the tariff impact, as well as RBI's very positive moves. I also want to get your view on the banking names, because we've seen almost 1,000-point up move on the Nifty Bank, and just a precursor to the Saturday results for HDFC as well as the ICICI Bank. How are you viewing the banking space as a whole, and some of the key expectations from Q4, if you have any?
So Q4 expectations are not that great, frankly, because we haven't seen credit growth pick up that much, and the impact of the RBI liquidity and rate cuts will now start being felt. So my guess is that the markets are kind of preempting that move. But most importantly, banking as a sector did not do too well in the last couple of years for good reasons. You had the liquidity tightness, you had the RBI clamping down on unsecured loan growth, and you also had the volatility linked to the currency, etc. So banking in general had underperformed. So relative valuations of banking and the large NBFCs had become attractive in any case versus the rest of the market. And now that all those factors are being unwound, rupees stable, liquidity is ample, RBI is cutting rates, I think we are seeing the markets preempting growth coming back into the system, because growth was the only thing missing. Credit quality, capital adequacy, etc. were all fine.
Fair point, Mr. Vora. And also I want to understand, your view specifically, from the growth going forward. Where are you anticipating, in this particular quarter, which were the sectors? Because we've seen the auto pack getting impacted slightly because of, the Trump tariffs. Banking, you spoke about the Nifty IT, not too much great, coming in from that news and from TCS as well as from Wipro. So what sectors do you think specifically do we look at going forward? Because we've seen the market reacting to, as you rightly mentioned, some earnings coming forward. So what's your view on which sectors do we watch out for going forward?
So as you said, the March quarter earnings are not going to be anything great in any case. Single-digit earnings for the large caps, earnings growth for the large caps. So we will have to look forward, and there all the domestic segments look fine. We already discussed banking. Then we are talking about even the domestic cyclicals like industrials, etc. coming back. We do see government ordering supporting that, and hopefully with manufacturing in India gaining prominence, probably we can see the industrials also done well. Power, railways, defense, anyway were segments where government has been focusing on. There was a bit of a let-up in ordering, which led to a sharp correction in the stock prices. So these are some of the segments which will recover, I think, as we go forward.
Good afternoon, Mihir. Hiral this side. Mihir, the kind of rally that we are seeing right now in terms of where markets go, I mean, something which probably the street was slightly nervous about. However, the upside is looking fabulous. Do you think there is confidence which is coming back in the markets, number one? And secondly, it seems that the FIs probably are seeing some bit of short covering in terms of their strategy. How are you looking at it?
I think there's no euphoria as of now. I think people are still worried about the volatility. So we are not really in for a completely bullish view from the market participants. So there is enough, I would say, enough steam left because there is still a healthy dose of skepticism in the market, I would say. And I would agree with your view that some of the rally might also be driven by FIIs who are short on the market in the futures segment, in the derivatives segment. But it also may be some amount of reallocation coming back to India after what we saw in December, January, Feb, where some money had actually gone to China and the people are talking about India versus China, etc. So maybe some of that rebalancing trade also might be happening. And if that continues, we should see some more money coming in from the FIIs.
Here, hi, Tamanna here. Great to speak to you on what is turning out to be a very exciting afternoon with volumes coming in. From an India perspective, a sense now that comparative to China, as these reciprocal tariff rates keep getting higher and higher, that India is going to be the destination. In that sense, do you even see foreign investors returning, or this is going to be largely a domestic story?
I hope they come back, Tamanna, and put a smile on our faces, because they've been selling for so long now. September, October, November, December, January, February. I think March was the first month after 6 months that we saw some net buying by FIIs. So they already seem to be underweight India, and even if they want to make it neutral versus China, etc., we should see some good money coming in. Another statistic that we keep discussing is that calendar year 24 was a year where, on a net basis, FIIs were sellers. Statistically, at least historically, what we have seen is we haven't seen FIIs being sellers for 2 consecutive calendar years in the last 25-30 years. So hopefully that track record won't be broken, and FIIs should end up being net plus by the end of calendar 25.
Thank you. Thank you for that, Mihir, and always a pleasure to speak with you. We're getting more voices in on this Thursday afternoon. I mean, the kind of up move and the volumes with which it has come is truly astounding, and it's clearly the banks leading the charge. In fact, that's the first question I'm asking Abhay Agarwal this afternoon, Managing Director of Piper Serica Advisors, who's joining in. Abhay, great to speak with you. The faith that we're seeing in banks ahead of key results this weekend, what is that telling you? Because yes, we have seen interest rates dipping. They're going to continue to dip. But the transmission cycle is not necessarily giving us a great story for banks. Why do you think banks are leading the charge?
Yeah, I think, thank you first of all for having me. In our model portfolio rebalance that we did in this quarter, we have added 4 banks, and that is after not having any banks in the portfolio for almost 18 months. We tracked the sector very carefully, and I'm not surprised by this up move, and it is a lot to do with a reversal in a lot of things that put banks under pressure. The primary one being the restrictions that were imposed on lending to unsecured segment starting from January last year by RBI. And I think that sucked away a lot of liquidity. And if you look at MFIN data, the unsecured lending as a pool by banks fell from 4,50,000 crores to 3,70,000 crores. So there was a lot of pressure that banks took in terms of asset quality because of very strict NPA recognition norms. Provisioning was high, especially in the December quarter, because a lot of people who could not pay on time were tagged as defaulters and provided for when they were not really defaulters. So I think a lot of those things are reversing very quickly. The new RBI governor that we have clearly has given a very strong signal to the market that they will be supportive of liquidity and a lower cost of capital and focus on growth. So I think I'm not surprised that investors are looking at, especially the smaller banks that are trading at book value or some below book value, to make their bets now.
An interesting point that you made is where investors are actually watching out for the smaller banks. How are you looking at the kind of volumes you're seeing today? I mean, in terms of HDFC and ICICI Bank, because in terms of opening trade today, volumes have been super strong. Saturday is when both these banks will declare their results as well. How sustainable is that going to be? Because again, to some extent, the anticipation is that there could be profit booking in the last hour of trade with both these banks as well, just before the earnings. How would you look at this large cap banking space then?
No, I think large cap banking space, we are very positive. I think a very strong technical and fundamental bottom was made in large cap banks in the last quarter. We are seeing the technical and fundamental both becoming favorable for large banks. The volume-based buying that we are seeing, I don't think is going to stop beyond the results. I'm expecting the commentary from the banks to be positive after a long time. I think last 2-3 quarters we saw the commentary being cautious, which was rightly so, but I'm expecting that the banks will signal that the worst is probably behind, and then we are getting into a cycle which has lower cost of capital, better credit offtake, and better margins. So I think that's what the markets are also anticipating, and I don't really see these stocks correcting. Of course, there will be profit booking, that's par for the course, but I expect the trend to be upwards over the next 12 months.
Mr. Agarwal, it's Puneet here joining in as well. Thanks so much for joining in. You mentioned that you've added 4 new banks in your model portfolio. Any names that you can suggest? Is it only private banks, or have you added any public sector banks as well?
We are still adding them, so the names are not yet public, but these are, our focus is more on stocks there where we can benefit from a multiple expansion also. So these are all private small finance banks.
That's interesting. That's interesting because your microfinance or your asset quality question, which has been plaguing the space, seems to have receded. So a couple of factors, Abhay. I'm just trying to, let's zoom out a little and look at the big picture. CapEx rollout expected to pick up. Consumption expected to pick up now that the tax incentives announced in the budget are going to start kicking in, and maybe a distinct advantage for India versus China, for example. If I were to, off the top of my head, think of 2-3 reasons for this rally, would this make your list?
You're talking about the banks per se, or
generally? No, overall, reasons for this rally.
No, I think, as I said, and I've been saying this also, that the correction that we saw in India especially was very sharp, very vicious in the last quarter, starting January, February, and part of March also, because of various fears, domestic slowdown, FPI selling, and a lot of those reasons have reversed also as quickly. You have seen the US dollar correcting, the US assets becoming less attractive. So we are seeing, more conversations from foreign investors coming into India after a long time. Fundamentally, things are improving, better, lower taxes, lower interest rates, domestic consumption coming back. So I think every which way I look at it, I'm pretty confident that there are very solid technical and fundamental reasons for this rally to sustain.
Right. Abhay, we've spoken about the financial space. You have private banks, which is the top gaining sector today. But apart from that, let's look at 2 other sectors which have exposure to the export market to a large extent. Auto and Pharma, both of them seeing a recovery in trade today. Now, there is constant back and forth with regards to tariffs. How would you advise investors to now look at the auto and pharma space, taking into consideration the recovery that's probably coming in?
I would say on the auto, especially the four-wheelers, it's still a domestic story. And the good thing is that the stocks went through a sharp correction. Whatever channel checks we have done recently, there seems to be more inquiries. Some inquiries are also converting into sales. Price cuts that were taken in March and January helped a lot. So I think overall the demand environment for four-wheeler consumer vehicles, passenger vehicles is positive. On the export side, I think it's more of a two-wheeler story, and that also seems to be holding up pretty well. So I think auto is the segment that we haven't added yet to the portfolio, but we are looking at it actively to see what are the plays there. But on pharma, we are far more constructive. I think for the last 18 months it's been an overweight for us, and we plan to keep it that way. I think the Indian large cap generic companies have done a lot of good work over the last 5 years, and they are in an environment where their hard work is getting rewarded in terms of the large product pipeline they have, especially for the US launches. The US FDA is very friendly to the Indian companies right now, and I expect that to continue to be the case. So I think for the pharma companies, it's a great environment to benefit from.
What would be some of the pharma companies you're really liking now, Abhay, to whatever extent you're, giving us direction on it?
in our model portfolio, we have two, which is Dr. Reddy's and Divi's more so from the CDMO perspective. But at this point of time, I would say that if you look at last calendar year, Pharma index was the best performing sectoral index in Nifty. And I'm expecting that to be largely the case this year also. I think people will be surprised by the commentary and the results that they see from pharma companies. So I would say that, you can pretty much pick up any of these large caps and bet on them right now.
Interesting. So, we'll take that point away from what Abhay is saying, that Pharma is going to surprise on the upside perhaps this quarter as well. Thank you so much, Abhay. Always a pleasure speaking with you. Gautam Shah joining us now, founder Goldilocks Global Research. Gautam, very good afternoon to you, and it's turning out to be a spectacular afternoon, truly. Let's talk about the Nifty. Zoomed through several resistance levels. Where do you see it now? Closing in on 23,800.
Yeah, good afternoon indeed. When you see a stock like SBFC Bank at lifetime highs, you want to question whether we are actually in a bear market or not. Because I think we've had a very unique situation in these last 6 months, wherein the average decline in stocks on the NSE was about 42%. And you had so many stocks among the top 100, which really stood out really well. I think on the first signs of global stability, you have the Indian markets running away because, this 25,000 crores, which was just waiting on the sidelines, waiting for global stability, that has kicked in the last 2 weeks. And this is probably the reason the market has seen a V-shaped recovery. I don't think index levels are as important because I think money is at work. People feel a lot more confident. Earnings have been quite reasonably stable. The slowdown talks have been discounted to a greater extent. India VIX has corrected, crude has corrected, dollar index have fallen. So there's a lot happening in the financial market framework at this point of time. I think one should remain constructive. I don't think the index is running away. 24,000, I think, is an important barrier where there could be a bit of a pause. But I think being in the right themes, being in the right pockets is important. And we love financial services. I think we've maintained that stance. And I feel it will go on to do much bigger things over the next 3 to 6 months.
Gautam, interesting point. I mean, 55,000 is what you're aiming for as well in terms of Bank Nifty. We're pretty close to those levels. Our chart's still indicating further strength where HDFC Bank, ICICI will lead the rally to hit that 55,000?
See, I think we went through a storm in these last 5 or 6 months, and any sector and any stock in the market that withstood the storm has basically been the best participant of the rally in the last 7 to 8 days. I mean, if you look at ICICI, HDFC, SBI, and Kotak, they just didn't, fall while the markets were collapsing, in those difficult times. And I think now money seems to be chasing them. And obviously, these are businesses that don't have much to do with foreign soil. I think that's probably the reason a lot of companies, which are more inward-looking and are India-centric, have done much better in the recent past. So I think there's a lot more upside. As I said, numbers are not important, but 55,000 near term, maybe a 60,000 over the next 6 to 12 months on the Bank Nifty, entirely doable.
Gautam, it's Puneet here joining as well. Thanks so much for joining in. 60,000 on Nifty that you're looking at. I want to get your view on the PSU banks as well. Anything that you're seeing, the positivity of private banks there as well? And we've seen the mid-cap and the small-caps not really participate in the rally today. Any view that you have on those, on both those indexes as well?
See, firstly, on PSU banks, I think they are on the verge of starting a new trend. I think in the last 15, 20 days, it's been about the private banks, and rightfully so. But I think some of these top PSU banks are setting up beautifully on the charts. And I think the risk reward is excellent. The margin of safety is immense. You have some of these stocks which are trading at a PE of about 8 and 9, and they have nothing to do with these, talks around tariff and the global uncertainty. So I believe that this strength, which has been in private banks, will trickle down into the PSU banks, and the top 3 names, we like, and I think we recommend your viewers to look at investment positions there. Talking about mid caps and small caps, I think it's very selective. It's not a kind of market environment where anything and everything would do well. I don't think that can happen. It's top quality which is participating, and this is going to continue. So large caps might take a breather after we hit a level of, say, 24,000, but the mid cap, small cap outperformance, I think, will continue for the rest of the year.
top three names there, Gautam, top PSU banks, SBI. Which are the other two?
Yeah, so the top three names are clearly SBI, BOB, and Canara Bank.
Okay. And you think more steam in an HDFC, ICICI bank after what it's been doing? Like you said, I don't know where the bears have gone and not looking for them to come back. But HDFC, ICICI bank still looking like more steam ahead?
I think so. I think, they've just seen beautiful relative strength in these last 3 or 4 months. And I believe smart money was hiding into some of these stocks, and not to forget the Bajaj twins, the NBFCs, Bajaj Finance and Bajaj Finserv, which have also been quite solid. So I think the entire space will do bigger things. I mean, the advice to your viewers is don't look at profit booking very early, because we've gone through a difficult 6-month period, and I think there's definitely more to come on the upside. Markets are not going to run away. They will have their dips from time to time, but now we are going to get into a period of buying the dips and a period of higher tops and higher bottoms.
25 calendar year, what is the Nifty looking like for you? And I know I'm saying this at a time when the mood changes every 3 days, Gautam. But having said that, is there a number that you want to put out there?
Yeah, I think the mood can change. That's okay, because we live in a very fickle-minded world with so much happening on a daily basis. But, as a technician, I feel extremely elated because price action discounts everything, and discounts everything really fast. And I think we've gone through a bear market in 6 months that could have happened over 1.5 years. And because cycles have shrinked, it's good that markets have come back this quickly. And I think this is going to sustain. So while the Nifty might not give you great upside, maybe another 5-7% from here, as I said, it's a stock pickers market and king pickers market. So we are very bullish on financial services even now. We like the entire PSU basket. We like the entire metals basket and the power in the infrastructure space. So if you're in these 5 major pockets, I think there is serious money to be made between now and end of the year.
And Gautam, we're talking about people who are already invested in these sectors. How about someone who's looking to make fresh investments at this current point in time? Are charts favorable for a new investor for the sectors that you're mentioning? Let's pick up metals first. And if so, any names that you would give?
I think so. I think the risk reward is justified buying into financial services and metals even now. I know people might look at the price action of the last 7 days and say that, oh, they've missed a rally. But I think the upside potential is far, far greater than the downside risk at this point of time. So I think as new investors, just because Nifty is at 23,800, please don't wait out. I think a lot of domestic money fund managers are also deploying money as we speak, and they're forced to, because they see that, markets seem to have stabilized. So just focus on these 3 sectors and be a buyer even at today's prices. There could be a 2-3-4% dip at any point of time. We have a long weekend ahead, but I think one should not really wait too much for that.
Right. So I think this is a stock pickers market. There are opportunities for someone to make a fresh entry as well. That's the word coming in from Gautam Shah. Thank you, Gautam, so much for joining us on the show and sharing your views at a time when the markets are at the day's high, in fact, very close to their record high levels as well. Nifty 50 has actually erased losses with regards to 2025, Puneet, and that's an interesting one. We are about that 23,750 mark in terms of Nifty 50. And Bank Nifty has added nearly 1 lakh crore in terms of market capitalization. So it's the BFSI which is leading the space.
Well, definitely. And, before the results come in, it's a big positive move, something that market might be telling us already, like a preview going forward. But, the market news definitely continues. Nifty Bank levels, almost we crossed 1,200 points on the Nifty Bank, just seeing some correction there. But overall, very close to 23,800 on the Nifty now. But with that, that's all the time we have on this edition of Profit Buzzers. Thanks so much for watching. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea?
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor, Varsha. Well, Varsha, market continues to hover around the day's highest point. We have in fact crossed 22,800 point. Let's get in our guest for the show today, Avinash Gorakshakar, the Director Research with Profit Mart Securities. Avinash, coming to you first on markets, a strong up move that we have seen in the market, especially led by banking and the IT names. How are you looking at the market at the current juncture?
Yeah, good afternoon, Somik. My sense is, I think, the entire sentiment in the market has changed, after the fact that markets have realized that, the scare which came on April 2nd from the Trump tariff issue has now got normalized. I think, most market players are expecting that negotiations will happen, and obviously not immediately, but at least till September, things will be very clear. Hopefully, India will get a lower, tariff rate structure, and that goes positively for us. In fact, India, according to me, is a very protected market, offers a very solid growth kind of opportunity for, countries like Europe and US. So there is unlikely to be any major disruption, because of the tariff issue. And I think clearly with the dollar weakening, the rupee stabilizing, we have seen the dollar index also coming down. FIs have also started buying very small quantities, in the cash market. So that has given an added level of comfort and confidence. And I think, sectors like financials, public sector banks, private sector banks, hospitals, hotels, these are sectors where I think growth would continue. I think at least visible growth is there. And most importantly, of course, for the export sectors, although the headwinds are challenging, IT companies, we're going to see a little bit of sluggishness in numbers, which came yesterday from Wipro and earlier TCS. And today, Infosys. I think, normally markets would re-rate these stocks only when there's a clear hint of visibility of growth coming in. So maybe the IT sector, maybe for that reason, the pharma and the metal pack may remain cloudy, but I think there are some good sound bets in this sector also. So I think, my gut feeling is that numbers for the fourth quarter are important, but the real improvement in the market sentiment will further get re-rated once the April to June quarter numbers come in, because that's the time when you could see some impact of the rate cuts, of the budget announcements. And I think we are positive and constructive on the market. It's a good time to look at good quality companies and start building your portfolio. Because I think now at least the panic has gone out of the market, and liquidity is slowly coming back to the market.
Right. So thank you for that. But let's move on and let's see how Waaree Renewables has performed when it comes to Q4. It posted about 83% rise in its consolidated net profit on account of higher income. Before we speak to the management about the quarter gone by, Mihika joins us with the highlights of the quarter.
It's been a good day for Waaree because Q4 numbers were strong. Earnings were aided by 76% higher EPC sales on an annual basis. Margins were impacted by 100 basis points on higher EPC contract, employee and other costs. But the company's order book, unexecuted order book, was up 38% YOY and now stands over 3.2 gigawatts. In terms of the top four numbers, revenue is up 74%. EBITDA has seen a 68% uptick. Margins have contracted by 100 basis points to 26.5%, and net profit is up almost 83% on an annual basis. The key reason why margins fell was a 78% rise in EPC contract expenses, a 51% rise in employee costs, and a 59% rise in other expenses. But execution for the company as a whole in FY25 was strong. It was up 15% year on year at 1,524 megawatt. This is surpassing the 1,500 megawatt target that the company had. And the unexecuted order book, like I said before, was up 38%, standing at 3,263 megawatts. In terms of their balance sheet picture, lastly, the total debt is now reduced at 27.37 crores versus 40.1 crores a year ago, and the cash and cash equivalent stands higher at 26.8 crores versus just about 9 odd crores a year ago.
Well, thank you, Mika, for all the details. In fact, we spoke to Waaree Renewables Group Head of Finance, Abhishek Parekh, about the company's bidding pipeline for EPC segment. Listen in.
Our current order pipeline, the total bidding pipeline which we call for our EPC revenue, is around 30 odd gigawatts, which last year was somewhere around 20 odd gigawatts. So at 30 gigawatt of order book, we believe we have a reasonable pie to look at, because we have been consistently maintaining our market share also. And year on year, our pipeline increases, and we have seen the impact coming into our order book as well. So difficult to give an exact number, but I can tell you our order pipeline and our overall bidding pipeline has increased significantly in last 12 odd months.
Well, that's what management has to say when it comes to bidding pipeline about the company. But Avinash, in this space, in the EPC space, we've seen a lot of increase in competition. You have water infra companies, you have solar EPC companies. Just wanted to have your view on the sector as a whole, and of course on Waaree Renewables.
No, I think, Varsha, competition is definitely there, but I think it's all a business of volume. And I think as the company management disclosed, the kind of order book Waaree Renewable is sitting on, I think at least for the next 2 years, the revenue visibility is intact. Although, in this quarter, that is the fourth quarter, also we saw that top line and profitability in absolute terms grew. There was some pressure on the profitability margin. So I think, it's obvious that in a volume-based kind of business, margins will be under pressure. But typically, I think if you look at Waaree Renewables, I think the better part is that, they're also looking at an integrated approach. They're looking at putting up their own solar cell facility. So, going forward, such companies which have got an integrated approach are definitely going to benefit significantly. And I think even in the US, they have a US facility. So my sense is, I think, the Indian story will continue because the Indian government has been pushing for solar and renewable energy in a big way, and that is unlikely to change. So I think clearly, despite the competition within the solar EPC players, I think the market pie is very large. It's growing quite significantly in double digits. So to that extent, somebody who wants to take a view on this company has to take at least a 2-year view. These companies cannot be evaluated on a quarter-to-quarter basis and on a short-term level. I think longer term, the management bandwidth, the order book, all boils down to the fact that there could be a good risk reward provided one takes a 2-year view.
Right, on to an NDTV Profit exclusive now. As global trade war heats up, there's a rising trend of FDI interest in India as global giants look at the possibility of setting up manufacturing base in the country. My colleague Shrimi joins in with more details on the same.
What we have been given to understand that the government received 20 plus foreign direct investment related queries in past 2 months from global firms to set up manufacturing base in India. And these queries, spanning in sectors, particularly chemicals, automobiles, textile, electronic, which has huge, export potential. Sources, in fact, also telling us that these foreign players are restructuring their investment strategy, looking to diversify their supply chain in India. And, this surge in queries are, particularly driven by the lower tariff environment, which India has at this point. After pausing this entire tariff scenario, we have at 10%. Some of these actually FDI application also involve, joint venture with minority China stake. And in fact, some of the proposal do suggest that they want to structure the company in a way in India as far as joint venture is concerned to comply with all the India's FDI policy on investment. So sources also, indicated us that government has approved 7 to 8 joint ventures in non-sensitive sectors. And they are saying that this entire tariff move by US has acted as a trigger to this, prompting, global companies to rethink on their, supply chain and explore India as a stable alternative. Plus, India offers a competitive edge over the global peers, is what also they indicating. And the kind of scheme we have, like PLI scheme, is also a key factor to drive interest. So overall, yes, global firms is what the indication we're getting, that revisiting their investment strategy amid this geopolitical shift and trade uncertainty. Many these MNCs companies are recalibrating their strategies as a part of broader global realignment. Back to you.
Thank you so much, Rimi, for all the details. Well, moving on, Morgan Stanley has also cut target price for major players from the metal sector. Let's get in Mika with who will give us more details on that.
So Morgan Stanley has, downgraded the ratings of 3 of the 4 metal counters that it currently tracks. Tata Steel, JSPL, JSW Steel, all of the ratings from an equal weight earlier have been downgraded to an underweight. In terms of sale, it's maintained at underweight. Now, the new target prices for Tata Steel indicate an 8.8% potential downside. JSPL has a 5.4% potential upside, while SAIL has a 21% potential downside from the previous closing prices. In terms of why MS is downgrading steel, the tariff-related uncertainty has boosted global growth concerns, and this could weigh on global commodities demand as per the brokerage, and they do see a downside risk to steel prices even if the government implements a safeguard duty of 12 to 15%. On Coal India, it has downgraded the stock's rating to an equal weight from an overweight. The target price has been cut to 450 rupees from 525 rupees previously. In terms of why they are downgrading Coal India, well, slow growth in India could affect the company's volumes, and weak global prices could affect the e-auction prices. Lastly, in terms of what does Morgan Stanley prefer, the brokerage does prefer cement because it expects domestic commodities to do better versus global.
Well, Avinash, how are you looking at the entire metal space, and what is your preference? Is it the ferrous or the non-ferrous? Do you prefer Hindalco or the steel names?
Well, I think, Soumik, we are very selective on the metal sector, and I think within the metal pack, one of the most stable and decent cash flow earning companies player is Hindustan Zinc. We have been seeing that zinc prices have started firming up. Hindustan Zinc, incidentally, is the third largest silver player, and it contributes almost 35 to 40% of the EBITDA to Vedanta. So, here, the best part is that if silver prices continue to rise, our sense is that we could see better numbers, at least, not only for the March quarter, but even for the April to June quarter. And I think they've also decided to expand their capacity. So in terms of their EBITDA margins, in terms of their operating cash flows, in terms of their, dividend payouts, I think this could be a good bet, for the medium to long term. Probably a price of 490 to 500 is very much possible, provided we see firmer prices for both zinc as well as for silver. So I think within the metal pack, we believe that, unlike a Hindalco or a Tata Steel, where there could be little more volatility, here I believe, the price point is definitely attractive, and I think that would give a good tailwind to the company in the coming year.
Well, Avinash, thank you so much, for joining this conversation. Good to have you. Moving on, Soumit, Morgan Stanley is actually bullish on Adani Ports. What do you have?
Well, yes, it's a very interesting note that has come out from Morgan Stanley's house, and that's on Adani Ports. Now, they have maintained their overweight rating on the stock and have marginally increased the target price to 1,418 from 1,415. But this is an interesting note because they are quite bullish on Adani Port despite the tariff issues that we are seeing. Now, what the brokerage house is saying is that they say that Adani Ports has a resilient business model with diversified cargo and geographical mix. They are saying that in the medium term, India is likely to gain the global share of goods export, which bodes well for Adani Ports' cargo business growth. And they're also saying that the currently announced tariff structure, in that positioning, if you look at India, stands much better. India is much better placed as compared to other larger Asian exporting countries. And at the same time, domestic leading macro indicators are also quite positive, and all these factors bode well for Adani Ports as per the brokerage. Now, they see that there is a limited impact of tariffs given the well-diversified cargo mix, larger share of sticky volumes of Adani Ports, and limited direct exposure to the US market. In fact, as per the brokerage house, Adani Ports has less than 5% exposure to the US. So, not much of an impact that could come in because of the tariffs that have been imposed by the US government. They're also saying that apart from this, there is inorganic growth and new capacity addition, which would also bode well for Adani Ports and could offset any impact that could come in from the tariffs in the future. Apart from this, they're also saying Adani Port is expanding its integrated business model with continued investment in both port capacity expansion and logistic value chain. And they're saying that company continues to gain market share, and their strategy to leverage into integrated business model is also quite encouraging. So, quite a positive note that has come out on Adani Ports. But shifting focus from Adani Ports to Infosys. Now, this Infosys will be coming out with numbers today post-market. Let's get in, Puneet, with what is the street expecting out of Infosys Q4 numbers?
Well, thanks for that. It's expected to be a subdued quarter for Infosys, and that's expected to be the lowest growth across the large cap peers specifically, expecting revenues to just slightly rise by 0.9%, while the EBIT is expected to fall by 2.4%, and that's because this is a quarter where the salary hikes are going to be anticipated to come, and that's going to affect the EBIT margins, coming at falling by 71 basis points at 20.63% is the expectation for EBIT for Infosys. On profit as well, it's expected to fall by 1%, coming at 6,700 crores, and one of the likely things will be 100 to 150 basis point impact on EBIT margin, specifically because of salary hikes. Apart from that, we are also anticipating growth to be affected because of larger impact on consumer discretionary spending in the USA. Commentary as well as guidance for next year is expected to be roughly 2 to 5%. Both Nomura as well as Nuvama brokerages have anticipated that growth for FY26. So, guidance number will be something to watch out for. Attrition on a year-on-year basis will be slightly higher, but I think the guidance in the deal wins, as well as some commentary on if any delays that they have seen and project delays will be something to watch out for going forward.
Well, thank you, Puneet, for that. With that, it's a wrap on this edition of Top Trades. Stay tuned and keep watching NDTV Profit. India Market Close up next.
That's huge. That is a biggie. It's on a
Gold Class Clear Glass. Far ho ya near, sab kuch dikhe clear.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its
Good afternoon and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Mahima Vachrajani, and it's been a fabulous week of trade. In fact, the last 4 trading sessions, we've been in the green, and today again we've seen a rally. We were flattish at the start of the day. Let's pull it up in terms of the intraday chart, and largely driven by the Nifty Bank, as you can see. We were flattish at the start of the day, and now we're 1.8% higher. Now staring in at 24,000. We've been in a week where we've gone nearly from 22k to 24k, and it's largely led by the banks. We're just 70 odd points away from life high on the Nifty Bank. That's something to watch out for as well, and hopefully we'll see it in the next 1.5 hours, and we can probably quickly cover it as well. Let's look at the heat map on the index. At least the momentum indicators seem to suggest that banks are the place to be at this point. 5% higher on an eternal. But look at an ICICI leading the charge among the banks, and SBI is up 3.5%, Reliance up 3% as well. So some of the heavyweights there carrying the load. But let's not forget there's an Adani Ports as well as a Bharti silently up 3.5%, those two as well. While not heavyweights on the index, they are certainly pulling a punch. Let's look at how many stocks are 1% plus, and it's 28 stocks which are gaining 1% plus in trade. Even a Kotak and an HDFC up 2.5% and 2% respectively. So it's a day when the financials have really taken center stage. Let's look at what's not doing well. Steel, coal, a Wipro on the back of numbers being disappointing in that sense. No deal wins, or rather the deal wins more subdued than expected. Let's look at the contributors on the index as well. And within that bucket, you'll see banking really contributing well. The heavyweights in general are also doing well. Far and few in terms of losers, and therefore we are up 400 plus points on the Nifty. Let's look at the advanced decline if we can, and what we'll again see is a bit of choppiness at the start of the day, and thereafter the bulls have really again taken charge, and the breadth of the market continues to be positive, and that again stands out, especially in the last 4 trading sessions. We gained 2% Friday, 2% Tuesday, and now we're nearly 2% higher even today. So 4 consecutive days and solid days at least in the green, and that's how it's played out. So that's the positive. But broader markets, Mahima.
Right, absolutely. So the broader markets are also pretty much sanguine. Also, I mean, not to the extent that the benchmarks have the fashion in which the benchmarks have recovered, but in terms of the mid cap 150, it's up by about 0.7 odd percent. The small cap 250 also up by about 0.6 odd percent. Let's also take a look at what sectors are doing. Of course, Nifty IT under pressure, but Nifty IT has also significantly recovered. There was a point in the day where it was down by about 2 odd percent. All sectors in green, it has recovered to around 0.05% in the positive. Nifty Bank, of course, leading the pack up by about 2.4 odd percent. Nifty Finance also up by about 2.4 odd percent, followed by PSU Bank up by about 1.7 odd percent. Nifty consumption doing well, up by about 1.4 odd percent. Oil and gas, energy are some other counters which are doing pretty well in trade today. In terms of stocks and counters, amongst the universe of the total market, some counters doing pretty well in trade today include your nuclear software up by about 12 odd percent, Fusion Microfinance up by about 11.5 odd percent. Restaurant brands is also up by about 8.6 odd percent, and there are rumors being told about restaurant brand that Mr. Adani has bought in stake in the counter, and we're seeing the up move in the past 2 or 3 odd days. Significant up moves coming in restaurant brands as well. JTL Industries, Spandana Spurti, GMM Fodler are some other counters faring well in trade today, but some counters which have kind of cratered. And this is on the back, of course, earnings as well as everything that's happening across, the markets right now. There are counters like Wipro, which is not doing well in the Nifty 50 basket. And if you can also pull up the NSE 500 and see, what counters are doing well and not doing well. There's Sonata Software down by about 0.6 odd percent, Wipro down by about 4 odd percent, GSK Pharma down by about 3 odd percent. So these are some of the counters, Harsh.
I'm surprised you've not taken Delivery's name. Up
yeah,
7%.
It's about 9 odd percent now, I think. Let's pull up that chart and see. It's 8.9 is what I saw, I think. There you go. No, it's 7%. Yes.
So 7% higher on a Delivery. A Fact is up 13.5%. Some fertilizer names really doing well in any case over the last couple of days. So Fact also one of those. But let's quickly welcome on board Kush Bora, founder kushbora.com, to talk to us about markets and more. Kush, with regard to the Nifty 50, lots of zing in it today. What's the outlook going in? It's a truncated week. What's the outlook going into next week?
Hi, Harsh. I think greed is good. Yesterday we were speaking about how greedy you were being when the indices are taking a break. But no, I think funny things can happen on expiry, right? And then let's not forget, today is also the weekly expiry for Nifty, and in all likelihood, the call writers at 23,600, 23,800 have been taken to the cleaners. For now, let me start with the broader view, which is obviously that the tide seems to have turned, and the indices and a lot of sectors are participating, so it's definitely a bullish turn. But if you've traded for, let's say, the very near term, about a week or 10 days or so, and you're sitting on very handsome profits, yesterday I spoke about taking partial profits home. Today I would say book it out completely, because now we've gone into the zone of excesses where Nifty's also hit the overheated territory. Bank Nifty has gone too far into the overheated territory. So I won't be surprised to see some kind of a pullback coming in the next week or so. However, that decline should also be taken as a buying opportunity. But for now, irrespective of the truncated week, it's not a bad idea to go out and book some profits and just wait for the market to be kind enough to give you that tip to re-enter.
So that's the texture, that's the structure you're looking at. How much of a pullback are you expecting, Kush, at least on the Nifty 50 and the Nifty Bank as well, because you've given calls on both?
Great question. See, what's happening is that every time index is moving about 200 to 300% higher, the supports are shifting upwards. That's on the Nifty. So, earlier 23,000, then we saw that base on 23,300, and now we're seeing a strong foot base on the 23,500
Can
level.
we get?
And hence, I think 23,500 to 23,400, is the zone where, if you do get that kind of a drop, you should look to accumulate. So about 300, 350 points from here, maybe a little less would also do. On the Bank Nifty, about 53,000, 53,200 kind of levels. Now, the supports are shifting higher. 52,000, 52,500 have a good put base on the Bank Nifty. So somewhere close to 53,000 should be a good pullback to re-enter. Let me just reiterate, this is from a very near-term perspective. From a medium-term perspective, as I said, the tide seems to have turned now.
Right. Kush, you did talk about profit booking, but any counters that are still looking attractive to you right now that you would want to go ahead and buy?
Oh, absolutely. The texture of the market is such that, you've seen a lot of action, on the broader end of the spectrum as well. The stock-specific action isn't abating, right? Now, while we've seen in the past, if you skip the whole of last year, even before we've seen, while the market could, be in a place, the stocks could do their own thing and, move higher. So even now, I've got two calls and both of them on the long side, despite the kind of, mildly cautious view, or a near-term cautious view on the Nifty and the Bank Nifty. Apollo Hospitals, we've discussed this stock in the past, continues to do well. So that's a reiteration of a call. 71, 40, 70, 300 are your targets. 68, 70 is where you place that stop loss. So yeah, good moves on this one. Will continue to do well going forward as well. From the banking space, I've got City Union Bank. Again, like most of the pack, this too has done well on the back of good volumes. 200-day moving average taken out, golden crossover, of the smaller averages. It's got a few things going for it. So 182, 188 are your targets, 172 is where you place that stop loss.
Right. Kush, what's your view with regards to fertilizers and chemicals Travancore? Because, in the past few days, it has silently moved. In the past 5 days, it's gained over 25%. And today, we are seeing significant up moves. It's up by about 13% right now. 1 month also, it's fairly done well, up by about 20%. But do you think now it's the time to book profits, or do you think this momentum will sustain?
Mahima, you're referring to fact, right?
Correct.
Sure. So, in fact, if you recall, we've been bullish on this space for a while now. Chambal Fertilizers, was a call that we've initiated about 10, 15 days ago. Coromandel also was one of the picks that, we've discussed. Fact was one stock which hadn't really participated. So, if you ask me, this is more of a catch-up rally. And despite the kind of 13% up move, it doesn't, deter me, at least technically, and given that this is more of a catch-up move, that, you could still perhaps go out and look to accumulate. Fact, the target on the upside is 810. Once that is taken out, you're looking at an 880 kind of a level as well. Stop loss comes in at 710. So despite this kind of up move, there is still some upside to be had. Because if you look at something like a Chambal, made a low somewhere, early this year, end of Jan, whereas Fact made a low just recently, right? I mean, about, a month or so ago, maybe less. So I think there is a lot of catch up to do. The Fact, I won't be surprised to see move higher to 880 levels. But I still prefer the likes of Chambal in this space.
Okay, and what about your reading with respect to where Nucleus Software is concerned? Because even that stock is gaining significantly in trade today.
Nucleus Software, right?
Yes.
I'm afraid I'm having some. Okay, got it. I was having some difficulty, getting the charts up. But no, this one has consolidated for a while. Was seeing a bit of an up move now. Couple of things in terms of resistance going for it. One, the 1000 level will start acting as a psychological and also a technical resistance. From a short-term perspective, the stock is overheated. So the best way to play this would be to buy on declines, where a slip towards 950, 945 zone should be taken as an opportunity to accumulate. If you have these stocks or Nucleus Software in particular, not a bad idea to continue to hold because there's momentum. But fresh positions aren't warranted because of the risk-reward ratio. So a pullback towards 945, 950 should be taken as an opportunity to accumulate afresh.
Kush, within the Nifty Bank, you've got several large movers and, would be a real miss if I didn't ask you your views with regard to some of them. And ICICI Bank is up 3.5% and SBI is up 3.5%, Kotak is up 3%. On some of these large gainers and an HDFC also up 2%. What's the view like? And and Axis is also up 2.9 odd %. So some big gainers and these are large cap banks as well. These aren't small in size either, and therefore the move is significant.
So Harsh, I mean, if you talk specifically about HDFC Bank, we know that the stock hasn't done practically anything for the last 4.5 years, 5 years, and all sorts of reasons, technical, fundamental, money supply, what have you, all sorts of reasons can be attributed. So I think the upside to this one in terms of a catch-up rally with some of its peers is fairly high. So there's a good possibility that you could see levels of 2,000, 2,100 in the coming months, on HDFC Bank. And as you'll recall, in the recent past, we've discussed that if you want to stay within the banking space, it's not a bad idea to stay with HDFC and ICICIs of the world, and in PSUs, perhaps something like an SBI and a Canara Bank. So continue holding on to these. There isn't anything yet suggesting that the momentum's taken out of these names. Perhaps you might want to pick and choose where Kotak is also playing a catch up, but I would still prefer an ICICI over a Kotak. SBI from the PSU pack. Also, let's remember one thing, that if the FII money is coming back, and there are very early signs of it, but if it is coming back, we know that banking, especially the likes of HDFC, ICICI, and SBI, will be one of the key beneficiaries of that. So with that point also going to their credit, of course it's a big question, but if that does happen, then there is still a lot of room and a lot of money to be made on the upside. And let's not forget the margin of safety angle as well in times of volatility.
Kush, you've given us a view from a 6-month perspective. How should we look at it from a trader perspective? So are these good levels to buy at this point from a trading perspective?
Let's say, if you have a week or a 15-day kind of a time frame, then yes, I would say, you might want to perhaps wait it out just a bit, because when I talk about Bank Nifty slipping, let's say about 1,000, maybe 1,500 points, and purely on account of profit booking, obviously some of these names will also cool off, right? So then, it's a good idea to buy these also on declines, as is the case with Bank Nifty. So a dip towards 1880, 50, that zone on HDFC Bank, a dip towards 1375 kind of levels on ICICI Bank, that would be a good level to accumulate. While they aren't particularly overheated, but yes, with the kind of sharp move that we've seen over the last 5-10 sessions, and some cooling off, which is very likely on the Bank Nifty, these heavyweights will for sure participate. So if you're a trader with a view for a week, maybe 10 days, then you should wait it out and use declines to accumulate rather than go in right now, because the risk-reward ratio will not be favorable buying at the current.
On a day when markets are certainly showing plenty of zing, Mahima, we have an NDTV Profit exclusive. Of course, we have the global trade war, which is heating up. There is a rising trend of FDI interest in India as well, and that's one of the reasons why banks are perked up. We're seeing continuous flow from an FDI perspective. But what's the possibility of setting up manufacturing base in India? My colleague Shrimi joins us with more perspective on this count. Shrimi.
Yeah, so what we have been given to understand, that government has received 20 plus foreign direct investment queries in past 2 months, and this is mainly to set up manufacturing base in India, and these queries are spanning across sectors, but mainly into chemicals, electronics, textile, and they are saying that government is examining these proposals, and in fact notably some of these proposals, at least 7 to 8 such proposals, are related to joint venture with a China backing investment. So they are saying that they are looking into those, and they are getting a lot of these queries as far as joint ventures are also concerned. Now 2-3 scenarios are at play, is what sources indicating us. One is clearly that all these foreign players are kind of restructuring their investment strategy for India, and kind of looking at how to sort of diversify their supply chain as far as Indian market is concerned, and a couple of reasons for that. One is, of course, the kind of tariff situation we have. India has competitive advantage over global peers, and the kind of policy we are offering to these companies, particularly in the form of PLI schemes, that is giving a lot of certainty for these foreign players to come to India, set up their manufacturing base here. And also remember the way we are handling this entire tariff situation with the US. We have already started talking on the bilateral trade agreement. The talks are ongoing, and in fact we are hoping to sort of conclude that deal by September, October. So that is giving a lot of certainty as far as global companies are concerned, and they are trying to sort of leverage the way we are handling it, and it's very cost effective for these companies also also to have a very, ecosystem and, indicating that we are better positioned, if you compare us from other markets like, Vietnam, Bangladesh, Taiwan. So yes, the indication is coming at this point of time that they are realigning this entire investment strategy, and that will be reflected in the coming months.
All right, Shimi, thank you so much for breaking that down for us. And in fact, the highlight and takeaway from what Shimi said, and a lot of analysts have also been saying this, that India is much better positioned as compared to other countries where tariffs are concerned. But, circling back to what we were talking about, that is the banking space. We've talked about a couple of factors that are playing in favor of bank. First of all, valuations, and you've always advocated as to how valuations are lowest right now, for banks. Considering rate cut, and we're also penciling in that FY26 overall is going to be very good for financials, right? Do you think that this kind of up moves is kind of already penciling in, because we're also seeing a lot of FIs also buying in ICICI Bank, HDFC Bank, Axis, as well as SBI as well. Do you think that these factors are now getting penciled in, and this momentum should, after a given point of time, stop? And if yes, when?
Well, in fact, Mahima, it's the reverse. FY26 may actually be a tepid year for banks in terms of earnings, because what you will see is you will see yields, which is the loan rates come down due to the repo rate cut. But you may see deposits start to reprice in a slower fashion. We had Ashwini Kumar Tiwari, who came in the morning, SBI Managing Director, and he spoke about this trend. So you may actually see the first half of this year be slower where banks are concerned in terms of the way in which the numbers start adding up. It may actually be back-ended. Maybe the latter half of this year may start to see better numbers where banks are concerned. But two things I believe driving the flows today, and we'll also ask our guests on the show, but the sense is that two things driving flows. One is valuation comfort is available there, and therefore likely that is one piece. The other piece is the FII interest right now. Last couple of days we've seen strong FII buy flows. Maybe not $500 million, but roughly about there, 3,000 to 4,000 crore rupees of buying by FIIs. And generally they'll opt for pockets which are under-owned at this point by FIIs themselves. And right now banks are, in that sense, in relative terms, under-owned by FIIs, and therefore they're just shoring back ownership. But let me bring in Vineet Bulinskar for exactly this. Vineet, welcome, good afternoon, thanks for joining us. Opportune time. It's a day when the Bank Nifty is rallied. It's a great question by Mahima. What's your sense? What's driving the Bank Nifty outperformance from a fundamental perspective? Vineet, I'm not sure. I believe you're on mute.
So over the last couple of months, we have been writing reports only on banks. And we believe that, contrary to the market opinion, banks are going to do relatively better. And it's already being visible on the screen. So, my quick take is that, you have to understand that China is the fundamental enemy of USA. And it doesn't stem from economic positioning itself. It generates from, your fundamental security concerns. Because if everything is going to be made in China, then tomorrow China will have a hold on US. So Trump is breaking away from that. And given the cost structures of the United States, you cannot have cheap production, and that has to be outsourced. And most of it, as an alternative to China, is going to be India. Okay, so that is what we are seeing happening, and that is also being played out in the FDIs that are being inquiries that are coming in. We are also on verge of signing an agreement with them. We already signed a framework. 3 countries are in advanced negotiations: South Korea, Japan, and India. And clearly, US understands who are foes and who are enemies, and that is going to be a very big driver for the economy. So from that perspective, if you see banks, interest costs are down, liquidity is injected, we have got abysmal valuation multiples, ROEs are very high, NPAs are, at cyclical lows. And, with the policies of the government on taxation, consumption boom in India is going to grow significantly. So, you might have slight reduction in NIMs, compressing. But, we'll make up for by the growth in numbers and growth in, the GDP growth that will take place through all these initiatives on manufacturing.
That's a very comprehensive view, Vinny. Thanks for that. And continuing with the banking theme, following last week's 25 basis points repo rate cut by RBI, SBI has also reduced their repo-linked lending rates. Earlier in the day, we also spoke to Ashwini Kumar Tiwari, Managing Director at SBI, about how this will impact the margins. Listening.
So existing loans, as I mentioned, those which are linked to the external benchmark, which is repo rate, has immediately happened. We also announced on 15th of April, external benchmark rate cut of 25 basis points, which is the RBI's reduction. So that has already happened. Now, in case of deposits, as I mentioned, the rate cut which has happened is applicable to new deposits. Older deposits will continue at the contracted rate. And as they mature and are brought again for depositing again, that is the time the reduced rate will kick in. So therefore, there will always be a lag in case of rate cut in terms of the deposit rates getting priced in, and therefore there will be some initial pressure on margins.
I always love listening to Mr. Tiwari, one of the finest minds within the banking space. But we also spoke with IDFC First Bank, completely different peg on that count because they've approved a fundraise of 7,500 odd crore. Warburg, Adia coming in. It's interesting to see, Mahima, that foreign investors are now interested in banks in a big way. Right. This is of course a direct vindication of Indian banks and possibly one pocket which they believe is well valued from a long-term perspective. But let's listen into what he had to say with regard to the next stage of growth for IDFC First Bank.
All of these raises have all been above book value per share. All. So every one of them adds to book value per share because you're giving new shares at a higher price than the book value. So the book value per share after this transaction will touch close to 53. But that's one point. That's one part of the story. Now, I think a more fundamental question should be that why you're raising capital, so much capital, why you're raising so frequent capital? Is that the question simply? I need people to understand this basic fact that if you look for a bank which is like 35 years in existence, they're already running to peak profitability. So their capital is almost equal to the return on equity. The growth is almost equal to return on equity. They can keep on forever. But for our bank, starting from zero. So for a bank which has a zero return on equity to start with in 2018 or 19. So, right now, let me call it around maybe 7-ish or so if you take out MFI impact. So your return on equity is 7, growth is 20, the gap has to come from capital. But the good news is that 0 has moved to 7. We believe 7 will come to 15 or 16 also. But it's a phase. Early stage bank, every bank starts low and then becomes, bank like ICICI or HDFC. Think about how ICICI raised capital 20 years ago. They raised $5 billion in 2005, $3 billion, something like that in 2005. That's one of the capital initial stage people raise.
Vineet, I wonder what you make of this. Something like an IDFC First. It's a small bank in relative terms, in terms of size. It's valued at around 1.1, 1.2 times price to book. Has demonstrated strong growth, has its set of challenges, but has been raising funds. And this is where the concern lies. It's been raising funds at 2 times price to book, 1.6, 1.7 times price to book, now raising at 1.1 times. Is that at all a concern? And just give us your views on the bank itself.
So, we have initiated a sell on IDFC Bank. And it is precisely for this reason that the amount of funds that they need to raise to, meet capital adequacy and also to grow in the future and take into account the NPAs buildup that is there is very uncomforting for us. So we believe that equity dilution will lower the growth rate of the bank. And we think that the bank should be valued below 1 multiple, given all these concerns that we have.
So that's the view with regards to IDFC First Bank. Vineet, in terms of shifting focus to the consumption space, we've seen a lot of notes coming in and talking about the high valuations versus growth not happening, and there was an interesting CLSA note saying that the growth versus the valuations at where these staples stand is completely detached. What are your views with respect to how consumption and especially FMCG staples will play out in FY26? Do you see some improving trends there, because we're expecting good monsoons? We're also expecting the benefits of tax rate cut coming in, plus inflationary pressure overhang which was there in FY25 overall is slowing down now. So even that will play its part, and price hikes have already been taken. So what's your view with respect to where these staples are concerned?
I think we have a positive construct on these, and we believe that they will do well. We like Devyani International among consumption themes. Your HOL looks very interesting. So these are a couple of names that we like. And while, the growth story is still not present, but, the macros are well in place. And then you'll have all these factors, connive together to build a growth story. So you have to be invested out here because, from this, you have nothing to lose from the current levels.
Okay, so that's the view with regards to where staples are concerned. With that, it's time to slip into a very short break, but stay tuned. We'll be right back on the other side to get you all the news and, of course, chatter behind the dealing room as well. Stay tuned.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice. only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers.
Welcome back. You're watching India Market Close here with us on NDTV Profit. Now, that time of the show where we bring to you everything that's happening with regard to all the chatter in dealing rooms. And this is, of course, our daily segment, Heard on the Street, which Somit does. Somit, what is it that you're hearing? And again, one more time, you've got us a hit with regard to IDFC first. So, yes.
Well, as our lower band was saying that bulls are taking charge, I have a negative news to start off with first, and that's on Maruti Suzuki. What dealers are indicating is that the domestic institutional investors have been selling shares of Maruti at higher levels. Whatever the rise we have seen for the shares, every rise is being sold on is what the dealers are indicating ahead of the 4th quarter numbers. The company will be reporting its numbers next week, April 25th. So keep an eye out for Maruti in trade. JSPL is another interesting counter in trade today. Today morning, Morgan Stanley in fact had downgraded their rating to equal weight from overweight on JSPL and cut the target price to 900 rupees from 1200. But despite this, we are seeing such kind of an up move in the share price, around 4% up at one point of trade. And what dealers are indicating at this is that this 4% surge is on the back of the buying action that we are seeing from large HNIs on JSPL counter. When it comes to Axis Bank, the Nifty Bank Index has been in momentum for the last 4 trading sessions. It has been continuously gaining. But in the dealing room, Axis Bank is one name that has been standing out. Dealers are indicating that there are strong buy flows on both domestic and FII front when it comes to Axis Bank. And what dealers are also saying that if you see in the last 6 months, Axis Bank has actually underperformed its larger peers, that is HDFC, ICICI and Kotak Mahindra Bank. And this could change going forward is what the dealers are indicating. And lastly, SpiceJet and Colgate India, both these counters have been given a positional buy call on multiple dealing rooms today in broking firms that we are seeing for SpiceJet and Colgate. Now for SpiceJet, one of the logics given is the fact that the Q4 numbers are expected to be very strong for this company given the fact that there was higher air traffic and higher fares. And for Colgate, now if you remember ahead, we had got some Q4 updates that had come in, but the street is now saying that the 4th quarter numbers might not be as bad as they had feared when the operational updates had come in. So keep an eye out for Colgate as well in trade.
All right, thank you so much for that, Somit, and thank you so much for breaking that down for us as well. I'll go to Vineet. I think I'll take his view on SpiceJet versus Indigo, because today we had an interesting note which has in fact downgraded the price target for SpiceJet, and of course Indigo is going to be a better beneficiary where the entire Mahakumbh playout will take place. Vineet, your view with regards to where fundamentals are concerned for both of them, and of course Indigo versus SpiceJet.
So I think Indigo is self-explanatory. It's the market leader, maximum market share, and everything got going for it. But we don't think that SpiceJet is a sell. Our simple take on this is that the industry is here to stay. It is going to grow very aggressively. Airport additions in the country are only growing. International travel, domestic travel is picking up very aggressively. And what's more important is that, SpiceJet, while not cheap compared to Indigo, but they're doubling their fleet over the next couple of years. So earnings growth is going to go into hyper momentum over the next few quarters. And hence, we think that, at the kind of valuations that it is available at, we think that the market cap is very, very tiny for a player of national relevance. So I think definitely once it gets out of the woods, and it's on a better fundamental backing in terms of financial muscle, we think that the faster priced action will take place. Until then, I think this stock, you have very little downside out here, nothing to lose. And it's a very high risk, high gain play in a sector which has got significant tailwinds.
Okay, some interesting news coming in. Hi Vineet, hi Kush, on this whole sunscreen war. A little bit of an aside, but both are listed companies. HUL and Honasa is what I'm talking about. So I don't know if people have followed the story, but HUL and Honasa have been fighting online on social media over a sunscreen ad. And here the Delhi High Court seems to have ruled in Honasa's favor. So the Delhi court order says that HUL in its ad should say some sellers instead of online bestseller. They have to remove the light yellow, orange color in packaging and use any other color that is not close to Derma Company, that is the product for Honasa. They've ordered HUL to discontinue their ad campaign and asked them to remove all online ads within 24 hours and remove the hoardings within 48 hours. There's also a hearing in the Bombay High Court, so we'll have to wait and see what happens. But just quickly, curious to see what's happening with the stock of both those companies, HUL and Honasa. And of course, not massively stock moving news for either, but interesting from a Honasa point of view that is taking on a giant like HUL. This is a space that you're tracking very closely, Mahima, and it gets very heated and competitive.
Yeah, absolutely. And in fact, especially in that the basket of especially cosmetics, it is getting extremely competitive, and it's not just the listed space, it's also the unlisted space which is giving a significant competition. And packaging is one such thing which kind of attracts the customer, and it's important to fight over that as well. So I think Honasa is completely kind of taking over and making sure that something that is their product. But Derma Company, if I'm not wrong, is an acquired product. It's not originally a Honasa manufacturer owned product. But yeah, so that is how things are heating up right now and how competition is playing out as well.
Even if it's acquired, it's okay. It's a win for Honasa in this case. Today's, win for anyone who stayed invested in this market, I think, Harsh. That's the biggest story.
Yes,
just the point, because you track banks so closely. Just firing up on banks ahead of the results. I'm just wondering if Street is setting itself up for a little bit of a letdown. If there's any kind of a miss on the numbers we'll see on Saturday.
Well, that could be a possibility, Tamanna, and we've just been discussing that on the show as well. That could be a possibility, but it's the very strong FI buy number which is likely driving the way stocks are moving, and it's also the fact that some of these counters versus historical are trading at a decent discount as well, and therefore maybe to some extent warranted. We spoke with Vineet on this as well. He was also super bullish with regard to how banks are concerned. So from a medium-term perspective, surely it looks decent. Kush, not so positive from a short-term perspective. So that's the brief summary of the views we've taken over the last half an hour for you as well as everyone joining us.
Yeah, that recap is important. I'm just wondering how high can an ICICI Bank or HDFC go post this, and whether in the rotational play, what's next. Kush, let me come to you on that piece. Because even as the bank rally is leading the entire market, the broader indices is also looking fairly decent. Would you say that there is space for a recovery in IT at any quarters? Remember, we might hear from Infosys in another hour or so, less than an hour or so. I mean, sometimes it comes in right a couple of minutes before close. But do you think IT is set to join the rally at any point, the Nifty, IT or any of the individual stocks?
Hi, Tamanna. Why Tamanna? I mean, why do we want to dabble in a sector which, if I recall correctly, yesterday Neeraj said, I think there are a lot of mixed views on the street across all sectors, but one trade is consistent, which is still IT, right?
No, but can I tell you something, Kush? There are enough people out there who are saying that the worst may have been priced in. The deal pipelines, if you look at it, are not that bad. And I mean, the whole space is shaky on the basis of management guidance. One could argue that the management is being very, very sanguine by saying that it could be terrible. They might surprise on the upside.
No, so Tamanna, I've spoken to some of those candidates, some of those investors who say that this is deep value. They've been they've been selling off for some time now, and this is a good time to buy and hold. I agree if you have a 12, 18 month, maybe 24 month kind of a time horizon, right? Because how long could these stocks be beaten down? That is one question. But if you ask me from a near-term perspective and from a purely technical perspective, I would believe that once I see any kind of price action, right now we've seen a bout of recovery, right? It's not that that recovery hasn't come about, but if you recall, what we've seen is there's been bounce from oversold territories, and that's been taken as an opportunity to sell further. So Infosys, TCSs of the world haven't really impressed, at least on terms of price action. Once some key levels being taken out, let's say 1500 on Infosys, maybe 34 on TCS. Once you see that meaningful, sustainable bounce, is when they make a good candidate for trade. At least if you want to trade momentum. Other than that, you've got a lot of other sectors which are at play. So if I had capital to deploy, I wouldn't deploy them in the IT names for now. And hope for momentum rather than actually play where the momentum is, which is banks, some cement names, healthcare space, and within that hospitals. So I would wait and watch, but they wouldn't make a trading bet for me just on the basis of them being oversold.
Well, vehemently making a case that it's not a trading bet, Kush. But Vineet, what's your take? Would you go contra at this point?
On which stock?
On IT as a sector.
Why would not touch it even with a barge pole?
Okay.
Sorry, so Vineet, I'd like you to elaborate a little bit on that. So what would you like to see in terms of sensing that there is a recovery at play? Would you want growth to come back significantly, or would you in general not want to touch it because these are slow growing giants?
So I just want to highlight a couple of things that are going on. Is that we build models for all the IT companies, though we've not released reports on them. Today they are at fair value, and if you would be wanting to buy stocks, you want to buy them lower than fair value, at least 20%, right? So I'm looking at a point in time where they're 20% cheaper to look to buy them. Number one. Number two, if you see the numbers that are coming out, slowing growth, right? It just doesn't pick up. Third thing is that, AI has become so part of everyone's life. There is no need for IT, if I may say that. You just need managers who can build you flows. And for that, you don't need IT. And the first hit that is going to come in the business consultancy space, and it will trickle down to the IT consultancy space, because employing a $100,000 person as an IT consultant in-house, and rather than outsourcing that to a IT consultancy, okay, and both are going to be using ChatGPT and LLMs to drive solutions. There is no need of outsourcing that activity anymore. So I believe that there's a fundamental shift in how business is going to be done, and we are going to see several downgrades, degrades, unless and until these companies innovate. And sadly, they're not, despite having billions of dollars of reserves and cash flow generation, they've not even tried to build a product. It's very saddening at that end.
So this is a sector, Tamanna, which is down 33%. Vineet says he won't touch it till it goes down another 20. Just kind of putting it out there. And thereafter he'll consider it because they haven't done the right amount of or the right type of investing over the last many years of the billions of dollars of cash flow that they make. Just kind of summing it all up there.
I mean, I don't know if there's a contrarian view at all over there, Vineet, but you've said it well. Perhaps the worst is behind us on IT. Vineet and Kush definitely do not agree. But let's focus on the stock of the day. ABB is in focus after the global business reported stronger than expected India order growth in its first quarter. Anushi is telling us why ABB is buzzing today.
Right, so what we are seeing for ABB India is the results for the first quarter of ABB Group, and this is the first quarter results that we are looking at. The company follows a Jan to December calendar year pattern. So what has happened is that the ABB Group, for its India business, it has reported a 1% of a growth. Do note that the expectation for a negative growth, so anything in positive is a big positive for ABB's prospects in terms of where the order inflows are concerned. So a big positive on this side. But talking about the ABB other numbers as well in terms of how the revenue has fared, how the EBITDA margins have. If you look at the total revenue, they reported a growth of around 3% at $7,935 million, which is lower than the guidance of about mid single digit that the company had given in its earlier quarter. So while this is a factor that has been because of the kind of global environment that there is building on, it's the EBITDA margin number which is another standout for the quarter. Now EBITDA margins have seen about still at 20.2%, seeing an improvement of over 200 bips, and this is above the guidance given where the management had expected that the margins would remain majorly stable. This was led by higher pricing, better pricing environment as well. So this was a big thumbs up along with what the order inflow prospects were for the company. Overall orders, if we see, they reported about a 5% growth at $9,213 million. But let's also take a look of how the company's ABB Group's order inflows have fared as compared to ABB India. So we are seeing a similar kind of a trend in the past quarters as well, where ABB Group, last quarter we saw about a minus 21% of a dip in its order inflows, when the ABB India had reported about a 14% of a dip, while if you look at the other 3 quarters wherein they had seen a positive growth, it's a higher than expected growth that we had seen for ABB India. This is 9% against 11% of a growth that we are seeing at. So focus would be now on the first quarter, wherein ABB India may see higher order inflow growth. That is something that we should be watching out for. Another factor that should be considered is the company now plans to spin off its robotics division, which is expected to be listed in the second quarter of FY26. So that is something that we should be looking forward on how the robotics business would be. Also, the company now has maintained its CY 2025 outlook. Majority of the factors have remained steady, which includes the likes of revenue growth being in the mid-single digit, positive book-to-bill ratio being there, and improvement in the EBITDA margins. However, they did state that the global environment is something where there is more uncertainty building on, so that is one factor that should be considered. But overall, a net positive result that we are looking at, of course, the main focus being on the order inflow pictures for ABB India. That's the reason why the stock is up in trade today.
Right, thank you so much for giving us that information, Anushi. Vineet, I'll take this up with you. Interesting company. You know, over the past 5 years, the growth CAGR for the company has been over 40%. In terms of dividend payout also, it's a good company to have in your portfolio. How do you see growth coming in for ABB India, as well as how do you compare this to the likes of something like a Siemens? Vineet, I think you're on mute.
Both these stocks have their own, growth metrics, and I think both should be a part of your portfolio. High growth rates will continue, and I think you can see steady compounding of these stocks in your portfolio. So my view is to go buy both these stocks together.
Sorry, quick follow-up. Do you also like a Siemens, or between an ABB and a Siemens? Is there a preference you have?
No, as I said, it becomes a part of a portfolio where you add both.
Okay. Point taken. Also, you've got a couple of stocks which are really flying in trade. You have Fusion Micro within the lending basket. You also have an SBI Cards, where we had a positive view coming through, some possibility of some of the overhang with regard to unsecured going away. Vineet, I wonder whether you would try to play that, because Fusion Micro and Equitas and SBI Cards are some big movers in trade today. Is this a start of a potential opportunity where you could see 20-30% returns in a very short period of time? If things were to improve, would you venture in that angle of things?
So, you talk from IndusInd Bank to Credit Grameen and all the other players. All of them are, of the opinion that things will look better from now onwards. Number one. Number two, the government scheme, I forget the exact name, is providing them significant insurance from, the losses that accrue from these microfinance lending. So to that extent, I think the entire pack of SFBs and these lenders are due for a re-rating. Their valuations are abysmal. And typically what happens is that you have a good growth period, then you have a slam dunk, which they've gone through. And now they're going to pick up again. So they'll have another 2.5 years of cycle. It may not roll out this quarter, it may roll out from next quarter, but definitely well positioned to benefit from this. So good to have a small allocation, 1-2% of your portfolio to one of your favorite stocks from this segment.
I'm loving how credit quality concerns have not just ebbed but seem to have vanished for this entire microfinance space, which was the biggest talking point not less than 3-4 weeks ago. Just follow up on that, Vineet. What do you think? Is there any factual reason for those concerns to have ebbed? Was it not as bad as was expected, or right now in relative terms in a rotational play, the space is looking better?
So as I mentioned, most of these players are going in for the government-backed insurance scheme, which protects them from the adverse effects of NPAs from this segment. And that reduces a large amount of risk of lending to these segments. So that takes a lot of the asset quality concerns away, and hence you're seeing a re-rating take place.
Okay, so government intervention has sort of moved in. All right, let me go across to, I think, a stock which is definitely a bull versus bear case. You should hear both sides of the story. If you've heard to Kush and Vineet so far, you've definitely heard the bear case. But I'm going across to Puneet to talk about Wipro. Puneet, what is the bull case, if any, for a Wipro today?
Well, there are a few points we've put together, but a bear versus bearish case is something that I would like to rename this particular segment. Not too much positives essentially in this particular results for Wipro. While the large deal wins were a key positive, and that's the first bull case specifically, up 17% on a year-on-year basis as well. They were largely expected because of the new, UK insurance deal that the company had won a couple of months ago. So it was expected to come in and also boost the revenue as well as the EBIT margins, not to be at least in this particular result. We've seen, the deal wins not translating into any kind of revenue growth, and that's the first bear case essentially. If we can move on and look at the second key bull and bear case, management has mentioned that they're expecting revenue to recover in H2 specifically of FY26. Europe is something that they are positive on going forward, so something to watch out for. But sequential guidance in Q1 of FY26 is a huge negative. Negative 3.5 to negative 1.5% growth is what's anticipated in Q1 of FY26. Brokerages had penciled in a negative 1 to a positive 1% growth actually. So it's a big negative there, which essentially has triggered most brokerages to come out and actually mention that FY26 might be a year where the company might actually not grow revenue for the third consecutive time. When you look at the third bull and bear case, they are endeavoring to maintain margins in a narrow range, and that will give some solace to investors going forward. But they are expecting clients to take a more cautious approach going forward on consumer discretionary spending, and hence that will lead to project delays as well. Finally, in terms of valuations, currently at 17 times price to earnings for FY27. Now, that is actually the lowest amongst the large cap players, but there is no growth in sight. So essentially, it might not actually be a value play, but a value trap maybe. And brokerages are also penciling in that aspect. They are saying that this could be, of course, the third consecutive year of revenue decline, and margins, while improving from the 15 to 16% to going all the way to 17% for the last 2 quarters, the playbook for Wipro, might be in terms of growth, and that's currently not in sight. So overall, there are a few aspects moving around for Wipro, but not too many on the positives.
Okay, thanks for that, Puneet. The other one which is really moving in trade is Sonata Software. Puneet, would love your view on that as well. But we'll do that in just a minute. Let me quickly go across to Vineet Bulanchkar. Vineet, I know you're not in favor of the large cap IT, but how would you play IT therefore at this point? You can't completely ignore it. Would you play through mid small cap? Are there any specific counters where value has started to emerge within the mid small cap space? Or would it be ER&D, or would you ignore it completely?
So Sonata Software, by virtue of its performance, it's a very low-lying stock and very under the radar, and they've generally been performing very well. So that is where the stock would lie my interest. Persistent is another stock which is very, very AI heavy, and they've got good credentials around that, is what I would be looking at. But apart from these, I would tend to stay away from the IT back.
How many ways Vineet will find to say, nahi, lena hai IT bhai. So I think he's very clear on it. Okay, what's happening with Sonata? Let's get the update from Puneet.
Well, yeah, thanks for that. So, it's lowered its Q4 FY25 estimate, and that's because Sonata's largest client has essentially, pulled back a bit in this particular quarter. International revenues is expected to be lower in Q4, and revenue is expected to decline higher than what the company had guided. They guided for a 3.5% fall in revenue in Q4 of FY25. It might be higher now because of this aspect. Now, essentially, the largest client could be Microsoft, and LTI, Mindtree, as well as Persistent are vendors of Microsoft. So we might see some impact on those stocks as well. We saw that in the morning. That's one key aspect. International revenue is roughly 25% for Sonata Software, and is a high margin business as well. So that's one of the key negatives. While the stock has recovered from roughly about a fall of 12% today to roughly between 5 to 6% now, I think there are more questions in this particular quarter specifically. Now, in Q3, they had mentioned that the TMT vertical is, ramping down because of clients having essentially pausing the expenses. But this new update, which has come just last night, of its largest client pulling back a bit in this particular quarter, is largely a negative.
So that's bound to happen. That's bound to happen at tough global conditions prevail. So we've been talking about a sector which is down in the dumps. Everything else is up and about. We're above the 23,800 mark, staying there. Bulls are firmly in charge. We're going to take a very short break. We're going to come back and tell you what positions you need to put into place for a long weekend ahead. I will get you more on that. Meanwhile, Kush and Vineet, thank you so much for joining us on this leg. We'll be back with a fresh analysis and views after this very short break.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election, because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea?
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the
Welcome back. Bulls firmly in charge in this, thank God it's Thursday, and let's celebrate the long weekend trading session that you're seeing. It's just been a fantastic move up through the day. I just want to pull up the Nifty intraday for a second just to give you a sense of the kind of very tepid start that we had. But once Bulls took charge, there is really no turning back. 23,850, just crossed the 23,600, then 23,700 mark, and now 23,850 with such ease is astonishing. What's leading it? Banks are leading it, no doubt. ICICI all-time highs, HDFC, public sector banks coming in. So are your small finance banks, which is interesting. IT languishing out on the sidelines, but there has been an improvement even there, no doubt. To speak more on what to expect in the coming week, I'm joined now by Sandeep Agarwal, fund manager and co-founder Savilo Investment Manager. Sandeep, very good afternoon to you. The problem is that we've seen this story play out before, a bear cycle and then few sessions of euphoria. Question that comes to mind is that are we seeing short covering? Are we seeing an undersold market getting corrected, or are we seeing now a bull leg of the rally that will continue for some time? You're on mute, Sandeep.
Yeah, hi. Thanks, and thanks for having me on the show. So, I have a very different perspective. Maybe, not everyone will agree, but I will put my thoughts here. So, I believe that when COVID happened, then first time the whole world started looking that, their supply chains getting concentrated in one country in the world is not good for them. And they all started looking for options. And I think that was the reason that in post-COVID, you saw a lot of mid-cap and small-cap companies reporting good profits, good profit margin, good growth in profit, more actually on the improvement on the margin rather than on revenue growth, because there were a lot of restrictions to import to avoid the dumping of the products in the country, and also a lot of European, and I'm telling you first-hand experience, I've met many corporates, the exports have gone through the roof to Europe and US. And that was the reason that the market did so well post-COVID. I think this is the second, and this is a much bigger jolt than the earlier one. And this time, while it may temporarily look very scary, but I believe that this will do wonders for the country, because if you see the pre-tariff war started, the GDP estimates for all the leading economies in the world, and the gap between India and them was already stark. And now if you see the revised estimates, India's GDP estimates has cut by 20 to 30 bips, which is like 5% on the base. But if you see other economies in the world, the cut is like 30-35%. So we are become more attractive than anyone else in the world after this tariff. And I think this is a much bigger opportunity than what we saw post-COVID. So I think this time the whole world will agree to one thing, that you can't not be in India for your manufacturing and supply chain. And in turn, investors will also realize that we need to be in India. So I think we will see a flush of money coming to India in next few months. And I'm very, very optimistic in the market. I was not so optimistic in last 2 years, but now the way things are panning out, I think we are in for a golden decade kind of situation.
Oh, wow, what a mood changer that is. I haven't heard you sounding so optimistic, Sandeep, like that. Rajesh Palve also with us. Rajesh, are you feeling that mood as well?
The mood is already there on the prices, and the way Nifty has moved up 1,000 point in the last 5 days, that clearly shows that yes, everybody is now buying in the market, and now the broad-based buying action, which is clearly the indication that yes, this upward trajectory can extend further, and possibly Bank Nifty is just few point away from the all-time high trajectory. So I think. That clearly shows that there is a confidence the sector where there is no impact of tariff volatility. I think banking and financial, I think that sector has clearly given us indication that market is ready to move further higher, and Nifty is also following the same behavior. So we believe that yes, possibly we may inch up or scale up to the level of 24,000 level in the continuation of this up move. And I think this positive trajectory will keep on continuing for some more, week from here onwards.
Rajesh, with respect to Bank Nifty as well, what are the levels right now that you're observing? It's hardly a few points away from touching its life high. What are charts indicating to you right now?
So for Bank Nifty, clearly, I think the next target where we can see in next couple of days towards 55,000 and 55,500 as most of the private banks like ICICI Bank, HDFC Bank are now at all-time high trajectory. Again, the PSU banks also started participating in this upward momentum. I think SBI is also contributing to this rally, and we believe that we may see another 1,000-point rally can be there in Bank Nifty from here onward. So buy on dip would be the advice. Till Bank Nifty is holding above 53,600 mark, I think there is a possibility that 55,000 to 55,500 would be the next target in coming weeks.
Right, and from the basket of stocks that are seeing significant momentum in trade, what would you go ahead and buy right now?
So two stocks idea where we are focusing at this moment. One is from the insurance basket, that is SBI Life is looking very attractive. The way stock managed to view breakout of almost 10 to 15 week consolidation at the lower band, and now the breakout is clearly indicating that this stock can extend its gain. Even most of the insurance stocks are also contributing this upward momentum. So SBI Life, we are projecting target towards 1650. With stop loss of 1575. Another stock is Avenue Supermart. DMart is also looking bullish. The way stock has managed to recover all its losses from the October 2024. Now stock is managing to fill the bearish gap which was there in the stock weekly chart. Long built up is there in data. I think DMart can be looked at for buying side. Our target for near term perspective is 4460. Keep your stop loss around 4335.
Okay, so that's the view with regards to where Rajesh's picks are concerned. With respect to HDFC AMC, the numbers are just out and Harsh is taking a look at that. While he's taking a look at that, there are good amount of gains in terms of profit. The board has also declared a dividend of 90 per share. There is also total income, which is up by about 20% Net profit is up about 18% for the counter. Harsh, if you've had the chance to take a look, what's the first cut? What is the read-through right now?
Well, it looks like a very good set of numbers overall. 21% growth at a time and in a quarter when you've largely seen a correction overall. The stock reaction also quite decent in that sense, 2.5% higher. Sandeep, your view very quickly on the initial read-through on the numbers?
No, so I think as you rightly mentioned, the numbers are all around positive, and Also, the way it was not, it has gone through time correction. So I think this whole space of AMC is coming back. Very hard to comment, although on one specific stock, but I would say that the whole AMC space is looking very good. The whole NBFC space and the banking space. So this whole BFSI space itself is looking very attractive.
And what about Rajesh? What about your take on charts? How does HDFC AMC look on charts?
Well, stock now managed to give breakout about 20-day, 50-day moving average. Even 20-day moving average has given a positive crossover to 50-day moving average. So it's a sign of strength on the near-term perspective. Stock managed to give breakout of its previous swing high also. I think if its stock sustain above 4160 level, there is a chance that, again, stock can extend its gain towards 4260, even 4320 kind of level. So I think those who are already long in trade can hold the position with trailing stop loss of 4170.
Okay, so those are levels on an HDFC AMC, dividend of 90 rupees a share, a healthy 2% dividend yield at the current price as well. 18% profit growth is what the counter has seen for Q4 FY25. So overall, a decentish kind of a set. I also keen to understand the view, Rajesh, with regard to something like an Angel One. That was the other one which took out numbers or came out with numbers. What's the sense like on that one?
So after correction, stock is now consolidating near to its 20-day, 50-day moving average. It's almost, consolidation of last 4-5 weeks, but the stock not managed to give breakout of this range. So 2450, 2500 is the key level on the higher side. Once stock crosses these level, then we can see, good rally in the stock, and then maybe short covering would trigger about 2500 level, and then possible target towards 2650, 2700 we may see in short period of time. But till the time stock not crosses those level, I think some consolidation in range of 2250 to 2500 would be there. And possibly stock may attempt to give breakout on the higher side, as on the lower side we have seen accumulation activities already happening in this stock. So about 2500, I think we may see a sharp rally towards 2650 to 2700 level.
One has made a full recovery in that sense from the day's low, and that was the sense that despite the weak numbers, are we starting to see a bottom here is essentially the big question. Both are guests suggesting so. I want to also quickly mark out that HDFC AMC, in terms of the PAT estimate, was 606 crore. PAT has come in at 638 crore. So surely a beat on that count. Stock reaction also suggesting that. So just want to put it out there. It's a very strong set of numbers overall from HDFC AMC.
HDFC AMC is looking good. Just the point on Angel One, I mean, I wouldn't give it too much credit of some great bottom being found, because look at this, is a rising tide lifts all boats. Then I want to see what's happening with the 361 and Anand Rathi, all winners through the morning, and the kind of move there. 361 come off actually its highs, but Anand Rathi started off well, now looking like it's in the dips. But we've been talking about an interesting story and something which is clearly a setback for HUL. Setback legally in a very small segment, but nevertheless, it's a rivalry in India's evolving skincare market that has spilled into the courts. Honasa Consumer, the parent of brands like Mamaearth and the Derma company, has filed a lawsuit against Hindustan Unilever, alleging that a recent Lakme sunscreen campaign undermines the credibility of its own product. Now, what this the court has said, the Delhi High Court has said, is very interesting. Sesha, I believe the court has asked HUL not to use the same color on its packaging as the Honasa product?
Yeah, absolutely. So the Justice Amit Bansal has asked HUL to remove the light yellow and orange color in the packaging and rather use any other color that is not close to Honasa's Derma Co product. In fact, the court has also asked HUL to say some sellers instead of online bestseller targeting directly Honasa's Dermaco products. Also, HUL has been asked to discontinue the current ad campaign, but they are allowed to run new ads with the modifications, and this include the both change in packaging as well as to say some seller instead of online bestseller. They have also been asked to remove the online ads within 24 hours and remove all the physical hoardings within 48 hours. Further, the case is now dismissed, and also HUL has agreed not to press suit in Bombay High Court filed against Honasa.
Okay, Sesa, thank you so much for bringing us that information. Sandeep, I'll take your view with regards to this, of course, and in terms of how competition is faring out for all these players, where the entire skincare and cosmetics segment is concerned.
So, I believe that India is a very, very big market. We have a growing population, young population with increasing per capita income, and, everyone will fight tooth and nail to get their share of market share. So this is something which will intensify, and I think it will be the survival of the fittest. So very hard to, comment on specific developments, but we are seeing this for quite some time. And I believe that, the good thing is that, ultimately the consumer will be beneficiary, because more superior products at a better price will be the outcome of this thing. And I think that is what will happen finally. So I believe that, with such a big market, these are bound to happen, and this will only intensify from here.
I wonder what's happening in something like a CE Infosystems, absolutely flying in trade. Just picked it up right a couple of minutes back. Look at the spike on that stock. Rajesh, quick perspective with regard to this one, if you have any.
I think, yeah. So looking at the market momentum, I think CE Infosystem is also, participating in this rally, and the way stock has moved up, I think next target towards 1820, we may see in the continuation of this up move. So I think one can trail stop loss towards 1720 at this juncture to hold the position. I think 1800 to 1820 would be the next target for this.
Okay, Rajesh, let's quickly get your BTST ideas, if any. And this is the tricky bit. We're going into a 3-day break, so we'll have to wait and see what happens. But nevertheless, what are the ideas that you can share for the last 10 minutes or of trade?
So Eternal is looking attractive. The way stock has moved up and the breakout is already there on the near-term chart. So I think Eternal can be looked at for BTST perspective. Stock is comfortably holding above 20-50-day moving average, and now negotiating with its previous swing high of March 2025. Long built up is there in data. So I think one can buy this stock for 242 target. Keep your stop loss around 226.
Okay, so Eternal is the one idea that Rajesh is talking about as well. Another stock that has been buzzing is Vari. So it's very important to see the numbers that are going to come in, because that's going to be a big push, and anything that looks like a better than expected Q4 is going to have an outsized reaction. That's what we have seen with Vari Renewable. They've reported an 83% jump in its consolidated net profit at 93.76 crores. Earlier today, we spoke to the company's group head finance, Abhishek Parikh, about their quarter gone by and their order book. Most importantly, we asked him why margins are down despite such an amazing quarter.
So 3.2 gigawatt roughly in terms of revenue would at the run rate of 1.1 crore to 1.2 crore per gigawatt per megawatt would convert into somewhere around 3,500 to 4,000 crore worth of minimum revenue at this point in time. But as we move ahead, we also have a large pool of talent for the business development and sales team. And every quarter we have been building our order book as well. Like last quarter itself, we have seen one of the biggest orders coming up. And especially in the second half of this year, we have seen our order book building as good as 2.5 gigawatt worth of order. Especially in that, I would again mention that we got a single largest order of 2 gigawatt at a single location, which probably is one of the largest order by any solar EPC company at this moment. Our current order pipeline, the total bidding pipeline, which we call for our EPC revenue, is around 30 odd gigawatts. Which last year was somewhere around 20 odd gigawatts. So at 30 gigawatt of order book, we believe we have a reasonable pie to look at, because we have been consistently maintaining our market share also. And year on year, our pipeline increases, and we have seen the impact coming into our order book as well. So difficult to give an exact number, but I can tell you our order pipeline and our overall bidding pipeline has increased significantly in last 12 odd months.
Okay. All right. So order book is looking strong. The margins impacted to some extent by EPC input costs and employee costs as well. But Vari on a roll over here. Sandeep, is this a stock that you like?
So, we run a PMS, so very hard to comment on any stock specific, but I will say that, solar is something which we love a lot, but it is very, very expensive. So not within our philosophy or within our limits to buy any of them. So we are evaluating them consistently. If they come in our range of valuation, what we can give them, then probably we'll look at them. But right now, everything in solar looks very expensive to us.
That's the tricky bit about solar and clean energy, if I dare say. I mean, I'm not putting both in the same context, but Vari is a different story and Gensol is a different story. Not saying it in the same context, but for companies in that space that have the ability to make very big claims, then you have to actually see if they're running through and what their cash flows look like. But on the charts, meanwhile, Rajesh, are you liking Vari?
I have very limited data for this Vari Renewable, and I think looking at the technical, stock is in uptrend only, but still difficult to comment because limited chart for me. But looking at structure, 1060 is the key support area for near-term perspective. Which sustain over these level, I think really can extend further, and I think 1200.
So are you looking at energy? Are you looking at Vari Energy?
No, Vari Renewable.
Vari Renewable, right.
Yeah.
Okay.
So Vari Energy is having data, but Vari Renewable is having limited data.
Yeah. Okay. No issues at all. In terms of, Rajesh, let me also get your point on some of the auto companies right now. For EV plays going to be in focus. Auto again, one sector which was quite beaten down. Will we see that kind of recovery? How are you liking a Tata Motors, for example?
So after the corrective move, Tata Motor is trying to get some buying interest at lower level, but still structure is weak. Stock is trading below to all its near-term, short-term moving averages. But for near-term trading perspective, 600 is the key level on the downside. If it's able to defend this level in this market for next couple of days, I think some buying interest will emerge in this counter, and then on the higher side, the major supply zone, which is placed at around 650, 665, that may act as a resistance area for this pullback action. So those who are already long in trade or want to buy a stock should follow the stop loss at 600. Positional target 650, 660 we may see in the counter, as stock is already in oversold trajectory. So some recovery would be there in the stock in near-term perspective.
Sandeep, if I were to ask you to pick one sector which you believe will really outperform over the next 6 to 12 months, what would that be?
I think banking.
Okay. And your second best?
Second bet will be power.
Okay.
And third will be water treatment.
Understood. And how would QSR line up? Because you're seeing a restaurant brands up 7.5%. So quick perspective.
So a lot of QSR brands have become really attractive, right. and see, the India story is a long term and it will do well. So we are very, very actively looking at a lot of QSR names, and obviously, we can't buy them at what we want to pay, but we are little generous with them.
Earnings seasons have actually kicked off, and Infosys is in focus. It's set to announce its results today, Q4 numbers. My colleague Puneet joins in with more details on that. Puneet?
Well, thanks for that. So Infosys will largely continue the subdued quarter that's expected for the large cap IT players. Revenues is expected to rise roughly about a percentage, while EBIT margins will be under pressure and will fall by roughly about 70 to 150 basis points, and that's because of salary hike that's expected in this particular quarter. Because of that, net profit is expected to fall by 1% to come in at 6,716 crores. Now, apart from the margin hike, margin fall specifically in this particular quarter We are anticipating the deal wins, as a number which is a key monitorable. Do note that Infosys only, discloses the large deal wins, and in the previous quarter it was about $2.4 billion. Now that's actually fallen from roughly the 3 billion to 4 billion range for every quarter. So that will be one of the key numbers to watch out for. Attrition is expected to slightly inch up into this particular quarter as well. That will be another key monitorable. It was 13.7% in the previous quarter, and in the same time last year it was around 12.6%. So one more key monitorable there. Now going forward, I think one of the biggest numbers to watch out for will be the guidance. Brokerages anticipating a 2 to 5% constant currency revenue growth guidance for FY26. We've seen Wipro miss that by a mile, and TCS does not report that. So specifically that number will be one of the key ones to going forward, and if they are seeing any kind of project delays as well in this particular quarter, but largely a subdued number expected. We are expecting numbers to flash in the next 15 to 20 minutes, but press conference at 4:15 will be one of the key ones for any kind of forward commentary going forward as well.
All right, thank you for that, Puneet. So we'll wait and see what happens with Infosys. There was, I think 2 quarters ago, we were closing up the show and Infosys came in the last minute. So let's see if that happens. But a minute and a half ought to go, and what a week this has been. What a day it has been. Let's pull up the Nifty intraday to start with, the fun and games. The fireworks, I think, started about mid-morning and have continued unrelenting. Just look at this chart. I mean, it's a thing of beauty. You're close to the day's high, a little below the day's high perhaps, but 23,872. I just wonder if we have enough to push the 30 points that's left, or we're just being greedy. I saw so many tweets doing the round. I saw one saying that if the markets open another 3-4 hours, you'll cross, I don't know, another 300 points today. So maybe good that we are shutting and leaving some firepower for the rest of the week. Let's pull up the heat map very quickly and show you what's been powering through the day, and it's all about the banks. Eternal, Zomato coming in to push through. Maybe a big weekend, some block deals coming into the picture, but Eternal is the street favorite today. ICICI Bank has hit an all-time high on its stock price, going strong, and overall it is the banks that is driving this. And RIL, it's been a very participatory kind of a bull push today, and it's pretty much just a Wipro and some of the IT pack, not even so many of the IT pack that are languishing. Wipro, because the guidance really to come in and say that we're going to degrow next quarter between 1.5% to 3.5%, a little doubt and little wonder that you've had that kind of an impact. But apart from a Wipro and some of the IT names, Harsh, is just all about the banks and ahead of an action-packed weekend for banks.
Yes, absolutely. Let's pull up the Nifty Bank on that count intraday and just look at the contributors here. Actually, let's freeze this. ICICI Bank, HDFC Bank together contributing 110 points on the index today. That's just those two counters alone. You couple that with a Kotak and an SBI that reaches nearly 150, along with maybe Axis, 160 to 170 positive points out of the 400 positive that we've closed at on the Nifty. That is significant. And therefore really packing a punch. Let's look at the intraday on the Nifty Bank, and you'll see that largely markets today were driven by the Nifty Bank. We've cooled off from the highs for sure. We've closed slightly lower. At one point we were up 54,407 is the high that we made on the Nifty Bank today. So that's how high we were. We've cooled off nearly 150 plus points from those highs. So something to keep in mind, whether we can again reignite that fire starting next week. But that's something you'll want to look out for as well. This is a chart where we're trying to showcase which pocket contributed the most points, and look at the private banks here. 164 points alone by private sector banks. Refiners largely being Reliance, but private sector banks is really the pocket which is standing out. And we spoke about our 160 points contributed by those private sector banks. We did that rough math. That's exactly where we are stacking up. So that's where we are at. Huge contribution today from the private sector banks. Let's look at the sectoral heat map as well before I look at the advanced decline. Sectorally also, you'll see that push from the financials aiding the index. Some of the defensives not doing as well, but yet nothing in the red. That's the key takeaway for me on a day like this, Tamanna.
I suppose except the VIX, which is not in this map. Let's just pull up the VIX very quickly because this is a pretty chart to close markets on, which we have done. Markets are now closed near the high levels, and yeah, there you have the VIX, but nearly 3% down. I wonder if we can pull up the weekly charts now, because this is something that Harsh, you were saying, small week, but has packed a punch. In terms of,
it's a wonderful week in terms of holidays as well. Just 3 days working, Tamanna. So in that sense,
you're working this Saturday.
I'm very aware of that.
But anyway, India, not India VIX. I want to pull up Nifty, Bank Nifty, and let's pull up mid cap and small cap this week, because that's going to give you a picture of what it has been like. And oh, there you go. It's been pretty good. So we started off this week, truncated week on a Tuesday, reacting to the 90-day pause. When it seemed like it wouldn't sustain, it did for India. India relatively better. I'm not sure what has happened today, but I'd love to see the FII figure also coming in. That's been the Nifty. The Bank Nifty has been the absolute star, no doubt about it, but a lot of strength to the market coming in from the Bank Nifty. Same for, I would say, the mid cap and the small cap index as well. So the broader markets.
3 sessions. Tamanna, just wanted to kind of
mark on the Bank Nifty.
4.5% on the Bank Nifty in 3 sessions. So that's how it's played out.
Yeah.
And the Nifty chart not doing it justice, but last 5 trading sessions we've done nearly 7% on the Nifty as well. So just 5 trading sessions, if we pull that up, just the 5-day chart, there you go, nearly. So okay, 6.5%.
Wow.
That is extremely strong. So India is doing fairly well in all of this uncertainty. Out of the last 5 sessions, we've closed in the green in 4 sessions. So that kind of goes on to show the resilience.
We are going into a long weekend, so keep that in mind. But I was seeing an interesting statistic for the US
and
markets.
And its expiry today.
And its expiry, that's probably what's caused the short covering that has come in. But interesting statistics that I was saying, that traditionally in the US, the trading session before Good Friday always closes up in the green. So we'll have to wait and see, because the US will also go into a 3-day holiday. So we'll look at what happens. But next week, important, I think we should mark what's happening on Saturday, because this is next week, but next Saturday is important because you have the big banks, HDFC coming in, Yes Bank coming in, and a whole host of them.
And an ICICI.
And ICICI coming in.
So both of those heavyweights really coming in. You'll also have numbers from Yes Bank coming in. Will be interesting to look at those as well. We'll have, of course, the numbers of Infosys coming later today. So some heavyweights will likely move the index on Monday on the basis of earnings. So that's that. Any others in terms of earnings? You pull all of them up. Okay, so shares to exit lock-in. You have Hyundai Motor, 62% of the share capital to exit lock-in. That's a big one. So something that's the other one to keep in mind. In terms of what to watch out for globally, you have US jobless claims, you have the ECB rate decision, Japan inflation rate, and India forex reserves. Nothing significant in that sense.
Maybe jobless claims, if at all, because of what Fed Chair Powell has now said, saying that the impact of tariffs could be outside. But a lot can happen in 3 days. Nevertheless, we're ending on a good note, so let's savor and live in this moment right now. Keep an eye on what happens with Infosys, and you're logged into the right place to know what happens, because we'll be covering it right here on NDTV Profit. But meanwhile, from Harsh, me and the team that put the show together, thank you so much for watching.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea?
Yeah, I was a super fat, obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show. Viewers, it has been a terrific Thursday on the D Street with bulls taking the charge. Both Nifty and Sensex closed about 1.5%, while the Nifty 50 ended about 23,800 mark. The 30-pack Sensex concluded above 78,500 levels. A splash of green on screen, with all the sectors ending higher on the last day of this truncated week of trading. Nifty Finance led the gains with the Nifty Bank trading just shy of record high. Rupee strengthens against US dollar for 4th consecutive day, strengthens 31 paise to close at 85.38. HSBC reports a robust outlook for the travel and hotel sector with strong Q4 performance driven by Mahakumbh and limited supply. Beyond Q4, hotels face no significant headwinds. Airlines, despite cost pressures, may benefit from the lower oil prices and strong yields, supporting continued sector resilience. Morgan Stanley maintains an overweight rating on Adani Ports, raising the target price to 1,418 rupees. The company's resilient business model, driven by diversified cargo and geographical presence, positions it for growth. Now, India's rising goods exports are expected to boost cargo volumes, while Adani's integrated strategy minimizes EBITDA sensitivity to volume fluctuations, ensuring stability. Vari Energies is the stock that released its Q4 earnings yesterday, and the company has seen a sharp uptick in their profit uptick. Now, the reasons that have impacted is the earnings aided by $75 higher EPC sales on the annual basis. The FY25 order book also includes execution of 15% at 1,524 megawatt. Infosys Q4 preview indicates challenges ahead, with expected revenue weakness and a partial wage hike set to pressure profitability. The EBIT margin is projected to drop by 100 to 150 basis points quarter on quarter, primarily due to the wage hikes impact. Another stock was Angel One, who experienced a muted growth. The reasons behind the fall is said to be the F&O regulation and the volatile geopolitics. Another BIF reason was the broking and distribution margins of the business fell due to them being a prime sponsor in the IPL spends. GTPL Hathway saw double-digit growth in their revenue in this quarter. Biggest reason for their rise is 4% annual rise in broadband revenue. Fall in the EBITDA was due to higher operation expenses along with the project material purchase and inventory costs. IDFC First Bank has approved fundraising of up to rupees 7,500 crore from two investors. Now, Warburg and Abu Dhabi Investment Authority, the notification was given on the exchanges. The bank will have to give 81.26 crore and 43.71 crore rupees compulsorily convertible preferential shares at 60 rupees per piece. Wipro's revenues remain largely flat. While the company saw 13% hike in its total contract value when compared with its last quarter, they could not be converted into revenue growth. And now, in fact, guidance for the first quarter of FY26 remains largely negative. Sonata Software faces challenges as Q4 revenue from its largest client is expected to fall below projections. Now, this shortfall is likely to impact the company's international business revenue, signaling potential headwinds for growth in the near term. The management has guided for a sequential revenue decline of 2.5% to 3.5% in Q4. Morgan Stanley cuts target on major consumer discretionary players. Now, they see multiple compression, especially in pockets where medium-term growth outlook is unclear. They are also uncertain on Aditya Birla Fashion's ability to achieve its ambitious growth goals. However, the brokerage is very positive on Vedanta Fashion, believing the category has runway for growth. Zydus Life will continue marketing its generic Mirabegron in the US despite a US court ruling against it in a patent litigation case. The company is evaluating legal options but has no ongoing settlement negotiation, signaling a focus on defending its position in the market. Zydus Life Sciences also plans to acquire an 85.6% stake in Amplitude Surgical by June 2025, with the intention of acquiring over 90% of the company's capital and voting rights. Now, this acquisition is likely to expand Zydus Life Sciences' presence in the market. Alembic Pharmaceuticals received final US FDA approval for its carbamazepine tablet used to treat certain seizures and bipolar disorder. Now, this nod strengthens Alembic's portfolio, enabling it to expand its presence in the US market for these critical medications. Kotak upgrades Cello World to buy with 710 rupees target despite a 35% stock drop over 6 months. Now, weak growth and delays in glass furnace commissioning have hit margins. Kotak expects moderate revenue growth, factoring in margin pressures, with a 12% EPS CAGR for FY25 to 27, down from 16%. FY26 to 27 estimates are cut by 5 to 6%. Federal Bank reduces savings account interest rates by 25 basis points. Accounts with deposits up to 50 lakh rupees will now earn 2.75%. Those between 50 lakh and 5 crore rupees will get 3.5%, and deposits between 5 crore and 50 crore rupees fetch 5.25%, reflecting a strategic adjustment to its savings rate structure. ABB plans to spin off and list its robotics unit until next year. Now, the business, which provides automation solutions for industrial clients, is to start trading as a listed company in the second quarter of 2026. As per the company's own statement, the unit is a strong performer in its industry and it would benefit from being measured more directly against its peers. Now, their robotics unit generated $2.3 billion in revenue last year. BSE share price rises nearly 2% as bonus issue optimism lingers. The stock has been rallying since the announcement of a 2-for-1 bonus issue on March 30th, briefly hitting a one-month high earlier this month. Now, the exchange platform announced earlier that its board had approved issuing 2 bonus shares for every share held. Now, this marks BSE's second bonus issue in 3 years. Taiwan Semiconductor Manufacturing Company posted better than anticipated quarterly earnings after customers scrambled to stock up on advanced chips. Now, this comes in anticipation of global trade tension ignited by the US tariffs. The main chip maker for Nvidia and Apple reported March quarter net income of $11.1 billion. Blue Smart, a cab service with all electric cars in its fleet, suspends operations in Mumbai, Delhi and Bengaluru. Blue Smart also falls victim to the ripples of Gensol's SEBI revelation of misusing the EV loans for luxury real estate by its co-founder Anmol Singh Jaggi and his brother Puneet Singh Jaggi. The company that started as Gensol Mobility will now lease their fleet to Uber and function as Uber's EV cabs. A steaming rivalry in India's evolving skincare market spilled into the courts. Honasa Consumer, the parent of brands like Mamaearth and Derma Co, filed lawsuit against Hindustan Unilever, alleging that a recent Lakme sunscreen campaign undermines the credibility of its own product. HUL in turn has hit back with a counter-suit, escalating the spat into a full-blown legal battle. Speaking at the CII's 18th Corporate Governance Summit 2025, SEBI chairperson Tuhin Kanta Pandey says that good corporate governance is the foundation of a successful enterprise. He aims to create self-regulating environment. He also emphasized on importance of ease of doing business, highlighting the introduction of tech-enabled single filing system. Fitch Ratings revises India's GDP growth estimate down by 10 basis points to 6.4% for the current fiscal year. The agency cites concerns over a severe escalation in the global trade war. However, the projections for the next financial remain unchanged. They say that it is difficult to predict US trade policy with any confidence. Massive policy uncertainty is hurting business investment prospects. Equity price falls are reducing household wealth, and US exporters will be hit by retaliation. Refix Industries step-down arm Refix EV Fleet Services has phased out its airport-based electric vehicle taxi services in Bengaluru. Now, the decision may be a part of a strategic shift or restructuring within the company. Swaraj Engine sets June 27, 2025 as the record date to determine shareholders eligible for the final dividend of 104.5 paise per share for FY25. Now, the dividend recommended by the board awaits approval at the annual general meeting on July 15, 2025, with payment expected by August 14. Now, this follows a strong quarter for FY25 with net profit up 29% to 45.4 crore rupees and revenue rising 29.4% to 454.2 crore rupees. Collab Platforms declares an interim dividend of 2 rupees per share, with the board setting April 24, 2025 as the record date to determine eligible shareholders. Now, this move reflects the company's strong financial position and commitment to rewarding investors with payment details to follow as per the exchange filing. MS Dhoni-backed drone startup Garuda Aerospace has raised 100 crore rupees in Series B round from venture capitalists and others. Now, the company preparing for an initial public offering has so far raised 160 crore rupees and is currently valued at $250 million. With the funds, startup plans to scale up its current production facility and build a research development center for advanced defense drones. Hero MotoCorp halts production at 4 of its plants for 3 days as India's largest two-wheeler maker looks to tide over a supply chain issue. As per the company's exchange filing, production has been temporarily paused from 17th to 19th of April at 4 manufacturing plants. And as they navigate a short-term supply alignment, the company will use the break to carry out maintenance and general upkeep of its facilities in the north. Production will resume on April 21st. Global firms dial India amid trade heat. Sources tell NDTV Profit that the government has received over 20 plus FDI queries post US tariff move. Now, there has been rising interest in FDI due to relatively lower tariff rates in India. The government is receiving queries from sectors like chemicals, auto, textiles, electronics. In fact, some FDI approvals have been sought for joint venture with the minority Chinese stake. Now, the government has approved 7 to 8 joint ventures in non-sensitive sectors. The board of Root Mobile approves appointment of Mark James Reed as chairman of the company. The decision was made based on the recommendation of the Nomination and Remuneration Committee. The appointment follows the resignation of Guillaume Antoine Bouton, who stepped down as non-executive and non-independent director and chairman of the company. HDFC Life announces its quarter 4 earnings. Net profit came in below estimates at 477 crore rupees versus estimate of 719 crore rupees, but the net profit grew by 15.8% on a year-on-year basis. Net premium income too grew by 16% at 23,766 crore rupees on an annual basis. Businessman Robert Vadra appears before ED for third consecutive day. He was accompanied by his wife and Congress MP Priyanka Gandhi. The third summons issued follows a money laundering probe linked to a 2008 land deal in Haryana. West Bengal teachers whose appointments were cancelled earlier this month due to irregularities in the recruitment can continue to teach till the fresh selection process is completed, says Supreme Court. Stressing that students' education must not suffer. This relief is for untainted teachers, those whose names were not linked to any irregularity during the investigation into the 2016 appointments. Hearing on Waqf bill in the Supreme Court is underway. The Apex Court takes on record the statement of Solicitor General that Centre will respond within 7 days. SC says that Solicitor General assures the court that no appointments will be made to the Council and Board. Supreme Court says that let the response be filed by the Centre within 7 days. Fed Chairman Jerome Powell, while speaking at the Economic Club of Chicago, said that the larger than the expected tariffs means higher inflation with slower growth. He also mentioned in his speech that Fed would wait for more data on economy's direction before making any changes to interest rates. Trump calls Howard University a joke, says the Ivy League should no longer receive federal funds. Trump's remarks come amid a funding standoff between US administration and Howard that has become a focal point of his war against elite educational institutions. Puerto Rico suffers in the dark after being hit with a massive power outage. Now, energy plants across island unexpectedly shut down. This is not the first instance Puerto Rico has been dealing with chronic power outages, including a blackout on New Year's Eve as its infrastructure crumbles. IPL 2025 experienced their first super over match yesterday between Delhi Capitals and Rajasthan Royals. defending a total of 189. Rajasthan Royals ended up levelling up the score. In the super over, Rajasthan scored 12 runs, losing up both the wickets. On Delhi Capital side, Tristan Stubbs pulled a 6 on the third ball of the over, helping the team win match with 2 balls still remaining. The rivalry week has started as the MI will play against Sunrisers Hyderabad today. Mumbai has a bigger advantage as they have won 13 times out of 23 when both the teams have faced each other. All eyes will be on the key players such as Abhishek Sharma and Travis Head, as they are the key players in the Orange Army, while the Mumbai Indians will be backing on the shoulders of Hardik Pandya, their captain. Well, with that, viewers, it's a wrap on Market Express, but stay tuned to NDTV Profit as there's more lined up ahead for you all.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact, had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth.
Bulls take back the charge on Dalal Street as the Nifty reclaims 23,800 mark, whereas the Sensex rallies over 1,500 points. All sectors rally. Financials lead the sharp surge. Nifty erases all the losses for 2025. Due to the US raising tariffs on imports, sources tell NDTV Profit foreign companies are showing more interest in setting up factories in India, where tariff rates are comparatively lower. Over 20 queries have been received by the government from industries like chemicals, auto, textiles, and electronics. All eyes on the Infosys Q4 results. The company expects challenges ahead with revenue weakness and a partial wage hike set to pressure profitability. IDFC First Bank receives a shot in the arm and a major boost as global investment heavyweights Warburg Pincus and Abu Dhabi Investment Authority step in with a combined infusion of approximately 7,500 crore to fuel the lender's next phase of growth. The High Court comes down hard on Unilever in the sunscreen face-off, ordering HUL to remove light yellow-orange color in its packaging and use any other color that is not close to Honasa's Dermaco, also ordering Unilever to discontinue its ad campaign. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it, shall we? The benchmark indices rallied for the fourth consecutive session, outperforming broader markets and marking a significant recovery today. The Nifty 50 snapping a two-week losing streak and recording its best weekly performance in over 4 years. Now, the gains were driven by strong performance in the banking sector, with the Nifty also logging its best week in nearly 4 years while ending a two-week losing streak. Additionally, we also saw Nifty Realty Index emerging as the top sectoral gainer, breaking a 3-week losing streak and contributing to the market's momentum. My colleague Harsh now joining us for a better perspective on this robust week for the benchmark, underscoring investor optimism across key sectors. Harsh, over to you.
It's a good day of trade for markets. We've closed the week a solid 2.5 to 3% higher on the Nifty 50. So truncated week, but we had a very, very good week in that sense. And what we've seen over the last 4 trading sessions since maybe Friday is a very sharp surge in the Nifty. In fact, the Nifty is up nearly 7% in the last 5 trading sessions. So we've had a good kind of a run over the last few trading sessions. What happened today? And let's focus in on that. One, you had banks lead the charge today. We were up nearly 400 points on the Nifty and largely around 170 of those points positively contributed by the Bank Nifty constituents within the Nifty 50. So solid take, especially from private sector banks. The other one was also the PSU banking pack, which did well, and SBI was up 3% odd, and therefore even the PSUs contributed well to this. It was the financials which led the charge. It was expiry day as well today, mind you, in this truncated week. So something to keep in mind that it was an expiry day as well. The other piece is with regard to certain stocks which did well. From the pharma basket, you had a Sun Pharma doing well. You had an Eternal which was flying away in trade, which is Zomato, and therefore some of those counters doing well. Pretty much all sectors closed in the green. IT was slightly tepid, with Wipro being the biggest loser on the Nifty 50 after the results that they declared, 4% lower on Wipro. IT, the index, though, you know, in that sense was in the green. I mean, just marginal green, but green nonetheless, and therefore not as impacted as Wipro was in trade. And despite that, we saw the IT index close in the green. So that was the one positive point. Overall, all sectors in the green. I did mention that. In terms of the advance decline and the breadth was positive. Initial bit of choppiness at the start of trade, but the breadth closed positive. Both the Nifty mid-cap and small-cap, the broader markets, they underperformed the index sharply. And that kind of shows how much of private sector banks really played a role in the Nifty 50's move in trade today in particular. So something to keep in mind, that it was largely driven by the private sector banks. But overall, we saw a good day of trade to close this week off. Now, in terms of views from markets, we had views coming in from Mihir Vora on whether markets have actually started to bounce back. Listen into a slice of that conversation we had with him.
Indian consumption story remains very, very solid, and India does tend to kind of rebound also quite well after most global crises. So I think India's relatively lesser dependence on exports is one. Second is the overall RBI policy approach also has now turned more dovish. So we are seeing liquidity come back into the system locally.
I'm expecting the commentary from the banks to be positive after a long time. I think last 2-3 quarters we saw the commentary being cautious, which was rightly so, but I'm expecting that the banks will signal that the worst is probably behind, and then we are getting into a cycle which has lower cost of capital, better credit offtake, and better margins.
We've had a very unique situation in these last 6 months, wherein the average decline in stocks on the NSE was about 42%, and you had so many stocks among the top 100, which really stood out really well. I think on the first signs of global stability, you have the Indian markets running away, because, this 25,000 crores, which was just waiting on the sidelines, waiting for global stability, that has kicked in the last 2 weeks, and this is probably the reason the market has seen a V-shaped recovery.
Absolutely, it is the end to a very reassuring week. But let's take you now to an NDTV Profit exclusive where sources are telling us because of the US raising tariffs on imports, foreign companies are now showing more interest, understandably, in setting up factories in India where tariff rates are comparatively lower. Sources also adding that 20 queries have been received by the government from industries like chemicals, autos, textiles and electronics. Essentially, to put it very, very clearly, global firms are rethinking their supply chains, and India is now slowly but steadily emerging as a competitive choice for manufacturing. Let's hear more on this from my colleague Shrimi.
Yeah, what we've been given to understand that government has received, 20 plus foreign direct investment related queries in past 2 months, which is mainly, related to setting up manufacturing base in India. And these queries are spanning across these sectors, but particularly in chemicals, automobile, textile and electronics. It's what sources hinting at. And in fact, sources tells us that some of these queries are actually also related with joint venture with, Chinese backing companies, and in fact the government has approved a couple of these in 7 to 8 such proposal in past few months in non-sensitive sector though. So, couple of scenarios is at play at this point of time. What sources indicating us that, the foreign players are definitely restructuring their investment strategy and kind of looking at how to sort of diversify their supply chain when it comes to Indian market, and the kind of cost-effective manufacturing ecosystem India is offering, in terms of having PLI kind of scheme. They are giving them or boosting their entire sort of strategy at this point of time, and the way tariff situation has arisen and the India dealing with this tariff situation with, handling the bilateral trade agreement, which is already in works, and we will see that it's concluding by, September, October. So the way India is moving and handling the situation, global companies has kind of getting sense and realization that this is the time they should come to India, set up their manufacturing base and leverage the kind of competitive advantage India has, and that will definitely reflect in the coming months as well, as far as, these companies' FDI is concerned.
Thanks so much for that, Shrimi. This clear shift that we can see as India stands to gain across multiple sectors as global firms are now reconfiguring their supply chains in response to shifting trade dynamics. And to delve deeper into which industries could benefit the most, let me quickly turn to my colleague Himangshi now for expert insights on the emerging opportunities. Over to you.
Yes, Anjana, so big moves in the global trade, and India could be a surprise gainer. The US has slapped steep tariffs of up to 245% on Chinese goods like the electric vehicles, batteries and semiconductors. But what's the reason behind it? Well, this is part of a bigger strategy to reduce dependence on China and protect American manufacturing. But here's where India enters the spotlight. As China becomes costlier, companies may shift their focus to India for manufacturing. That means more factories, investments, and a boost for Make in India. Plus, India's own EV and electronics sector could get a boost as global players look for alternative sources hubs. In short, it's a trade war, but India might just find opportunity in the chaos. Back to you, Sanjana.
Thanks so much for that insight. And moving on, the board of IDFC First Bank has approved a plan to raise up to 7,500 crore from two of its investors. And to provide insights on who these investors are and how the bank plans to execute this fundraising initiative, let's turn to my colleague Harsh for all of the details.
Where IDFC First is concerned, they've done a fundraise, 7,500 crore fundraise, around 4,900 crore to be infused by Warburg Pincus, around 2,600 crore by Ardia. So marquee investors coming in at 60 rupees a share. Now, in terms of how this is being done, it's been done through a CCPS, which is a compulsorily convertible preference share. Each preference share will be converted into equity share and therefore is equivalent to equity share. The conversion, post-conversion, Warburg will hold around 9.5% equity in IDFC First. Ardia will hold around 5.1%, and the book value currently is at 52.85 post the infusion of money that's come in, and therefore it's happened at around 1.13 times price to book. Now, one thing to be mindful of is IDFC First has raised money in 2023 and 2024 at far higher valuations. Something to be kept in mind. They've raised at around 70 to 90 rupees a share. So again, that is one thing to be kept in mind. They've done around 6,500 crore of cumulative equity raise back then as well. But this fresh equity raise happening at 60 rupees at a price to book which is just about 1.1 times. So again, that's one thing which really stands out.
And we also spoke to V. Vaidyanathan of IDFC First Bank on what the purpose of the fundraise was. And he said that in early stages, whenever small banks require capital, since the return on equity is lower than banks' growth, they raise money to achieve higher returns. He drew a comparison with how ICICI Bank raised funds for itself earlier. Here's a snippet of that conversation with my colleague Sajid. Let's take a look.
All of these raises have all been above book value per share. All. So every one of them adds to book value per share because you're giving new shares at a higher price than the book value. So net, the book value per share after this transaction will touch close to 53. But that's one point. That's one part of the story. Now, I think a more fundamental question should be that why you're raising capital, so much capital, why you're raising so frequent capital? Is that the question simply?
Yeah.
Yeah. Now, I need people to understand this basic fact that if you look for a bank which is like 30 years, 35 years in existence, they're already running to peak profitability. So their capital is almost equal to the return on equity. Their growth is almost equal to return on equity. They can keep on forever. But for our bank, starting from zero. So for a bank which has a zero return on equity to start with in 2018 or 19, so, right now, let me call it around maybe 7-ish or so, if you take out MFI impact. So your return equity is 7, growth is 20, the gap has to come from capital. But the good news is that 0 has moved to 7. We believe 7 will come to 15 or 16 also. But it's a phase. Early stage bank, every bank starts low and then becomes, bank like ICICI or HDFC. Think about how ICICI raised capital 20 years ago. They raised $5 billion in 2005, $3 billion, something like that in 2005. That's one of the capital initial stage people raise.
And wondering why you are unable to book a ride with BlueSmart? Well, the fast-rising cab company with an all-electric fleet has started suspending its operations, leaving thousands of users in Delhi, Bengaluru and Mumbai in a flap. The service abruptly stopped operating following the SEBI order against its promoters in a loan fraud case. Meanwhile, in the aftermath of the Gensol fraud, BlueSmart Mobility Private Limited has now started rebranding its electric cabs as Uber Green in Bengaluru. My colleagues Tushar and Haripriya bring us this ground report.
Why is BlueSmart in a spot of bother? Remember, BlueSmart is an EV ride-hailing company. Operations of BlueSmart, India's only pure-play EV cab operator, has come to a screeching halt after Gensol Engineering was pulled up by SEBI for misappropriation of funds. But first, let's explore what's the connection between BlueSmart and Gensol. Both BlueSmart and Gensol share a co-founder in Anmol Jaggi, the promoter of Gensol Engineering, who was accused of misappropriation of funds to the extent of buying a flat in DLF Camellias in Gurugram. BlueSmart works on a EV leasing model. Essentially, it gets all these from it gets its electric cabs from a EV leasing company, which acts as a middleman and sources loans from government institutions such as IREDA. These funds are used to then buy electric cabs and are then leased out to companies like BlueSmart. BlueSmart was a key beneficiary of these electric cabs at favorable lease terms. Now, with Gensol gone, the future for BlueSmart looks uncertain. Remember, BlueSmart was operating about 8,500 to 10,000 electric cabs on a daily basis and was doing about 20,000 rides per day on average. Its actually USP was catering to the airports in Delhi, Bangalore, as well as Mumbai. What we are hearing from sources is that a part of that fleet will be taken over by Uber, who will be running these cabs under its Uber Green wing. There were also talks of an acquisition by Uber of BlueSmart. There is also talk of a hybrid model where BlueSmart leases some of its cabs to Uber as Uber Green and itself operates a pruned fleet of its own.
Here at BlueSmart's charging station in Sarjapur area in Bangalore, there are about 200 vehicles parked inside and they have not moved since last evening. We also heard from drivers that near the airport where there's also a BlueSmart charging hub and the Prickle hub there. There's some re-labeling is happening where BlueSmart stickers have been replaced with Uber Green stickers.
So essentially, BlueSmart, which was a good EV cab company, a look into the future of mobility, is now facing existential crisis.
Thanks Tushar and Haripriya for that ground report. This is the aftermath of the Gensol fraud that we actually have been relentlessly following up. Moving on, let's take you through a clash that's taking place not just on social media but even in the courts. The legal clash between Hosana Consumer, Mamaearth's parent company and Hindustan Unilever has escalated, with the Delhi High Court now issuing directives for Lakme Sun Experts campaign overhaul. Justice Amit Bansal ordered HUL to replace online bestseller with some sellers in the campaign, adjust packaging colors to differentiate from the Dermaco packaging and immediately discontinue its current advertisements. For more insights into the court directives, let me quickly turn to my colleague Sessa now, who's joining us on the phone line with more. Sessa, first, if you could take us through what exactly the Delhi High Court said. We understand that just yesterday, Mamaearth dragged the Hindustan Unilever to the courts, alleging that this particular ad was disparaging in nature.
That's right. So HUL has voluntarily agreed to take down the current ad campaign and modify it after, Delhi High Court had asked them to do that. In fact, Justice Amit Bansal had asked HUL to say that the packaging should read some sellers and instead of the online bestseller directly targeting Honasa's Dermaco product. In fact, the court has also asked HUL to remove the light yellow and orange color in the packaging and use other colors that's not close to Dermaco sunscreen. In fact, the court has also asked HUL to discontinue their current ad campaign while they can run new ads with the modifications that the court has directed. They have been also asked to remove the online ads within 24 hours and further remove all the physical hoardings within the next 48 hours. Further, HUL has agreed to this directive and also agreed to not press the current suit in the Bombay High Court filed against Honasa.
Right. So, if you could actually take us through, Sessa, the terms really, and I'm not just looking at what this particular case is, but when it comes to trademark infringement, when it comes to disparaging ads, if you could give us a little bit of background into the protocol or the SOP that brands usually follow.
So, well, there are certain protocols, but it depends on several brands. Like, you cannot use the exact color or the packaging of the same product. You cannot use the exact, alphabet style rather to in your products as such. We have seen several cases in the past. For example, between Dabur and Imami, similar cases happened, and the court has kind of asked them to distinguish the product specifically so that they don't mislead consumers, and also they don't replicate each other in a way. So this is one of those cases, and now that HUL has agreed to kind of modify the ad campaigns and also the product packaging, we might see them come up with a new product packaging that will have any other color rather than orange and yellow, which is used by Derma company.
Right, Sesa, thank you so much for that. This very social media-led spat, then going to courts and finally hoping that we see the end of this fight over SPF 50. But for more on this, I'm going to go across to my colleague Malika to give us a background on how these two companies actually ended up in this legal drama in the first place. Malika, over to you.
Yes, thanks for that, Sanjana. And as you rightly mentioned, this is, I call it the SPF 50 fight between the two largest FMCG companies in India, right? Now, this started when HUL's Lakme dropped an SPF lie detector advertisement that claimed some digital brands that, project to be online bestsellers provide an SPF 50 protection, whereas in actuality, they only provide an SPF 20 protection. Along with that, this ad campaign also said that these companies that go ahead and do these ad campaigns boast global standard in vivo testing as well. But when Honasa noticed this, it basically did not take this lightly. Honasa said that Lakme is unfairly targeting rival sunscreens, and this ad resembles Dermaco's packaging. In fact, Honasa called it a hit-and-run case, and it sought court action to tweak or remove the ad. Now, when this, became a legal dispute, the Delhi High Court, as Sesa already mentioned, said that HUL will need to replace the word some sellers to, will have to replace online bestsellers to some sellers. It will have to remove light yellow, orange color in packaging and use other colors that's not close to Derma company's packaging. And it has also asked HUL to remove online ads within 24 hours and also remove any kind of physical boarding within 48 hours. HUL has also agreed to not press suit in Bombay High Court filed against Honasa.
Absolutely, Malika. Thank you so much for bringing us those updates. This spat now being taken to the courts and now resolved with the High Court actually pulling up HUL and asking them to take down this advertisement in 48 hours, discontinue the campaign completely and also change the packaging. Let's take a look at some of our other stories now that are making news around India. Stressing that students must not suffer, the Supreme Court has said that West Bengal teachers whose appointments were cancelled earlier this month because of irregularities in recruitment can continue to teach till the fresh selection process is completed. This relief, however, is only for untainted teachers whose names were not linked to any irregularity during the investigation into the 2016 appointments. Ease My Trip has clarified that it has no connection with the Mahadev app or any other betting app after the ED conducted searches in more than 50 locations, including the company's Gurugram office. The ED believes some proceeds of crime from the illegal operations of the app, amounting to nearly 6,000 crore rupees, went to entities connected to Pitti. Just 8 months into the biggest assignment of his career, it could be curtains for Mumbai stalwart Abhishek Nayyar as the Indian cricket team's assistant coach amid speculation that he has fallen out with a high-profile member of the support staff. If board sources are to be believed, Nayyar has already been intimated of the BCCI's decision to part ways with him. Amid the ongoing language row, the Maharashtra government has announced that Hindi will be introduced as a compulsory third language for students from classes 1 to 5 starting from the 25-26 academic session. The decision was made public through a government resolution issued by the School Education Department. And we have an update coming in with regards to Q4 earnings. The net profit at 7,038 crore versus the estimate of 6,698 crore for Infosys is currently been released. We'll try and bring you more insights on this shortly, but this is the information that we're getting in right now. This is after we have in fact wrapped up a week of significant earnings, but revenue coming in as the board approves the dividend of 22 rupees a share. So the Q4 earnings, Infosys, everybody and all eyes were in fact waiting on these particular numbers. But the net profit now standing at 7,038 crore versus the estimate, the FY26 revenue guidance at 0.0 to 3% is what we're seeing at this point of time. Revenue at 40,925 crore versus the estimate of 42,117 crore. This is as the board of the company has approved the dividends of 22 rupees a share. These are the key takeaways that are in fact coming in on the Infosys Q4 earnings. This is as the company has announced the net profit of 7,033 crores. This is against the estimate of 6,698 crores. But Infosys now announcing their Q4 earnings. We'll continue to bring in the updates as we hear more on this. But this is the key takeaway at this point of time with regards to Infosys. The revenue at coming up, this is higher 3.3% at 7,000 crore versus 6,806 crores. This is of course higher than the estimate. So good news coming in, but the board also approving the dividend of 22 rupees a share with the FY26 revenue guidance at coming in at 0 to 3%. But this net profit coming in. My colleague Puneet is going to be joining us shortly with more insights on this. But this is what we're seeing at the moment with regards to Q4 earnings on Infosys. The latest coming in as Infosys declaring its March quarter end earnings. That's the Q4 earnings coming in at the moment. Sure. And Infosys declaring its March quarter end earnings, the net profit up 3.3%. Infosys is a leading Indian multinational corporation specializing in information technology, consulting and outsourcing services. Infosys has been in the spotlight. This is what we have been reporting all day as it has announced its Q4 FY25 earnings. And investors now keenly watching for updates on its financial performance, as we have just told you. My colleague Puneet now joining us for more insights on this. Puneet, this is especially after a challenging year where its stock has in fact seen a decline year to date. But give us a sense of what the numbers are saying, how they are stacked and what this means.
Well, thanks for that, definitely. You know, we've seen the revenue for the company coming at 40,925, and we are flashing that the EBIT margins, you know, largely in line, 21%. Net profit, 7,033 crores. That's also slightly, you know, if I can, you know, pick the well, it has come in more than the estimates. Estimates was of 6,716 crores. Another key aspect is revenue guidance. It is a disappointing number, 0 to 3% effectively. It was expected to be between 2 to 5% for the revenue guidance in this particular quarter. And that's one of the key things. I think the revenue not meeting guidance is definitely a key negative year for Infosys. Specifically, we have seen revenue expectations was of 42,144 crores. It's come in at 40,925 crores. There will be a key reason for that, I'm sure, but as of now, that is a negative. They have still managed to meet the, you know, EBIT guidance largely in it's a 30 basis point miss, but I think that is one of the key negatives for Infosys in this particular quarter. We've seen the revenue miss definitely there. When you look at the net profit, expectation was of roughly 6,716 crores. It's come in much higher than that. So we will actually see if there's any exception item there, because revenue miss is there, but the PAT has been met. So that is one of the key numbers here. So that is one aspect. We've seen EBIT margins also largely meet for Infosys at this point of time as well. The key aspect apart from that, which I can see right now in the numbers, is of course the constant currency revenue growth. It's a negative 3.5% in this particular quarter for Infosys, and hence I think that number will also be taken slightly in the negative pinch as well. FY26 guidance expectation was 2 to 5%. It's coming at 0 to 3% for FY26, and that is one of the key numbers for Infosys in this particular time frame as well. I'm just going to toss it back to you, Sanjana. Just having some issue with the EP, I'm going to toss it back to you, and then we'll go to Omkar as well of Vasuki India to talk more about the numbers as well. We're just going to toss it back to you for the moment.
Right, Puneet, thank you so much for that. And as you catch your breath, as you were keen to actually talk about this update coming in, we also have Omkar Tanskale of Vasuki India Fund joining us on the phone line with more. Omkar, give us your first thoughts on these numbers with the earnings out. What are your key takeaways from this?
Yeah, it's high, first of all. Yeah, it's definitely a miss on the revenue front. Generally, Infi has a better for Q4, but this quarter they have standing below the guidance range. I believe it's more of the softening and uncertainties going around because of the tariff hikes. That is, tariff hikes and the tariff uncertainty is going around from the North America region. So that is impacting more on the IT business side. So the visibility is not there in terms of revenue. I'm not much worried about the margins, because the margins are likely to come as we grow with the volumes. So that is not a major concern for us right now. The major concern is for the demand scenario, which is extremely uncertain, and we should definitely, it's a challenging time for the IT sector as a whole, if it has been concerned.
Absolutely. So I actually want to ask you a question following up to that. How did the IT sector's performance actually impact Infosys's performance this quarter, given, like you rightly spoke about, the tariffs? So I'm keen to understand the kind of impact that we're going to see moving ahead.
Yeah, I mean, definitely next to a couple of quarters might face the heat, because even the TCS management, the Wipro management has all, everybody is saying that there isn't quite uncertainties. So the clients are refrained from giving the expenditures and the outlook going ahead. So absolutely there is no visibility going around. So it might take, a couple of quarters to things get settled down and they can ramp up. See, as far as deal wins are concerned, the deal wins for all the companies too strong. So there might be a delay, but definitely the demand will come. But we don't know when, but then a couple of quarters will be definitely a challenging one.
Omkar, it's Puneet this side joining in as well. Very good afternoon, and thanks so much for joining in. Just looking at the numbers, currently we are seeing, a slight miss as well. Largely EBIT margin is coming at 21%, but that's despite the revenue coming in lower. So I just wanted to understand, because we had guided for revenues to be roughly around 42,200. It's coming at 40,900 specifically. Despite that, they have been able to meet the EBIT number specifically. I'm not sure if you had a look at the numbers. What do you make of these couple of numbers to start off with?
See, Puneet, I am not quite worried about the margin things, because, they go slow on the hiring. They can control the margins up to a certain extent, maybe 30-40 basis points. They go slower on on-site expenses. So the margins can, they vary. But the real concern about the IT sector as of now is majorly on the demand side, not on the margin front, because the demand is quite skeptical, and everybody, you can see the results as well. That is very reflective, and you can easily digest it from that. So from the point of moment, it is very difficult to say what kind of a growth that is every IT company might achieve in FY26, because after the COVID takeoff, there was a sluggishness going around because of the rising inflation and uncertainties going around. So there might be a hope of FY26 will be likely to be better than FY25, but that is not the case. The things are getting delayed because of the tariffs and rising micro uncertainties. So that is cause of worry. So you will not get you will not get a might of multiple that you are expecting for the current scenarios.
And Omkar, I just want to ask you your view on the deal wins. You mentioned that deal wins is something that you're not looking at right now. It's coming at roughly about $2.6 billion. Last quarter was $2.4 billion. So while we take your point specifically that we are seeing project delays going forward, this number is largely positive on the deal wins. Is that a correct assumption?
Yeah. Nobody's sure whether when the deals are getting ramp up. It is getting delayed because from last 1 year the deals wins are getting resilient despite of having uncertainty. So the deals are going to be there. But nobody knows how the ramp up. But TCS management has also indicated that there are no ramp downs as of now and no deal cancellation as of now. So things are on the hold. So we might take out that it is on a status quo, as we have seen in the previous few quarters.
Omkar, we've also seen one other number that's for every IT company that is slightly inching up is the attrition number. It's coming at 14.1% in this particular quarter. Last quarter was 13.7%, and the same time last year on a year-on-year basis was 12.6%. But the headcount number has largely not been changing a lot. It's not like the clients are adding or the companies essentially are adding higher number of people in terms of headcount, and despite that the attrition has inched up. Do you see that is largely a demand problem, or how are you viewing this particular number as well?
No, I decode it in such a way that they are going slow in hiring side, as so there is no immediate ramp up of the large deal account of any deal. So they are on the demand side. We can decode this in a way that demand is not going to pick up immediately any which ways. Otherwise, that would have been reflected on the on the number of the hirings and attrition rate. So there might be the challenging time still persist, and we might get a delay in terms of valuation.
Omkar, we leave it at that. Thanks so much for joining. And viewers, specifically, we have seen the results largely missing. But we will see more comments in the presser that's on right now. So let's switch in and join into the Infosys press conference. Let's cut across to that.
1% operating margin, 4.1 billion free cash flow, and 11.6 billion in large deals. We feel the performance has been solid all around across the year. We're seeing growing demand from clients to partner with them on AI. They're moving from a use case approach to an AI-led transformation approach. This is using AI agents, which are playing more and more of a critical role, and we believe we have a very leading position in AI agents with over 200 agents we've developed. We continue with our strategic expansion and acquisition in the energy and consulting space in the US, acquisition in cybersecurity space in Australia, and a new strategic partner becoming part of our joint venture in Japan. So all three areas are areas where we have strategically looked to expand, and we are further committed with this expansion in the US in a very critical area for that market. We have a set of capabilities that support clients in their growth, whether it's AI or cloud or digital, and in their efficiency, whether it's automation, cost reduction, lean, and consolidation. So we feel well positioned in this environment to look at both growth and both cost areas as clients look at them. Based on what we see in the environment today and building